Good morning. It is Wednesday, September 21st, Fed Day here in New York City and, well, everywhere. This is Yahoo Finance Live. I'm Julie Hyman. That is Bradley Smith over there. Brian Sozzi is on assignment. Let's take a look at futures here this morning. Things are perking up a little bit, but of course everything could change once we hear from the Fed and also once we get the press conference later today. Up just about 153 points there on the Dow futures, S&P futures also pointing to a higher open. Nasdaq 100 futures up 0.5%. And of course, it being Fed Day, we got to check on what's going on in the bond market after the big move upward that we saw yesterday. Yields coming down a little bit, just about 3 basis points on the 10-year.
Yeah, a little bit of calm before the excitement here with some of the fractional moves higher. We'll see exactly where the market then reacts later on in the day. And that's largely going to be on the commentary that we receive from Fed Chair Jay Powell, even after the official decision drops at 2 p.m. Once 2:30 p.m. hits, that's when you should keep a close eye on some of the tick by tick that takes place.
Yes, most definitely.
All right, well, 75 basis points. That's what the street is expecting to hear from Federal Reserve Chair Jerome Powell today. The latest rate hike decision will be announced today at 2:30. And joining us on what we should expect from the FOMC meeting is Yahoo Finance's Jennifer Schonberger. Jen, good morning. You are live from the Federal Reserve in Washington. And so
good morning. That's right, Brad. I am live here in Washington from the Federal Reserve. In this building behind me, policymakers are commencing the second day of their two-day policy meeting, where they are widely expected to raise that benchmark interest rate by 0.75 of a percentage point when they conclude their meeting at 2 p.m. this afternoon. In the face of stubborn inflation, officials expected to raise the Fed funds rate to a new range of 3 to 3.25% from 2.25 to 2.5. This would mark the third 75 basis point rate hike in a row, an unprecedented move since the Federal Reserve has started explicitly targeting the Fed funds rate since the 1980s. The Fed likely to signal that they will raise rates more aggressively and expects rates to be higher for longer when they release that so-called dot plot, which is the individual interest rate projections of each Fed official. Now, markets expect the benchmark interest rate to rise above 4% by the end of this year, according to the CME Group. However, how high, how quickly, and how high rates remain at those levels remains uncertain. Officials also expected to release new projections for inflation, unemployment, GDP, which will give us a clue into how they see the outlook for this economy and setting monetary policy, and how perhaps tighter policy will factor into that. We'll hear more from Fed Chair Powell this afternoon when he gives his press conference at 2:30. Guys?
Thanks so much, Jan. Appreciate it. Of course, you're going to stay right there to monitor all of that. But let's continue the conversation on the Fed here today. You know, I'm really going to be paying attention to that dot plot, right?
Yes.
This is the mapping of the expectations of the FOMC members themselves as to where they expect rates to go. And as we've been talking about with guests over the past week or so, the so-called terminal rate, not just what they're going to do today, but what they're going to keep doing and at what rate are they going to end, has really gotten to be much more part of the discussion, and it has been moving upward. So we're likely to see that dot plot go a little bit higher, perhaps.
Yeah, we're expecting that we're going to get to 3 to 3.25% by the end of this meeting. But then you look out to November, particularly, and that's where we're getting even more of that expectation that there could be another 75 basis point hike in November. And that right now is priced in at about, well, the probability of that is about 62% based on the CME FedWatch tool. And so we could potentially be hearing even more about that later on from Jay Powell in terms of, to your point, the direction that the Fed heads from here and the aggressiveness that they continue to maintain over the next few meetings. And so that's where it really comes down to the dot plot. It also comes down to the data that the Fed is going to be looking into and where that actually shows that inflation and some of the targets that they're using as their benchmarks, where that starts to ease, and hopefully we get better CPI prints leading up to that next meeting as well. But that is going to be critical in the data dependency of the Fed.
Yeah, if you look at the figures that the Fed has been watching, it's been watching CPI, it watches PCE, which is effectively another version of CPI, right? This stuff has not been going down at the rate that the Fed would have wanted. And the other measure it's watching very closely is consumer confidence. And that's a number that's been a little bit more mixed. The Fed probably going to be paying a special special attention to the expectations, because inflation expectations help to sort of determine the future path of inflation. Yeah. And so all of that going to feed into what we hear today, the dot plot, all of it.
Well, let's bring in RBC Capital Markets equity derivatives strategist Amy Wu Silverman for much more on this conversation. Amy, great to have you here with us this morning, and particularly going into this meeting, or at least the decision to come from this meeting, your expectations, not just for later on today, but for what you may be listening for from Fed Chair Jay Powell. Amy, do we have you? Okay, we're going to see if we can get Amy's connection back up. But it's interesting, in some of the notes that Amy had sent over to us, it's really also going to hinge on where some of the traders are looking across some of the most volatile assets, even going into this decision and even there afterwards. And so keep a close eye on the VIX as we move on throughout the rest of today too. But we've already started to see on the side of the publicly traded companies who are really pricing in or looking through what a recession may look like for themselves, because the Fed is also going to perhaps steer away from themselves proactively using the R word recession, but they're going to be questioned about it for sure.
Yes.
And what they're comfortable with the economy incurring over the longer term extent of their decision making with the policy.
Yes, will Jay Powell utter the word recession? That is a good question. Amy Wu Silverman watches volatility. You just mentioned the VIX, and I know that she was watching that and sent us some notes about that. Volatility sellers have been out in full force, she said, even as the VIX is around 25, 26 as we've been watching it. And she also points out that, FOMC, once we get past that, then we'll have the Jewish holidays, so that we could start to see a bit of a decline in volatility from these elevated levels where we have seen it as of late. So that's something to keep an eye on as well, that we will, after this, maybe get a little bit more calm coming to the markets, at least until the earnings season kicks off in earnest. After this, the next Fed meeting isn't until November 2nd.
Right.
So we do get once again a little bit of a gap before that big catalyst.
And also in November, midterm elections as well.
Oh, yeah,
that's
that little
going to be
thing.
Interesting, the timing. Yes, all of that coinciding at once. I believe we have RBC Capital Markets equity derivatives strategist Amy Wu Silverman back. Amy,
There
I see
she
you
is.
smiling live and living color. So the feed is good. We are good. All right. So
I'm so sorry about that.
That's all right. Technology happens, right? For better or for worse sometimes. So let's get your expectations going into the policy announcement later on today, and what you're going to be listening for from Fed Chair Jay Powell.
For sure. So, look, I think the expectations from our own rate strategists and from the street right now is still for 75 basis points, even though, of course, those expectations of 100 have grown in proportion. So obviously for the Fed and for Jay Powell, it's about the future. And I think, a lot of the crowd that had expecting this lots of rate hikes and then cuts in 2023, that has declined somewhat. And you really feel that, frankly, in the volatility. And you start to see that pick up pretty dramatically in September. And my view has continued to be that this continues both through September and October in terms of both the pickup and the level of volatility that we will see.
Amy, what are you guys hearing from clients right now in terms of their level of nervousness around the Fed or level of confidence in the Fed to kind of steer us through here?
It's been very interesting because volatility has misbehaved so much this year, Julie, that actually clients, frankly, are a little complacent. There's actually been a lot of volatility selling. And you're seeing these interesting dynamics, right, where on days when the S&P is down, the VIX is actually down too, which is usually supposed to be an inverse relationship. And you're also seeing clients come in when volatility is high and actually sell it, because the reality is, even with the drawdown that we saw in March, that is actually the strategy that has been working. And what concerns me about that is there are many tails that are still in the market. I only need to think about Russia and Ukraine to be reminded of these tails. And they're really being priced quite low, and they continue to be.
And so what are you advising to clients right now? What particularly, even as you think through strategy, not just for the rest of this year, but even into next year, given that we've already seen some companies who are trying to get a grip on exactly how deep a recession might impact them, and what that may mean for their own forecasts?
Yeah, it's a good question. And unfortunately, we've had to be very nimble and very nuanced. So, there's kind of these textbook trades that make sense in different volatility environments and in different environments where skew that demand for hedges is placed a certain way. But unfortunately, this year they haven't worked. So one thing we've said is, look, when hedges don't work, you have to be really tactical about it. So even into something like the FOMC, you have to be more short term. You have to do trades where you're doing some sort of spread. You're essentially not paying so much volatility. You're trying to cheapen it somehow. And then you have to do some relative trades. And so, for instance, we look at the US versus Europe. We look at different sectors, maybe funding from a sector that has recently outperformed, like an energy sector, let's say, to fund protection in a different sector. So different ways to cheapen trades, but ultimately still saying that we are looking for that downside protection.
What tends to happen during, if we do end up getting a recession, what tends to happen with volatility during recessions, Amy?
It's interesting because the first thing I did as we headed into this cycle is I looked through essentially 30 years of data to answer that question. And it's sort of unsatisfying. It's a very mixed bag, so part of it is kind of like 2/3 of the time you get this volatility pickup, but 1/3 of the time you don't. And then if you include the taper tantrum, which some people say should be included as part of kind of looking at rate cycles, it actually increases a little bit. So, most of the time volatility picks up, but there are times when it doesn't. I think part of that has to do with expectations. And then outside of that, it also has to do with the level of volatility coming in. And remember, we had a decently high level of volatility coming in because of the pandemic.
And then additionally here, Amy, we were trying to coincide all of the different macro events that are taking place going into even the next meeting. And whether that's, moving through some holidays, whether that is also on the political front, an election, a midterm election cycle, how does that all kind of coincide together? And what should traders be bracing for even later on once we get to that November Fed meeting?
It's interesting because geopolitical events tend to be very kind of gappy from a volatility perspective. Political events are not necessarily that way. So, you'll see this pickup in volatility kind of heading into midterms, but oftentimes it's sort of you actually sell into those news once that occurs. Now, earnings, on the other hand, which kicks off in early October, is critical. And especially as you head into the end of the year and it's sort of the company's last time to kind of give key information, potentially give guidance for the new year. Those tend to be very volatile events. If you actually look on a month-on-month basis, October is really a critical event for volatility rising. And then, of course, outside of that, there are these unknown unknowns, which, the options market and the market in general has a very hard time pricing, like geopolitical events, which can always cause that gap and then reprice your tails very quickly.
Wow. All right. Keeping an eye out for the unknown unknowns. We're just going forward best we can. RBC Capital Markets equity derivative strategist Amy Wu Silverman, thanks so much for the time this morning. And on the other end of the inflation conversation, gas prices here. After 99 days, straight days, in fact, of declines, U.S. gas prices saw a slight tick up today. Currently, the average price for the U.S. is around $3.68 per gallon. That's up 0.7%. Still, prices are down significantly, though, compared to the peak price of $5 per gallon. That was back in June. Crude oil prices have also tumbled quite a bit as recession fears they weigh on the energy market. We're keeping a close eye on crude oil futures as well here. They're up right now. Coming up, the conflict between Russia and Ukraine. It escalates as Russian President Vladimir Putin says that mobilization events will begin today. We'll discuss the latest next. Welcome back, everyone. Tensions rising in the Russia-Ukraine crisis as Russian President Vladimir Putin has announced a partial military mobilization that could add an additional 300,000 personnel to Russia's military campaign in Ukraine. For more on what this means moving forward, our very own Rick Newman joins us now. What should we take away from this most recent mobilization effort from Russian President Vladimir Putin?
It's a big deal. It's a lot more than just adding a few new troops to the fight in Ukraine. For one thing, this is going to be politically unpopular in Russia, and this is something that Putin really wanted to avoid. That's why at the beginning he called it a special military operation. He was going to do this with the peacetime military. He was not going to have to bring this home to regular citizens in Russia. And now that's changing. And there's some speculation that even though he's saying, well, right now it's just reservists, we only need 300,000, it's people who already have some military experience. He could actually expand it beyond that. It's an acknowledgement that he is losing and he needs to do something dramatic. So I think it's not overstatement to say this is probably the most perilous moment for Putin in the 20 years he's been in power in Russia. And it raises some very weird questions about how does this end? Because he's not going to win the war in Ukraine. How desperate is he going to get? How dramatic are whatever might come next, the military moves that might come next? He hinted at the possible use of nuclear weapons. That's probably a bluff. He's probably not going to do that, but probably the likelihood of those types of desperation moves is now rising.
It's so interesting to me to see the market reaction or lack thereof to this latest, what you said. I mean, this is a dramatic step that he's taking. And maybe the takeaway is that it doesn't change the eventual calculus for the outcome of the war. Perhaps it just changes Russia's calculus and Putin's calculus here. I thought it was also interesting. I was seeing reports this morning of plane tickets out of Moscow being booked. People are trying to flee so that they won't be conscripted, which also tells you something about how this is being received. Yeah,
and plane tickets now to places like Georgia or the UAE are now, if you can get a ticket, it's like between $2,000 and $4,000. That tells you interesting supply and demand dynamic there. This affects markets relatively directly through energy.
Right.
And markets have been figuring this out since Russia invaded back on February 24th. And markets are going to have to continue to figure it out. So, I mean, is further turmoil in the energy markets priced in right now? It's maybe not, because there are some energy analysts who think that we are going to see Russian oil supplies coming off the market as this gets worse over the winter. There's supposed to be a European boycott of most oil purchases from Russia that goes into effect in December. That does not appear to be priced into the market in terms of energy prices right now, because that probably would take some Russian supply off the market. And the oil market is tight right now. So you lose any supply, prices are going to go up. I think markets don't think Europe is actually going to go through with that boycott. So that is something to watch for sure. And then we've got the whole situation with natural gas in Europe, which people should know does affect natural gas here, because we are now exporting as much natural gas to Europe and other places as we have capacity to export. And natural gas prices here are up as well, not by nearly as much as they are in Europe, thank God. But we're going to have an expensive winter here, and it's going to be really dicey in Europe.
Okay, so there are broader implications here in terms of how Russia has cozied up to China as well in all of their movement forward with their military operation. Have we heard any type of response from China? And I guess on the other side, too, if we look at the Western response, given that this would also entail even more of an acknowledgement from the West that if Russia is going to continue to ramp up, then there could be some type of support that is still necessary to provide to Ukraine.
Putin met recently with the leaders of both China and India, and they were kind of like, hey, Vlad, how about you wrap this thing up? So China has not really lined up right behind Russia and said, we'll give you whatever you want. They have not been backfilling a lot of the exports that Russia now is not getting from other countries because of sanctions. India has kind of said the same thing, although both of those countries are benefiting from getting Russian oil on the cheap at a discount of $20 to $30 below market value. They're still buying it. They're getting a good deal on oil. But Putin does not have very many friends here. And the thing to keep in mind over the next several months is this the end game for Putin? So if there are going to be internal challenges to his rule in Russia is going to come through the types of dynamics we are now starting to see with he's losing the war, he's mobilizing, so he has to bring the war home to Russia. People are trying to get out of Russia, so that they don't get conscripted. So is it possible that this could build into something that means Putin's downfall? I mean, it's probably not likely today, but we're closer to that, I think, than any time we've been over the last 20 years. So watch what happens.
Yeah, definitely. And I imagine we can also watch what happens with President Xi, for example, to see if he sort of pulls back further from his support. All right, thanks, Rick.
Thanks, guys.
Appreciate it. And before we go to break, a programming note for you. You might have noticed he's not here. Brian Sozzi is covering the Dreamforce conference in San Francisco. He's going to be sitting down with executives today and tomorrow. Today, he'll talk with Salesforce CEO Brett Taylor. You can catch that later on this afternoon. He'll also be talking to their chief product officer, in the next hour, in the 10 a.m. hour. But coming up in the next few moments, Stitch Fix stumbled in its fourth quarter earnings with a weaker outlook and a dip in active customers. We'll have more on that and the opening bell next. Welcome back. We still have a few moments to the opening bell, so we're taking a look at some of the movers that we're watching on this Wednesday morning. Stitch Fix is definitely one of them. Those shares about 5% to the downside. The company missed fourth quarter earnings expectations, posted a 9% drop year over year in active clients. To remind you, Stitch Fix sells clothing, but it's supposed to be sort of picked by an algorithm in cooperation with a person. You get a box, you decide what to keep. But this company has just been a perennial underperformer. The stock is down 75% this year. I believe it closed at a record low yesterday. And we're just not seeing any kind of signs of a recovery here.
Stitch Fix has been fumbling the bag. I don't know any other way to put it right now. And it's really looking at some of the consumer appetites and the ability to maintain that consumer that's been so critical that has just not been taking place. I think for a lot of the consumers coming out of the pandemic, they were not necessarily looking for everything to be picked for them, but looking for some differentiation, looking for the opportunity to kind of take that into their own hands. And even as they're now looking at what their expenditures may look like on a discretionary basis, it's even more of the cutting through the exact products, the clothing or the footwear that they need right now versus wants, and that makes even more of the actual picking important to that consumer. And so one thing that sticks out to me is that to even re-engage those who have not bought with Stitch Fix, clients who haven't shopped with them for over 12 months, that's going to be marketing dollars spent for re-engagement campaigns. And then it's the new client acquisition costs that are also going to rack up in this interim period of time to try and get back to profitability. They talked about this on the earnings call, and I think that there's going to be so much that needs to get put into some of those marketing expenses and the client activations and acquisition, that's going to continue to be a near-term headwind for this business.
Yeah, and the company also has been transitioning more into not just the traditional box business, but also getting people to just buy single items. And the CEO sort of pled for more patience on that transformation. But the patience is going to have to be extended. And we just showed what the company's forecast is for the first quarter, and sales going to be well below what analysts had been predicting. So, you know.
Just to put some numbers on this too, the active clients, it was a decrease of 9% year over year. Net revenue decreased 16% year over year. And so, looking at these figures, it is a larger question of what that timeline looks like to get back to profitability that investors are looking for right now. And they've launched affiliate networks, influencer networks. That's more marketing spend for client acquisitions. They're going to continue to make improvements in the freestyle launch. That's part of the business that you were talking about that allows people to pick just one piece that they want to get or a few pieces versus having somebody box it up and say, this is what the algorithm says you should wear. Just do this. So it's really just so much of the costs that I think about that they're going to have to actually put out the door in order to just get back to profitability at some point.
Yeah, well, the stock is certainly reflecting some of that sentiment. Well, the algorithm right now says that we have to talk about the opening bell and talk about the Federal Reserve once again, because that really, we've been talking about these micro stories. Obviously, the biggest macro story right now is what the Federal Reserve is going to do today and what other central banks, for that matter, are doing. The Riksbank of Sweden got attention yesterday for raising its rates by 100 basis points. Some were then extrapolating what that might mean for the Fed, but the Fed is, of course, its own man, so to speak. We are seeing futures indicate a higher open this morning ahead of the Fed's press conference.
There's going to be a ton to really kind of look through what Fed Chair Jay Powell says in that conference later on today. Of course, we'll be tracking that in the 2 p.m. hour with some special coverage at that time, too.
We will indeed, yes. We can't leave that aside. That's the big thing of the day. Here's the opening bell on this Wednesday morning, and we are seeing a delegation from the government of Indonesia ringing the opening bell, and this reminds us, of course, that there's something else going on this week, and that is the UN General Assembly here in New York City, and a lot of other conferences that run at the same time. The Clinton Global Initiative Conference is back, for example. The Gates Foundation doing events. I was at earlier in the week at a conference called Concordia that looks at private-public partnerships. So a lot happening on the sort of big policy front, even as we are also getting a lot on the monetary policy front, not just here, but around the globe.
Midtown was swooning with security officials yesterday. All throughout Midtown, I was walking through and just trying to figure out which streets were safe to walk on. And it was a lot of course, and rightfully so, given that all of these nations are going to be represented and so many dignitaries and elected officials in attendance. And so if you are in the area, just make sure that you're knowing exactly where to steer clear of.
And take the subway.
Yeah. All right. Well, we've seen the major averages open to the upside here. Also been keeping an eye on some of the sectors here. Major averages up across the board. 11 S&P 500 sectors in positive territory right now. And you're seeing that on your screen with some of the Dow Jones Industrials as well, at least to kick off today's trading activity. Only 3 laggards as of right now. And then on the sector front, you're seeing leaders in energy, industrials, and real estate to start off today's activity. Let's also take a brief look at shares of General Mills, ticker symbol GIS. It is moving reporting on some news this morning, beating earnings expectations on both the top and bottom lines. It's holding on to some of those gains that we're seeing pre-market, given some of the shifts from pre-market into the trading session. I had to catch myself there for a moment. We are up, though, holding on to those gains by about 3.5%. Company also raised its sales guidance as they now expect organic net sales to rise between 6% and 7% in fiscal year 2023 here.
Let's just put a fine point on this.
Yeah.
This company raised its forecast.
Yes.
Which is definitely in the minority of what we've been hearing from companies, right? We've had a lot of industrials cut their forecasts. We've had chip makers cut their forecasts. We've had retailers cut their forecasts. But cereal's doing fine. Well, cereal and lots of other stuff that General Mills now sells, including Bisquick, including, I believe they bought a pet food business as well. So there's a lot in there here, but the company's been raising prices. That has been helping its numbers as well. Interesting here that organic net sales in the first quarter, so that's when you take out currency fluctuations, you take out acquisitions, we're up by 10%, which is better than estimated. So that pricing seems to be paying off.
Yeah, General Mills is still a good barometer for where the consumer is leaning towards in some of their purchases on a cyclical week in, week out basis. And for some of the categories that are making their way to the pantries and right now have more of a shelf life, that's perhaps what consumers are leaning into as well, whether or not you can get that in a wholesale kind of bulk, or if you are buying it on an individual basis. I mean, I've got my own cereals, everybody does, of course. But I think that's where General Mills in this interim period of time, especially in a weaker consumer confidence or consumer sentiment period, where General Mills may be looked at as one of those brands that could be insulated because of their annexation to both the pantry as well as the refrigerator and having more shelf life in those categories too.
I'm just going down a little bit of a rabbit hole here to find out who makes my breakfast cereal. What is your preferred breakfast cereal, first of all?
I mean, I'm a big time Cinnamon Toast Crunch fan.
Oh, wow. You go for the sweet.
It's all about the milk afterwards.
You just pour some sugar right down your gullet first thing in the morning.
What's the better way to start off the day?
I can think of a few ways. I like, no surprise, I like Heritage Flakes
Okay.
made by Nature's Path.
Okay.
I don't know who owns Nature's Path. I still haven't discovered that in my Googling, but it's just, flakes, not too sweet.
But I trend French toast sticks when I can, outside of cereal.
Of course.
That's where I go. It's the freezer over the cereals for me.
Of course. That makes sense. As your stomach growls, as mine has been doing this morning as well. All right, let's talk about Coty this morning after the beauty and cosmetics company said it is on track to double its skincare sales to between $500 million and $600 million by fiscal 2025. Coty has also seen stronger beauty demand, leading the company to raise its first quarter sales growth outlook. It says that was fueled by both prestige and consumer beauty. Now, in this sort of in-between time that we're in right now, waiting for earnings season to begin, we've had a lot of companies that are holding investor days. Yeah. So that's where this Coty news is coming from. What's also remarkable, we have seen such strength in beauty at this period of time, right?
Yes, absolutely. This is the little luxuries that I love to talk about when there are times of a pullback in some of that consumer confidence, or even in the discretionary spending. Consumers will look to the cup of coffee. They'll look to some of the cosmetics brands to feel that sense of your dollar going farther than it is in some other categories. And so, and having that immediate gratification as well. And so in some of the plans, it's going to be interesting to see how much of that is front loaded in this interim period of time, as households are just looking across their spending, or individuals looking across their spending. But in part of these details, they're looking to achieve skincare sales of $500 million to $600 million, that by fiscal year 2025. And they're going to accelerate growth in fiscal year 26 and beyond as well. They're also going to have some new launches for their key skincare brands, and also raising some of their revenue and gross margin guidance. And so all of that kind of playing out within this broader investor announcement and an investor event taking place here today too.
Yeah, and we should mention, when you talk about its brands, CoverGirl, Max Factor, some like core drug store brands, but then they also have some higher end brands as well. Right. So sort of taking advantage potentially of that whole gamut of different price points. And the company has raised prices a couple of times this year, and already has said it plans to raise prices digitally going into 2023. So all of that perhaps helping the numbers as well.
All right. COTY seems they have an alibi here. All right. we're moving on here to talk about Bitcoin on the other side of this short break. Bitcoin is higher right now by about 1.8%, sitting just above $19,000 USD, ahead of the Fed decision at 2 p.m. We're going to discuss the latest in the crypto space. That's next. Bitcoin hanging above $19,000 ahead of the Federal Reserve decision this afternoon. The cryptocurrency's market value has declined by nearly 60% this year. Yahoo Finance's David Hollerith is here with us in studio today to talk all things crypto. Okay, so what should we expect the crypto reaction to be, especially given the Fed policy decision to come later on this afternoon?
Well, Brad, at least expectations as far as yesterday afternoon were not high as far as how Bitcoin would respond to this. It's typically highly sensitive to interest rate hikes in the past. So that being said, there are some very bearish takes out there looking at Bitcoin going as low as $10,000 per coin. But that being said, I think the real question is more about whether or not we'll see the lows we saw this summer in the asset. So, we're looking at sort of the upper 17,000s for the price to see how it will react. But that being said, obviously the correlation with the stock market has gotten to record highs, especially in the last month for Bitcoin. And so right now, it's essentially a leading indicator maybe for how the market might react.
Yeah, I mean, and I've seen a lot of commentary, specifically between the correlation between tech stocks and Bitcoin as well. There's another story that you're watching that has been so interesting to follow, right? It has to do with the future of Voyager. Binance and FTX appear to be reportedly some of the top bidders for Voyager, or the bones of Voyager, I guess. And this is interesting because it's been, as we've been tracking the fallout from crypto's crash, Binance and FTX appear to be two of the strongest surviving players in the space.
Yeah, that's a great point. So Voyager is holding sort of an auction for their assets in bankruptcy court right now. At their peak last year, the stock market capitalization was valued at $3.9 billion. And a report from the Wall Street Journal last night cited sort of Binance making a bid of about $50 million. So for Voyager, that just goes to show how far the price of its assets have dropped. But on the other hand, it's sort of a steal if you want to get into crypto lending, which, despite the summer insolvency issues, it seems like that game is not up yet.
I want one more just on the merge aftermath, if I may, because this has been such a fascinating time in Ethereum land. And there were so many Bitcoin maximalists out there for so long. I think of Michael Saylor and the additional purchase that MicroStrategy just made. Yeah. Like, are we seeing more divergence in the crypto community between those maximalists and then people who have gone more towards the functional cryptos like an Ethereum?
Yeah, Julia, I think that's a good point. It's definitely the case. In some ways, like very like hardcore like Bitcoin investors actually think of themselves as sort of critics of the rest of crypto in a way, and how they view the asset. I mean, they think of cryptocurrency essentially as just money. The way the Bitcoin blockchain is managed is completely different from Ethereum. So you sort of have this desire for censorship resistance, which is sort of the Bitcoin camp, and then the rest of crypto is sort of on a spectrum of software and like more akin to what we see with like Silicon Valley. And Ethereum's actually not the farthest on that spectrum. There are much newer chains, blockchains that are basically all powered by Silicon Valley venture capital. So that obviously is a very different model, much more like a company, even though they are decentralized projects than say something like Bitcoin. But Ethereum sort of is kind of trying to sort of toe that line in between. And after the merge, there have been a few developments to where we're going to have to see, what decisions they make in terms of how compliant they want to be with governments, to sort of figure out where Ethereum falls.
Wow.
Cool. Well, luckily we have you around to help us help keep us posted on all of that. Thanks, David, and it's great to see you in person here in the studio. All right, coming up, we're going to speak with one analyst on how he sees companies combating that crypto winter that we just alluded to. That's on the other side of the break. Winter isn't coming for crypto. It's already arrived. BTIG just wrapped up its second annual Digital Assets Conference featuring 180 companies. A big focus of this year's meeting was how companies are weathering the downturn and also the future of digital assets. This, as we just talked about, Bitcoin dropping below 20,000. Joining us on this, one of the conference hosts, BTIG Managing Director and Financials Analyst Mark Palmer. Mark, it's always good to talk with you to get your thoughts on all of this. We were just talking about with David, the sort of increased correlation between stocks and Bitcoin, tech stocks in particular, and Bitcoin. How are people sort of viewing that right now in this environment?
Yes, there definitely has been a correlation between risk assets and speculative cryptocurrencies. There's no question. Bitcoin is certainly reflecting that, as are the proof of stake cryptocurrencies and altcoins. But at the same time, I think one of the things that popped out of this conference is the fact that not all crypto-focused firms are in the same position. Yes, the exchanges and the brokerages are seeing volumes that are down significantly as a consequence of the price decline. But if you look at a platform like a Silvergate Capital, which serves institutions basically as an on and off ramp for crypto, has a really exciting stablecoin initiative that it's working on. It's really demonstrated resilience during the crypto winter. It was reflected in the company's second quarter results, which were better than had been feared, significantly better, in fact. So I think that this is a time really for those who are looking at crypto stocks to put on their analyst hats and think about taking a careful look at the fundamentals of these companies rather than putting them all in one pile.
Outside of core crypto, what do you believe retains value after this crypto washout or this crypto winter?
Well, again, remember, there's much more to Web3 and the ecosystem than just speculative cryptocurrencies. And we're seeing this now. You know, there's been 16 billion raised by Web3 firms during the first half of 2022. We're seeing new unicorns created even amidst the crypto winter. And I think the key thing here is that there needs to be infrastructure built on the one hand to prepare for the time when the winter ends and we see more players coming into the space, particularly on the institutional front. And I think that the number one reason why institutions haven't plunged into crypto to a greater extent is a lack of regulatory clarity. But that's not keeping them from coming into the space, setting up shop, getting up to speed on where things are. Frankly, that was a big part of what our conference was all about. At the same time, I think you're seeing pockets of Web3 that are outperforming significantly. We're just talking about the Ethereum merge. Well, Ethereum's move from proof of work to proof of stake has created enormous demand for staking. You know, we had staking platforms speaking during our conference that were telling us that their volumes have doubled during the first half of the year, and they expect them to ramp up further now that the merge has occurred. And frankly, if you look at the publicly traded companies out there, a company like Coinbase has a staking platform available for both retail investors and institutions. You know, we think that's an overlooked part of that story.
But for Web3 to really take off, it would need to have other assets on top of Web3 that are also carrying their own value too. I mean, we've seen a wipeout in some of the kind of annexed non-fungible tokens that have been on top of the Ethereum blockchain. And so even with that downfall in some of that value for the assets that are on top of the blockchain, you know, where do we start to regain some of the attention or some of the fanfare or comfortability with people saying, you know what, I'm willing to ascribe value to something that's sitting on type of a Web3 platform that perhaps they haven't fully wrapped their heads around yet?
Right. Well, you know, NFTs are a good example. I think that in retrospect, what happened to the NFT market during 2021 in particular was more of a furor or a craze, and there was a lot of froth in that market that wasn't really justified by fundamentals. Frankly, one of the things that we're seeing in the NFT space is that the utility of NFTs is really coming to the fore. The fact that this is not just about art, that there are many other use cases for NFTs. The programmability of NFTs is really coming to the fore. So we're talking about the use of NFTs to make supply chains more efficient, as used for storing medical records in a much more efficient manner. That utility aspect, I think, is going to really be a bigger part of the NFT story going forward. It's not just about collectibles. There certainly is a market for that. One thing I will say in that regard is that a theme of our conference is the number of brands, big consumer brands, that are using NFTs as a means of increasing engagement with their customer bases. We're seeing this from sports franchises. We're seeing this from everything from liquor brands that are enabling liquor to be traded, essentially to change hands because it is embedded within an NFT, to all sorts of brands that are looking to establish a presence within various metaverse games, Decentraland, the Sandbox, and the like.
BTIG Managing Director and Financials Analyst Mark Palmer. We got to continue the conversation at a later date, but we appreciate you joining us here this morning.
Of course.
Guys, coming up, NVIDIA has announced the launch of new hardware cards. Yahoo Finance's Dan Howley is going to share the details next. Welcome back, everyone. Despite a global pandemic and supply chain problems, NVIDIA is on track to release an entire new graphics card line, but it comes at a high price. The flagship RTX 4090 card is dropping in October for the hefty cost of, get this, $1,599. Yahoo Finance's Dan Howley is here to explain it all to us. Okay, so the significance of this card, and is the pricing fair around it too?
Oh, like how does it compare? I have no context for how much a graphics card costs.
So you figure this is a price jump from prior generations, right? You would figure the $1,599 card would be like the epitome of what's available, and sometimes they'll release something called a Titan card, which is like, beyond what the average person needs, but you use it because you're feeling a little extra bougie, beyond bougie, I don't even know. But usually these cards are less expensive, right? These are the cards that gamers will put into their PCs. So not only is it the card, but you have to still build the rest of the machine around it. So it's making this far more expensive. Now, we already knew that prices were higher during the pandemic because these cards were very hard to get. So that was shooting up demand and pricing as a result. These, though, are launching at a much higher MSRP than the prior generation. We're talking about the $1,599 for the top RTX 4090, $1,199 for the RTX 4080, and $899 for the RTX 4080 with 12 gigabytes of RAM. There's also some discontent among gamers because they're calling two of these cards 4080s, right? But let me just to give you a background, usually NVIDIA releases a 90 series, an 80 series, and a 70 series. They're not doing that here. They're just calling the lesser version of the 80 an 80, which they shouldn't, and it's kind of a little deceptive.
Yeah.
And I think gamers are expressing that online already, along with the pricing. I mean, look, $899, that should really probably be the middle ground for those kinds of cards. You're talking probably $599, $499 for an entry-level card for something like that. You can go get a PS4 for that, and you don't have to build the rest of the system around it. So I don't know how gamers are really going to respond as far as when this goes on the market. I'm not going to buy one because I am not made of money. I wish I was. But I do think the benefits of these are going to be, clear once you put them into your system. They're saying 2x performance in certain search situations. We haven't seen a new card in 2 years, so this is the first one. It's running on the Ada Lovelace version of their technology. Prior to that, they were using Ampere. So they're big improvements, yes. But I don't know if that means that gamers are going to want to take that jump, especially when you consider what's going on with the economy right now.
Yeah, and to that point, I mean, you sort of zoom out, all of this news is coming out of NVIDIA's GTC conference, where they tend to announce all of these things. But sort of hanging over the industry is what's going on with fundamental chip demand. And on that front, we got a downgrade for Micron today from Mizuho, a price target cut at another firm because there's a little more pessimism there, although the shares are trading higher.
Yeah, I believe BMO and Wells Fargo went ahead and changed the price target. And, it's just because people aren't buying PCs or they were going from the absurd demand we saw during the pandemic. And that's just fallen off a cliff. You don't need to buy a PC every year. Look, we talk about smartphones, right? I mean, these are more expensive than PCs for the most part, right? $999 for a base model of an iPhone Pro. But, people are willing to do that for smartphones because it's the one device that they always have on them, right? Even during the pandemic, I'm sure you were walking around your home with this. This thing is in the bathroom with you all the time. Yeah. But your PC, that doesn't do it. It stays there, you use it for work, and then you're like, okay, I'm done. Unless you're gaming, in which case it's gaming, work, and then the rest of the time you have this on you. So people just don't see the need to go out and buy those. We're also talking about smartphone demand dropping, though, and that's the other issue, right? They have NAND chips and they have DRAM chips. Those are in both PCs and smartphones, and just the demand is now dropping as we see, obviously, the economic issues that people are going to be dealing with, as well as inflation. So I don't know how much this will bode for, or how well this will bode for NVIDIA. Obviously, they had those prior cuts to their outlook in the prior quarter. And so, I don't necessarily know that that's going to mean that these pricier cards will end up selling. But, I'm a giant dork. I love video games. I would love to be able to drop one of those big boys into my machine, but it's not happening anytime soon.
Well, we know you're going to continue to be tracking the NVIDIA conference that's taking place all throughout this week, the 19th through the 22nd here. So we've got a few more announcements to take place, and we're going to hear from the CEO later on once he speaks today, too. Also, we'll keep a close eye on shares of MU, everyone. Thanks, Yahoo Finance's own Dan Haley. Guys, coming up, we're going to break down some of the breaking housing data as consumers question a housing market slowdown. It's coming up next. Welcome back to Yahoo Finance Live, everyone. We've struck the top of the 10 a.m. hour. I'm Brad Smith with Julie Hyman. Brian Sazia is on assignment, and we're going to take a quick look here at the markets as we are about 32 minutes into trading right now. The Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite, all on this Fed day, are higher by about 0.6% for the Dow and the S&P 500, 0.4% for the Nasdaq Composite. We've also got some breaking news on the housing front. For that, I'll toss things on over to Julie.
Yeah, existing home sales here is falling for the 7th straight month. This is the August figure. However, they're not down as much as estimated, down by 0.4%. The annualized pace now 4.8 million. It's still the weakest since May of 2020, but it's not as bad as the 4.7 million that had been anticipated. Of course, we all know what's going on with the housing prices. What is going on with the housing market? What's putting pressure there? It's that we are seeing an increase in mortgage rates which hit above 6% for the first time in more than a decade. That is definitely affecting affordability and affecting the ability of people to buy homes right now. So again, we saw a decline of 0.4% month over month in existing home sales. By the way, that figure is 17.4%, a dip of 17.4% if you look at the year over year figure. So all of this interesting as we look at the housing market and how it feeds into the broader economy. Let's talk about that now. Joining us to discuss is First American's Deputy Chief Economist, Odetta Kushi. Good to see you, Odetta, as we look at these numbers. Interesting that we didn't see more of a drop, but just sort of high level, how would you describe the state of the housing market right now?
Well, it's great to be here. So there's a demand and a supply side to this story. Clearly on the demand side, buyers have pulled back from the market as affordability has quickly deteriorated and mortgage rates have hit above 6%. On the supply side, you can't buy what's not for sale, and sellers are sitting tight right now because they're locked into these historically low mortgage rates and they don't have a financial incentive to move. And so we're finding that sellers aren't selling, buyers have pulled back, and that's resulting in a housing market that's cooling quite a bit.
And on the other side here, I mean, I guess holistically, I should say, you've got home buyers or prospective home buyers who are still looking for where they could find inventory, where they can find a home that they can compete with on an offer. And if they're not able to do so, that they're staying in the rental space. Redfin actually had just reported asking rents climbing 11% in August. And even though that is the smallest gain in a year, it still does go to show that you've got some prospective home buyers that are still impacting the rental market and the renters out there that are still having to take on the burden of some of the higher prices.
Right. So renters have a tough decision. If they're interested in buying, affordability is down. And to your point, inventory, particularly at that starter home price range, is still incredibly limited. We're still facing historically low levels of inventory in a housing market that's underbuilt. And so they're facing higher rents and higher home prices, reduced affordability as well. So they're certainly in a tough spot. We are seeing rent growth start to decelerate. Similarly, house price growth is decelerating as well. So that's some welcome news for those potential home buyers.
You know, like so many other things that we saw during the pandemic, Odetta, it feels like that this is a rebalancing to a more quote unquote normal level, perhaps. But I don't know what normal looks like anymore. How long do you think this process is going to last? And to you, what does a normal, what does a normal median home price look like? What does a normal existing home sales pace look like?
It's a great question. So, double-digit annual house price growth is not sustainable. So the market of the last 2 years is the exception, not the rule. It was an incredibly hot seller's market. You could argue we're still in a seller's market across many top markets across the country, certainly not as competitive as it was early in the year or last year, but still very much in a seller's market. I think you'll start to see house price deceleration to more reasonable pace. Historically, it's been about 4 to 5%. Mortgage rates are actually, believe it or not, right in line with historical average, if not a little bit below. So the housing market just needs to adjust to this not so new normal of higher mortgage rates, slightly slower sales pace, and more moderate house price growth.
And so for the prices that even new homeowners are looking at or trying to get into right now, I guess I think, and I'm kind of thinking on my own personal level here a little bit, but even for those of us who are just looking to get into their first home, this could have a much larger implication on households' ability to build equity and build wealth over time too. Even if they are priced out of the housing or buying opportunity right now, do you have a sense of what that implication could look like more long term?
So there's still this fundamental demand for home buying in the United States. There's this massive generation of millennials that continues to age into their prime home buying years, and they are buying later in life compared to their generational predecessors. So it's really a question of when, not if. These home buyers are currently, or potential home buyers are sitting on the sidelines right now, waiting for the market to adjust, waiting for prices to rebalance to a point where their monthly payment is affordable. And when that time comes, they'll jump back into the market. So maybe delayed wealth building, but certainly not foregone.
All right.
Odetta, good to see you. Thanks so much. Odetta Koshy, First American's Deputy Chief Economist.
Thank you.
All right, let's talk more about what's happening in the markets right now. Yahoo Finance's Inez Ferez over at the Wi-Fi Interactive watching the action today. What's going on?
Yeah, Julie, and stocks are drifting higher. Of course, we do expect to see more fireworks today at 2:30 after Jerome Powell speaks, and also sometimes the day after Fed Day is where you see a lot of fireworks. But right now we're looking at the Dow that's up about 0.5%. You've got the Nasdaq Composite that's higher and the S&P 500 of about 0.6%. You've got Treasury yields which have paused the recent rally, so this is helping equities. So you're looking at the 10-year Treasury at 3.53, down about 4 basis points. Also, the U.S. dollar index is at multi-decade highs, so this is putting a cap on how high equities are going. Because remember, we have seen recently that correlation where when the dollar goes higher, you're seeing equities go lower. But today, a little bit of a different picture because you're looking at industrials, which are higher, and that's because of defense stocks. Those are higher. I'll get to that in just a second. But look at that. Industrials is the leader right now, followed by real estate, consumer staples. You've got energy that's in the green as well. The energy had seen bigger gains earlier this morning, paring back some of those gains. Getting to where we're at with defense stocks, this has to do with the headline about Russia escalating the war in Ukraine. So we are watching defense stocks going higher, and I'm just going to pull up the chart here so you can see some of these gains. Lockheed Martin up more than 2%. You've got Northrop Grumman up also 3%, and also as well as General Dynamics, Raytheon. You get the idea. I'm going to pull up, though, a year-to-date chart because you can see some of the year-to-date gains for these stocks, guys.
Yahoo Finance's own Inez Ferez, a ton to continue to track on the defensive space as well here. Appreciate the breakdown this morning. Guys, coming up, we're going to speak with one analyst that says the Fed has to respond to the upside surprise in inflation. That's coming up next.
Let's get down to business now. A look at the stories in business and beyond you need to know about today. Cable company Charter has been ordered to pay $1.15 billion to the family of a murder victim who was stabbed to death by a cable technician. Now, that technician reportedly made a routine house call to the victim, then returned to the house the next day dressed in uniform, driving the company van to steal credit cards. The victim was stabbed after she caught that technician. The victim's family says Charter tried to use forged documents to force the claim into private arbitration rather than court, and also alleged they were negligent in checking the technician's background. In a statement to Reuters, Charter maintains it was not liable for the incident since the employee was off duty when he murdered the victim. Employees at a Philadelphia Home Depot are taking the first official steps to unionization. This after a National Labor Relations Board filing on Monday that included 274 employees in merchandising, operations, and other roles. Previously, a Home Depot location in San Diego saw 60 employees unionized, but that was back in 2019. The most recent action in Philadelphia comes as a wave of unionization grows across the U.S., hitting large corporations like Starbucks, Chipotle, Apple, and others. And Italy is taking Eataly on an expanded world tour. The Italian food-focused grocery retailer and importer is selling a controlling stake to Invest Industrial. That's a European private equity firm known for helping businesses expand overseas. It also has stakes in things like Ducati. The deal increases Eataly's capital to about $198 million and will see Invest Industrial take a 52% stake in Eataly. The grocery chain currently has locations in the U.S., UAE, Japan, and Brazil, as well as Italy itself. Brad?
Consumer take, they have great prosciutto there, Julie. Well, we're continuing to watch markets ahead of the Fed, with markets holding on to some gains here this morning for the U.S. major averages. The U.S. Fed isn't the only central bank on our radar, with most around the world actually raising rates. Sweden's Riksbank, most recently hiking its own rates to keep up with the ECB. All of this as the U.S. dollar remains strong. For a global view, let's bring in Krishna Guha, who is the Evercore ISI Vice Chairman, Head of Global Policy and Central Bank Strategy. Thanks so much for joining us here this morning. First, going into this meeting, your expectations, and will the U.S. Federal Reserve and the FOMC committee, will they be kind of in lockstep, do you believe, in terms of their aggressive nature, perhaps, with the rest of the world?
So it's great to be with you. Thank you for the invitation. Look, all the major central banks in the world, outside China and Japan, where there's some special considerations there, all the others are jacking up rates aggressively. Fundamentally because everyone is grappling with some version of a serious inflation problem. And the detail of that differs from one country to the next. So does the tactics and strategy that the central bank is using. But the trend to rates are moving quickly higher and then prospectively staying there for longer, that is certainly a global trend. And we fully expect the Fed's going to be taking its further step in that journey today.
And so how many steps is it going to take, I guess, Krishna, in the case of the Federal Reserve? The debate now seems to have moved from what are they doing at this meeting with the broad expectation at 75 to where will they end? What will the terminal rate be? Because we've really seen expectations move up.
Yeah, that's exactly right. So what I've said is that the Fed absolutely has to respond to the latest inflation news, which is really bad. Along with evidence that there is more momentum, more resiliency, particularly in the labor market, to some degree in spending as well, than might have been anticipated by this stage. So the Fed has to do more on rates, but I think it does get to choose how it does more. And I certainly think and have argued strongly that hiking by 100 basis points rather than 75 at this meeting is probably not the best solution here. What we expect them to do is indeed to signal that the path of rates from here is going to go higher and stay there for longer. So, you know that interest rate dot plot that they publish 4 times a year? We get another one of those today. I think that will show rates going to 4 and change the end of this year and point to rates, knocking on 4.5% next year. I think the message will also be that rate cuts are a long, long way out. No rate cuts next year, only moderate rate cuts in 24 and 25. Why? Because they expect inflation to be coming down, but will be coming down only gradually over those years ahead.
given that you track the global picture here too, I mean, this comes up at least, every day, I should say, within this conversation too, is not just what's in the Fed's control, but also what's out of the Fed's control. And what's out of the Fed's control is things like energy prices, is things like the supply chain, and that supply chain being a global supply chain, even though there are efforts right now to bring more of that domestically here in the U.S., in the near term, that's still going to be a very global part of the equation that the Fed does not have control over. Is there any signs that is improving from your perspective?
So first of all, you're exactly right to say that this is a particularly difficult situation for the Fed, as for most of the other central banks, because a lot of the shocks that are hitting the economy are on the supply side rather than the demand side first. And secondly, that a lot of those supply shocks are global in nature. They relate to the pandemic, or they relate to Russian war in Ukraine, or other factors. And so they aren't the sort of things that central banks are used to dealing with, or particularly good at forecasting. So that certainly makes it an additionally difficult time. Now, the right approach for the Fed to take in this environment is to say, on the one hand, look, we don't control where the gasoline price will be next week, next month. If Vladimir Putin decides as part of his energy war, he's going to, for instance, cut Russian oil production to try to generate an oil price spike. There's not a lot the Fed can do about that directly, and it's a massive but, on a 2 to 3 year type horizon and beyond, the Fed owns inflation in the US, period. And the Fed has the instruments, has the capacity, needs only the will to actually use those instruments in order to return inflation to an acceptable trajectory on a 2 to 3 year horizon. So that's the balance here to strike. We don't control inflation on a month-by-month basis. They do control inflation on a 2-3+ year horizon. That's the message that we will, I think, want to need to hear from.
It's interesting that you talk about that 2 to 3 year time horizon, because Elon Musk, of all people, was tweeting about the Fed the other day and talked about the problem with the Fed is its latency, is the fact that it takes its policies quite a long time to take effect and start to have more of an effect on inflation. And there have been folks who have argued for that reason, the Fed should wait. The Fed shouldn't be as aggressive because some of these issues will sort of take care of themselves without the Fed's help. How do you view that argument?
So I'd say a couple things there. First of all, I think the Fed has no choice but to err in the direction of doing a bit too much, because the cost of allowing a high and variable inflation to become embedded in the U.S. economy is greater significantly than the cost of causing a recession or trying to cause a recession. But if you had to pick, you would pick a recession over a return to the 1970s. But, and it's a very important but, the second point is that I think they still do have a responsibility to choose a strategy that gives them the maximum possible chance of restoring price stability without causing a recession that might not have been necessary. And I do worry that if they carry on moving in these big 75 basis point type increments, they risk outrunning the time lags with which their policy choices affect the economy. They risk outrunning, therefore, their ability to learn from the data, and the risk that they do make a policy mistake that causes a recession rises substantially from here if they can't find a way of getting off the hamster wheel of 75 basis point increases.
Some of the most bullish banks on Wall Street, they've shifted their tenor from it being a Fed pivot to it being, they could pull off a soft landing. Do you believe that there is credibility to the likelihood of a high probability likelihood of a soft landing, or should we be expecting something different?
So first of all, I think it's important to distinguish between is a soft landing possible and separately is a soft landing probable. So there are some very eminent economists who I respect greatly who would argue that at this point a soft landing is close to impossible. I don't agree. I think there's a lot that's unique about this pandemic business cycle. There are many factors that have driven prices higher. Some of them do represent classic imbalance of demand and supply. Others look like they are indeed one-time factors that will dissipate, fade away of their own accord on some horizon. So I think it is possible that we will be able to restore, price stability, restore an inflation rate closer to 2%, without necessarily having to have a full-blown recession. Second question is, how probable is that? And I think the probability moves up and down as we get new information coming in. I've sort of felt most of the year that probability is moving between 60-40 one way and 40-60 the other. I will say right now I'm feeling a bit less optimistic on the prospects of soft landing rather than more. That's really because this latest inflation data puts a bit of a gun to the Fed's head. It suggests that some indeed greater likelihood that we just can't fix this without a recession. But over and above that, it increases the risk that the Fed ends up oversteering, causing a recession that might or might not have been inevitable. So that landing zone, if you like, for that soft landing, it's looking quite narrow right now.
Yes, ever narrower it feels like. Krishna, thank you so much. Krishna Guha, great to get your perspective as always. Evercore ISI Vice Chairman and Head of Global Policy and Central Bank Strategy there. Well, we're going to take a quick break. When we come back, 7 bank CEOs are facing questions from the House of Representatives on the state of the economy and impact of inflation. We'll have the latest from that hearing next. Jamie Dimon, Jane Fraser, and other bank CEOs currently on Capitol Hill for their annual grilling by lawmakers. It's funny that's happening the same day as FOMC Day. On deck for today, discussions on the economy, consumer protection, fossil fuels, firearms, and more. Yahoo Finance's Alexandra Semenova is watching closely. I don't think it usually happens on the same day.
Yeah, I mean, today's hearing certainly fell into the shadow a bit with all eyes on the Fed, but this is still a big event with the leaders of some of the biggest banks in the U.S. set to be grilled by congressional leaders. Now, typically the purpose of these testimonies is to discuss topics like consumer protection, compliance, racial inequality, and those things will certainly be addressed, but given the macroeconomic backdrop, it is inevitable that we'll be getting a lot of remarks on the economy and on inflation. Now, the hearings are getting underway right now, but the testimonies are pre-written, and I read through some of them. Based on those notes, Jamie Dimon is slated to discuss conflicting trends in the economy and make his usual storm warning. He's going to talk about the irony of strong consumer spending and a robust labor market against the backdrop of historic inflation, quantitative tightening, and the war in Ukraine. And, he's going to mention strong consumer balance sheets and how these are headwinds while the economy is also facing many tailwinds. Citibank CEO Jane Fraser will also echo that tune on the economy. She's going to call today's conditions no less daunting than the start of the pandemic. And then also on the regulatory front, Diamond will complain about higher capital requirements for banks. That is the amount, of course, of liquid capital that financial institutions are required to hold to ensure that they don't have too many investments and risk default. And Wells Fargo CEO Charlie Scharf is set to ask Congress for patience as Wells Fargo works to meet their regulatory expectations.
Now, on the topic of bank compliance, Morgan Stanley, they had a bit of a snafu protecting its customers. What happened there?
Yeah, a bit interesting that the timing of this. Morgan Stanley CEO James Gorman will actually not be at the hearings today, but yesterday Morgan Stanley agreed to pay a $35 million fine to the SEC after the bank allegedly failed to keep personal information from millions of customers safe. According to the SEC, Morgan Stanley improperly disposed of devices containing sensitive information and repeatedly hired moving and storage companies that did not know how to properly dispose of this information. And they just paid the fine. They did not resist it.
Wow. Yahoo Finance's own Alexandra Semenova, thanks for tracking, of course, the hearings taking place as well as
we'll be listening to those all day.
In the sector. Definitely. Appreciate it.
Thanks, guys.
And everyone, coming up, fitness brands are running up that hill to reach pre-pandemic levels. We'll speak to the CEO of Barry's on the state of their recovery. It's next. Oh, you got excited, Alexandra. Workout brands, some of them face an uphill battle following COVID-19. They're looking to recover to pre-pandemic attendance levels. One brand in particular, though, is looking to expand its focus from the treadmill to the bike with the launch of Barry's Ride. Barry's global CEO, Joey Gonzalez, joins us now in studio. Joey, great to see you live in living color in person here. Okay, there's been so much of the strategy that we've been watching play out. And in fact, many of our team members too. We have either by ourselves or as a team tried out berries too, just to get our workouts back in order here. So as people are going back in person to these experiences, what have you seen in comparison to pre-pandemic times and how berries is trying to recover?
So in terms of our recovery, we sort of benchmark success as pre-COVID attendance. Very excited to say that as of last month, we are at 120% total attendance across the country. We're trailing a little bit around 90 to 95% for same stores. But just to give you an idea of how steep that curve was, as of March, April, so 5 months ago, we were at 60.
Wow.
So it's been a tremendous amount of growth in a very short amount of time. We owe a lot of that to so many wonderful new clients trying berries for the first time. We've had over 500,000 people across the world try berries. And it has been interesting to see some of our, older clients coming back to, reintroducing berries to them and them sort of like ramping back into this workout after what they've been doing at home. That has definitely been fun to watch.
As someone who tried it before and who tried it now, yes, there is definitely the journey, the post-pandemic journey here. I'm curious also about instructors. I mean, when you talk about anything from berries to Peloton to any of the sort of marquee fitness brands out there, the trainers are very important. Have you had a harder time finding people? Are there people who, during the pandemic, said they wanted to do another profession entirely, for example?
Yeah, I mean, first of all, you're absolutely right. And I'm a trainer. That's how I grew up through the Berries family. And we really prioritize our talent. They're essentially our product. And they build the relationships with all of our clients. So throughout the pandemic, we raised money twice to make sure that we could keep all of our full-time instructors employed the entire 2 to 2.5 years. So luckily, we retained a lot of our top talent.
Are you paying them more now than you were before, just out of curiosity, pre-pandemic?
Yes, we've had some comp adjustments all throughout, but we've ended up now with a compensation structure that's meant to compensate instructors more than what they were making in 2019.
Talk about
And by the way, sorry, just one other thing. We did have a lot of instructors sort of go and do their own thing during the pandemic, and the majority of them, I'd say around 50 to 60%, have since tried to come back, some successfully and some not.
And it's also the type of instructor that you're bringing in too now, especially when you think about the expansion in something like Barry's Ride, and how you listen to customers who perhaps have had experiences with some of your competitors out there and have wanted to be on a cycle, but also want to increase their strength training perhaps too, in tandem. What went into that kind of decision and expansion, and what does that rollout look like, especially as you're kind of bringing in this new facet into the Barry's experience?
Yeah, I'm glad you asked, because I'm so excited to talk about Ride. I'm a CEO founder, so very entrepreneurial. So innovating, which is one of our core values, is my favorite thing to do. And we have been expanding this Barry's original concept for 2 decades now. And we continued through COVID, opening new markets. Austin, Denver, we did infill in New York, in Chicago, in LA. We opened Frankfurt, Berlin, Copenhagen. And now the second phase of our development out of COVID is actually introducing a new modality called Ride Lift, which replaces the treadmills with the bikes.
After a period where a lot of people have been on bikes, stationary bikes in their homes, doing some of those home workouts at Peloton or some of the other connected devices.
And some people have asked, well, was that what inspired us? But my plans for Chelsea back in 2010, my architectural renderings actually always had Ride in them. So this has been over a decade in the making. I always wanted a concept that was maybe more approachable and cast a wider net for new clients. And we tested it right in about February to March of 2020, really good timing, and had to shut it down because of the pandemic. But we did notice anecdotally a lot of people who said to us, I was so afraid to try berries, and now I actually feel more comfortable because there's something about that bike that helps people come in over the treadmill.
It's interesting that you bring up accessibility, because I think berries can be a little intimidating, if I'm honest. And not only that, the price point also, especially in this time where there's a lot of demand on their wallets, right, for basics. And then you look at a $38 price point, at least here in New York. That's a lot for a 50-minute workout.
It is. And berries, isn't for everyone. Even though our mission statement is to transform lives worldwide, we understand the size of berries is still only at 85 studios compared to some of our competitors that are in the thousands around the world. So we understand that it's a specific client. We also understand that what we're offering, I think, is a really compelling experience. Not only are you getting the best workout in the world with efficacy at the core, you're also getting liquid gold to wash your hair with Orbe hair care products and Dyson hair blades and a much more beautiful build out in locker rooms and showers. So it's definitely a more premium experience. And for people that don't feel like there's value there are plenty of alternatives.
There are some publicly traded, of course, companies within this space, whether they be kind of the in real life, the IRL fitness experience of a Planet Fitness, where people are kind of just taking it upon themselves, or an F45 that we just saw go public via SPAC last year, and unfortunately get kind of caught up within that SPAC craze. And with all of that in mind, what does that even look like for a company like Barry's too in the future? Is that something that you think about, and how do you retain the culture of the company too, as you even evaluate what that may look like going public?
So first, not really something we've been entertaining. Have an incredible relationship with my private equity team, and was grateful over the past 2.5 years that I had their support through many, many difficult decisions. I'm just happy that we haven't been beholden to shareholders to make those decisions, and have no immediate, goals to go public for Barry's.
All right, Joey, thanks for coming in.
Thank you. I'll see you in class.
Yes, definitely. I know. Now I'm going to have to look on the schedule and see when you're teaching. That's the next goal.
We'll let you know, and we'll send all of you free classes.
Oh,
your
well,
staff.
That's very nice of you. CEO Joey Gonzalez of Barry's Global. Appreciate it. Coming up, Brian Sozzi. He's going to join us live from Dreamforce in San Francisco with the Chief Product Officer of Salesforce. You don't want to miss that.
Welcome back to Yahoo Finance Live. I'm Brian Sozzi at Dreamforce in San Francisco. Salesforce's big, giant annual conference back in person. Joining us now is David Schmeier, Chief Product Officer at Salesforce. David, good to see you here. This is a festival of software.
Brian, it's great to be here. Thanks for having me. This is the world's largest technology conference, so it's exciting.
How important is it to you and your teams that an event like this is back in person? What do you get from it?
This is a family reunion, so we have 150,000 people registered. It's sold out, so it is. Our customers and partners and our employees are loving being here live. There's nothing that replaces that live energy.
Well, you're not just here drinking the coffee and walking around seeing all the festivities. You're talking to clients. You're meeting with customers in this environment, tough economy, tough stock market. What do they need from your team?
At Dreamforce, we launched the industry's first real-time CRM. And I couldn't be more excited. I've been working in this industry for 30 years, and this is groundbreaking stuff that we're doing here, Brian. It's a game changer. Our customers and our partners, everybody's talking about our new data platform, Genie.
Take us through that. What it's all about.
Genie allows you to handle the explosion of data. So maybe I'm in the car. We showed the Ford Lightning 150 yesterday. The check engine light comes on, and you have to...
I hate that, David.
Don't you hate that?
Hate that.
It's the worst customer experience of all. So you got to schedule an appointment, you got to bring it in, you got to take time out of work. Now with Genie, it's a real-time data engine. So in the car, the manufacturer, in this case Ford, they automatically know what the problem is. They can solve it in real time, dialing into the car with the connected car experience. And so Genie really provides automagic, or what we call customer magic, by solving the problems in real time. And another great example is in the healthcare industry. Maybe I have a pre-existing condition like asthma, and I go into the ER and they take my vitals, my blood, my temperature, all those, the test work. Minutes and milliseconds matter. So the data from 4 days ago, that's not good enough. You need real time because patients' lives are at hand.
You mentioned there's been an explosion of data. Do you think companies have just become paralyzed because there's so much data coming at them and they don't know what to do with it?
Brian, that's exactly the problem we're solving, which is, simply put, companies can't keep up with this explosion of data. And Genie and this real-time CRM technology, it allows them to keep up for the first time ever. It's truly what I call the holy grail of CRM.
What is the next era of CRM? And CRM is what? Customer relationship management?
That's correct.
You're seen as the OG in this industry. You've been doing this for a while. Like you reminded me before we came on set. What does that next era, what does that next decade look like for your business?
Sure. I've been working in the industry since the early 90s. It was a $50 million market when I started. Now Gartner and other analysts estimate it's over $60 billion as a software market. And this real-time motion is really changing the game to be real-time, automated, and intelligent. So our automation technology, Flow, saves our customers 100 billion hours a month. Our AI technology called Einstein does 175 billion predictions every day. So today, we're doing 175 billion predictions. And so what we believe is the companies with the best data and the best AI win, because that translates into a better customer experience. And as you know, at Salesforce, we're the #1 company that helps companies connect with their customers in entirely new ways. So the future are going to have these amazing, what we're calling magical customer experiences. And from your life, you know, how many magical customer experiences do you have every day, Brian?
Not a lot. You know, I would say everything is magical on the Yahoo Finance platform. I just don't want my check engine light on. So if you could stop those things, that'd be great. But take us through hiring for your teams. What you're doing is incredibly technical. There is a war for talent still in Silicon Valley. What are you looking for? And are you still having problems finding the talent you need?
Sure, it's a great question. Great software teams build great software. We're lucky that Salesforce is recognized every single year as one of the top employers in not just the tech industry, but in all industries. Credits to our founders creating a great culture. I think it's very different. I've worked in a lot of other tech companies. Salesforce is truly unique. So those 5 core values that Mark and Brett talked about yesterday, we truly live them. Trust, and equality, and innovation, and customer success, and now sustainability. So we're truly a values-driven company, and I think that really separates us from, I'd say, virtually every other big tech company.
Of course, sustainability, near and dear to Mark Benioff's heart, and it is embedded inside the company. How do you embed that into software?
Sure, so our Net Zero Cloud is really a fascinating story. We built it for ourselves because we're the first Fortune 100 company to become net zero, and our customers asked us, hey, that's amazing, can we buy that? Can we use that too? So we productized that, and now we've come out with the 2nd or 3rd generation, and here at Dreamforce yesterday, Mark launched the Net Zero Marketplace, so now you can trade carbon credits, and you can engage in sequestration projects, and you can really sort of buy and sell different capabilities to help you become a net zero company. So companies like MasterCard, JetBlue, and others are now using Net Zero Cloud to become net zero.
Last one before I let you go. One of the biggest questions we've gotten from investors on Salesforce, the team has made a lot of acquisitions in recent years. This might be the first event where it seems like everything has been unified. Is that fair to say?
We are certainly coming together around what we call the Customer 360, which is our portfolio of products. And so with Slack is our latest large acquisition. And we were talking earlier, you know the founder, Stuart, very well. It's an amazing team, an amazing product. And we announced some incredible innovations for Slack. And Slack really helps us tie together the Customer 360 in what we call the Slack First Customer 360. So Slack really delivers this new way of working in this hybrid world that we live in.
We're going to leave it there. I have to check my 97 Slack messages I probably now have after this interview. David Schmeier, Chief Product Officer at Salesforce. Good to see you. Enjoy the event.
Thank you for having me.
And we'll be right back. More markets coverage on Yahoo Finance Live. Do not go anywhere.
Welcome back, everyone. It is time for Cut for Time. 3 stories, 1 minute each. Let's start with this today. Walmart announced it's going to hire 40,000 seasonal workers for this year's holiday season, a sizable decrease from the 150,000 that it hired in 2021. This plan's coming after the retail giant warned of a smaller annual profit and as it navigates a slowing economy. You're seeing shares of Walmart WMT up higher on the day by about 1.9%. It is notable, the decrease year over year there for certain, and that directly correlated to perhaps some of the wage increases that have taken place from this year versus last year. But then additionally, the number of customers that they're going to continue to interface with, I think that's notable because Walmart, of course, does have the grocery category that gets most customers in stores, but then it's also, during the holiday season, the ability to deliver on so many of the e-commerce orders that they see come through as well.
Yeah, so it's a little confusing here that we're seeing this. So are they going to see that much of a decrease in demand that was different from last year? I mean, the other question is Walmart for many years was sort of plagued by the idea that if you went into a store, it was tough to find a salesperson if you did need help. So you wonder, are we going to see the return of those types of complaints, and is that going to have an effect on sales? But this is really dramatic that it's only 40,000 instead of 150,000. Speaking of job news, although this on the other side, Gap is cutting about 500 corporate jobs as the retailer continues to struggle with declining sales. Those cuts mainly in Gap's San Francisco, New York, and Asia offices across a range of departments. And the move comes after the company ended its partnership with Kanye West last week, and as it continues to look for a new permanent CEO. Bob Martin filling that role on an interim basis. But it also comes as the company has really struggled to maintain any kind of sales increases here in this environment. Old Navy, which had been the strong brand within the portfolio, has been also not doing great.
Yeah, this is significant, and it'll be interesting in terms of the different categories that they look across, or the different job functions specifically within Gap, given all of those subsidiaries that they do have, and where that restructuring perhaps even in the future, that thought and that frame of mind may kind of persist and take place, looking at some of the brands that have been doing well. Banana Republic, sure, yeah, had a good past 2 quarters, but even going forward from now, I think so much of the fanfare has still been around, okay, Athleta, what are you going to do to really beef up that brand? And then on the other side, how are you going to get Old Navy back into good graces with consumers? Yep. And that is where the strategic approach should be lying for a company in Gap, too. Also here, Beyond Meat. We got to give you an update there. Beyond Meat has suspended its chief operating officer, Doug Ramsey. This is after he was arrested over the weekend for allegedly biting someone's nose after a football game at the University of Arkansas. The police report also noted that Ramsey allegedly punched through a back windshield of another vehicle during a fit of rage. So Beyond Meat shares perhaps a little bit of relief in the day, but at the same time, we're seeing broader markets move higher, more specifically as related to the action that Beyond Meat has taken here. It is noteworthy because perhaps it just gets the CEO story, or alleviates Beyond Meat from the COO story that has certainly been swirling around the brand at a time where they're just trying to make sure that the customers know about what they're trying to introduce going into the holiday season, where some of those functions could be taking place that they could capitalize on.
I mean, this stock is down 74% year to date. So really the sort of daily move to the up or the downside, or the sideshow of a story like this, which no company wants to have to deal with a COO who's been arrested, let alone for something like this. But really the problem is there's increasing competition in this marketplace from the likes of Impossible, but also a lot of stores are coming out with their own brands and their own versions of plant-based meat. Even as it gets more popular, it is getting more competitive, and it's getting more expensive for Beyond Meat to source and make this stuff.
Innovation.
So all of that is an issue. Yes, I guess so. All right, let's take a look at the markets here before we leave you. And as we are seeing a little bit of lift here, but definitely just a waiting game that the markets are now playing, market participants are now playing because, they want to see what we're going to hear from the Fed here this afternoon, and whether there's going to be longer term any kind of direction for what we're going to hear. It's always difficult to predict how the market is going to interpret what is going on from the Fed, what the Fed says. Yeah, absolutely. And keeping a close eye on some of the sectors that have been most heavily impacted and that are going to be holding on to anything that the Fed says about their future policy decision. Keep a close eye on tech. And you did an excellent breakdown of this in one of the most recent morning briefs, really looking at the correlation between the tech sector and any of the Fed's policy pathway. So that's one sector to keep in mind. Also keeping an eye on some of the trending tickers that we're seeing over the course of today going into this announcement. XPong is actually in one of the trending tickers moving lower here on the day by about 9.5%. But then on the other side, you've seen some of the players that we've been talking about earlier. Micron, Lockheed Martin also in play. Our own Ines Ferre was breaking that down earlier on during our show too. Yeah, and General Mills up 7% also on that list. Coming up next, Akiko Fujita and Ines Ferre are going to speak to the Chief Sustainability Officer at GM on its road to reach net zero. You don't want to miss that during this Climate Week, an important conversation.
Welcome to Yahoo Finance Live. I'm Akiko Fujita.
And I'm Ines Ferre. Let's take a look at how stocks are trading this morning. We're looking at the major averages, which are higher. You're looking at the Dow, that's up about 0.5%. The Nasdaq up about 0.2%. The S&P 500 up about 0.5%. Treasury yields pausing their recent rally. So you're watching right now the 5-year Treasury note up just slightly, but the 10-year note at 3.55%. The 30-year up at 3.57%. Here's what we're watching today. It's all about the Fed today. As investors awaited an expected 75 basis point rate hike and projections for the federal funds terminal rate, also known as the dot plot. Let's bring in Yahoo Finance's Jennifer Schonberger, joining us live from Washington, D.C. with an appropriate background there, Jen.
Hey there, good morning. That's right, I am here live from the Federal Reserve in Washington, and Fed policymakers are meeting right now in this building behind me, and they are set to announce another supersized rate hike when that meeting concludes at 2 p.m. this afternoon. Investors mostly expect the Fed to raise by 75 basis points, though they were pricing in an 18% chance as of this morning that they could go by a full percentage point, according to the CME Group. In the face of the highest inflation in 40 years, if the Fed were to raise by 75 basis points, that would bring the Fed funds rate to a new range of 3 to 3.25%. That would be up from the current range of 2.25 to 2.5. Another 75 basis point rate hike would mark the third in a row since June and would be unprecedented since the Fed started explicitly targeting the Fed funds rate as their monetary policy target since the late 1980s. Now, the Fed likely to signal that they will raise interest rates more aggressively and expects rates to be higher for longer when they release their individual interest rate projections, known as that so-called dot plot. Investors are expecting the Fed to project that they will raise the Fed funds rate over 4% by the end of this year, according to the CME Group. However, how long and how quickly they get there and how high they hold the Fed funds rate at those levels remains uncertain. Officials also expected to release new projections for inflation, unemployment, and GDP, which will give us a window into their thinking onto why they're setting monetary policy the way they are, and perhaps how tight monetary policy may be impacting the economy going forward. We'll hear more from Fed Chair Powell when he has his press conference at 2:30 this afternoon. Guys?
Yeah, Jen, in many ways, that's really going to be the key, right? What we hear from Jay Powell in that press conference. The last time we heard from him at Jackson Hole, it was a pretty strong message, a short one, but to say we are sticking to this, inflation is the number one issue. Are we expecting any shift in tone given the data that we've gotten since then?
Yeah, Akiko, I expect Fed Chair Powell to double down on that exactly. The last time we heard him spoke before the blackout period began ahead of this meeting, the Fed Chair did just that. In fact, invoking former Fed Chair Paul Volcker, who is famous for breaking the back of inflation. And I see no difference in the approach that I expect to hear from the Fed Chair this afternoon.
Okay, I know you'll stay on top of it. We will, of course, have live coverage around all of that. Jen Schonberger live for us from Washington, D.C. And as, of course, we're going to be watching the market reaction. Interesting to see all three majors up today. When you think about the last few Fed decisions, that's kind of been the pattern where we've seen investors kind of run up against an expectations here. You could argue that expectations were really reset on the back of that Jackson Hole message. What investors will be looking for today, 75 basis points, a very, very slight percentage, expecting 100. Be interesting to see what happens if it moves in that direction.
Yeah, that's right. And so we have seen stocks drifting higher, and we tend to see a little bit of that Fed drift that you see during the session on Fed Day. However, we are expecting that 2:30 presser. That's when you really start to see some of the fireworks, really Jay Powell's comments. I mean, the last time we heard him say that the Fed is going to be data dependent going forward and basically ditching forward guidance. So that's really what had set off the markets in subsequent sessions after that. We'll have to also see what happens tomorrow, because we tend to see some fireworks once Jerome Powell starts speaking, and then sometimes the day after as well.
Yeah, and what we've heard from Fed officials, you know, not just Jay Powell, but other officials who've said repeatedly that it's not just about one data set, it's not just about 1 month. They need to see data consistently showing that inflation has started to cool down. You could argue we haven't necessarily seen that yet, especially with that last CPI print, which came in much hotter than expected. But a reminder to our viewers, of course, we'll have that live press conference for you coming up at 2:30 p.m. this afternoon. Another headline that's shaking up the markets today, Russian President Vladimir Putin ordering the partial mobilization of military reservists in the country. Now, the announcement came just one day after Russia-controlled areas of Ukraine announced plans to hold referendums to become a permanent part of Russia. Oil prices initially jumped on the news, but take a look at where they are right now. WTI crude down about 0.6%, Brent crude down about 0.5 percentage point. And of course, we saw that big jump initially, Inez, because this really does add to the jitters that a lot of people have been feeling about where things move from here in terms of what's happening with Russia and Ukraine. Energy, the big question mark, whether in fact Vladimir Putin does sort of weaponize oil and gas, as he increasingly, if you look at the recent moves that we've seen on the battlefield, he's increasingly being pushed into a corner when you think about Ukraine's gains.
Yes, completely. And it's really an economic war in Europe. That's what we have heard so many analysts also talk about. But it's interesting what happened with those oil prices, as you mentioned. We saw that bump initially, and now we've seen oil retreating slightly. Also, the U.S. dollar is at a multi-decade high, so that is putting a lid also on oil prices as well. But look, WTI is trading around $83 a barrel. I've spoken to analysts that are saying that you can expect to see it between a range of around 80 to 100 going forward. This energy crisis is not abating anytime soon.
Yeah, and you know, to sort of hammer home the point about how jittery things are, especially over in Europe, we saw the German government today agree to the nationalization of one of its utility companies, Uniper, a major importer of natural gas, which, by the way, the company already received a bailout earlier this year. Now the German government's essentially buying up almost 100%, about 98% right now. But that points to all the contingency plans, if you will, that are kind of being shored up right now in anticipation of a further squeeze on natural gas for a country that has been very reliant on imports from Russia.
Yes, and different European countries are proposing different measures, and there's been proposals for levies on energy companies, price caps, all sorts of measures to try and tame this energy crisis that's happening right now.
Okay, let's keep the market conversation going with our first guest for the hour. We've got Tony Dwyer, a Canaccord Genuity Chief Market Strategist. Tony, good to talk to you today. The market certainly expectation has moved in the direction of another 75 basis point rate hike from the Fed today. Are we expecting any surprises? And if so, how do you think the market responds?
Well, I'll tell you what, the last time they basically said what was expected, and it ended up with a surprise anyway. Honestly, if you gave me if you gave me the news right now, I'm not sure how to trade it. It's not oversold enough to say that, everything on a negative side is discounted, but clearly they're still raising rates, and that's not a great news item for the economy either.
Tony, Ines here, and one could argue that the Fed wants asset prices to come down, all sorts of assets, including the stock market as well. And it has been a relatively orderly decline, if you think about it. Right now, we're looking at the S&P that's down year to date about 18%. But investors want to know, are the markets going lower? If the Fed continues on this path, 75 basis points, let's say today, then another rate hike in November and December, then are we going to see further declines? And if so, by how much?
Well, Ines, I think it's a really important point. A month ago, after the summer rally, when people were saying that the market is likely discounted a recession, I thought that there was no way that was true. So you fast forward and, you take, for example, Federal Express, which was down about 36% from its peak in 2021 into their pre-announcement, and then it gapped down another 25%. U.S. Steel, Aluminum Company of America, Nucor, all these companies have pre-announced difficult earnings going forward in a difficult environment. So now you're beginning to price it in. So I think it's going to be a lot more average stock based, but I also can't find a time to answer the question directly. I can't find a time where the market made quote unquote the low while the Fed was still raising rates pretty aggressively.
So how do you play the market right now? Do you buy into it, or do you kind of put things on hold, especially with the big question mark about where inflation moves from here?
Well, Kiko, what I've been doing this year is I've been standing aside. I don't think it's a great time. At this point, you're down 20% from peak without a knowledge of what the recession is going to actually look like. So the idea that now you should get negative, I think, is a mistake. Or now you should get excessively defensive, I think, is a mistake. That trade has already been put on, and the valuations of the defensive areas and the outperformance has already been pretty extreme. So what you want, to me, what I'm doing is for the more active traders, what I've been saying, I'd like to be light and tight, meaning I'd like to be as hugging the benchmark where I can without a lot of excess exposure. And on the long only, the longer duration investors, it's just hugging the benchmark until you can actually look to get more aggressive. So our call this year coming into the year was that it was going to be a tumultuous year on a monetary transition in the first half and an economic transition from quote unquote buying stuff to doing stuff. And I think that's played out. Then we got the summer rally, and we've been anticipating what I've called a fall. And I think we're in the midst of that fall, which means what's the next thing? And I think what it's going to be is a more sustainable bounce on the back of a Fed pivot, because the economy, in our view, is going to get pretty nasty, which is the only thing, either a market event or a really tough economy is the only thing that'll make the Fed really pivot.
And that was my next question. When do you see the Fed pivoting? Will it be the markets going lower by X percentage points? Will it be unemployment going higher? What is going to make the Fed cry uncle?
That's a perfect question, Ines. It's unemployment going higher. I think fundamentally, of course, we're looking at inflation. That's been the focus of everybody. But that's also the past focus. I think the most important focus economically now is going to be the unemployment rate. Remember, the Fed has a dual mandate. And unfortunately, they've been in a box all year because it works both work with a lag. But as the unemployment rate goes up, and as you can see in the chart in 2020 that's up on the screen, and also in any prior recession, it goes up very quickly. And nobody's thinking right before it starts to go up, okay, this is going to go up very quickly. They think it'll be a nice moderate move. It's not the way it works. So with the monetary tightening, with the financial conditions tightening, I think the most important thing to look for in the next few months is going to be a higher unemployment rate, which will allow the Fed to pivot.
Okay, some direction there as we wait for that Fed decision at 2 o'clock this afternoon. Tony Dwyer, as always, good to have you on. Canaccord Genuity Chief Market Strategist. Well, time now for our trending ticker. Shares of General Mills getting a big lift this morning after the company topped estimates in its latest quarter. Net sales increased 4%, while organic net sales saw an increase of 10%. General Mills also reporting it's boosting its full year outlook for net sales, operating profit, and EPS growth. This comes as the food manufacturing giant expects volume elasticities to increase over the remaining quarter of fiscal 2023, and that stock now up roughly 7%. Coming up on the other side, pricing in risk. Crude oil whipsaws as Vladimir Putin announces Russia's first military mobilization since World War II. We talk supply and demand dynamics in the face of widespread condemnation. We'll be right back.
Oil prices giving back gains after surging this morning. This after Russian President Vladimir Putin announced a partial military mobilization for the war in Ukraine. Gas prices are also rising, with the U.S. daily average coming in at $3.68 a gallon today, snapping 98 straight days of declines. For more, let's bring in Matt Smith, Kepler co-head of crude analysis. Matt, thanks for joining us. Just when you thought that things couldn't get worse for Europe, how significant is this development when we're talking about the European energy crisis?
Yes, it's very significant. So this is just highlighting the fact that Russia is in this for the long haul. Obviously, as Ukraine have made territorial gains or regaining of land in recent days and weeks there, you have seen this response from Putin. So this is just one more escalation along a series of escalations. We've already seen in terms of Nord Stream pipe flows being cut there. We've got crude sanctions coming through in early December, and now you've got this mobilization of troops as well. So this is going to be supportive for crude prices going forward here. There's just a huge amount of uncertainty, but this doesn't seem like it can end well.
Yeah, Matt, we were talking about this at the top of the show about some of those headlines coming out of Europe today. Germany, number one, nationalizing one of their key utility here because of what they are having to deal with, especially with natural gas and that uncertainty around the Nord Stream pipeline. What does the supply pipeline look like for Europe right now?
Well, pretty good at the moment, Sir Kiko, from the perspective that they've refilled storage as much as they possibly can. That's looking really rather strong here. But there's such unknowns going ahead here into winter. We don't know how harsh it is going to be. There's also been these easing of sanctions on coal as well. So there's this real kind of supply grab that's happening from Europe right now to make sure that it's got the supplies as we head into colder temperatures here. But that's really the question is unknown, just because Europe historically has relied on Russia for sort of 35%, 40% of its needs in terms of natural gas. And so that's the big question mark. How cold is that winter going to be? But the key takeaway just right now, what has been the case already in Europe here, is they are already dealing with extremely high prices here, and they could spiral even higher here if temperatures continue to drop as we head into winter.
And Matt, as you head into winter, I imagine that more diesel will be needed, heating oil will be needed. How does this position U.S. refiners going forward?
Yeah, sure. So it could be a case of musical chairs, and we've seen it in other commodities, and say in terms of fuel, all of that. The U.S. sends the vast majority of its diesel into Latin America right now. We could be seeing that pull to Europe should prices really start to spike in Europe there. But at the same time, too, as well, as sanctions start to kick in, they don't kick in for the clean products until early next year. But we could see that diesel, it's nearly 1 million barrels a day that goes into Europe from Russia, instead trying to find a home elsewhere. So we could see that perhaps going into Latin America. You see the Middle East pushing more into Europe. There are a lot of moving pieces right now, and those will only continue to play out further as we get closer to these sanctions kicking in.
Matt, here in the U.S., on the one hand, we're hearing from the White House, President Biden has said, look, we're going to lend a hand to Europe, especially when it comes to natural gas supplies. Obviously, that's not an overnight fix. At the same time, we're already hearing some warnings from utility companies who are saying those prices, even in the U.S., are going to tick higher come winter. What should American consumers be bracing for?
High prices. So in terms of that natural gas price now, yes, it's nowhere near what they're seeing in Europe, but we're still seeing prices double what they were kind of a year ago. And so that's only going to result in high utility prices here in the US. But at the same time, too, as well, it's the case of in the land of the blind, the one-eyed man is king. And that's the situation for the US. So we have a plethora of domestic production here. We're hitting record production in terms of natural gas. The same on the crude and products front, we're very well supplied on that side of things. But at the same time, too, we are connected to global markets, and global markets are influencing those prices. That happens more on the crude and the product side of the picture. But as the US is becoming, one of the leading exporters in the world, those prices for natural gas in the US are much more tied to international prices, and they're being pulled higher as well.
And finally, Matt, we were talking today about gas prices ending that streak of 98 straight days of declines. We're talking just a penny higher, but should we anticipate those prices to go higher going into year end as well, especially for drivers at the pump?
Sure, Kiko. Well, it's a seasonal thing, and so you see the seasonal trend of gasoline prices at the pump moving lower into the end of the year here. So as long as crude prices remain around these kind of levels, then we should see that gradual decline at the pump there. That said, any swift move higher in the oil price is only going to take gasoline prices at the pump higher with it, unfortunately. So I think we're nowhere out of the woods yet in terms of the price at the pump here.
Matt, always good to get your analysis. Kepler co-head of crude analysis, Matt Smith, joining us there. We want to turn our attention to developing news here in New York City. President Biden addressing the United Nations General Assembly. Now, he has been speaking about the U.S.'s role in the global community, addressing what he's labeled universal challenges, including climate change and food security. He's also touched on the Inflation Reduction Act, calling it a game changer, touting the widespread impact that could have. Of course, and to Matt's point, the president also speaking on what's been playing out between Russia and Ukraine as well. Coming up on the other side, GM puts its money where its mouth is, stumping up the cash for a big clean energy initiative. But what about the goals for its own operations? We're going to hear from an executive leading the drive on the other side. Well, General Motors is moving aggressively with its climate goals, announcing a new partnership with the National Wildlife Foundation. GM will donate $1 million to raise awareness about communities vulnerable to climate change. The move comes as GM races ahead to go all electric by 2035. Joining us now is Kristen Seaman. She's Chief Sustainability Officer at GM here in town for UN Climate Week, and it's good to have you in studio. That partnership and the issue of climate equity is such an important part of addressing all this, because even if we're talking about EVs right now, it is about affordability and accessibility. How does this new partnership allow you to expand beyond the pool of drivers and the pool of those who are addressing climate change right now?
Yeah, absolutely. Thank you. So thanks for having me here today. And this partnership aligns very well with our work around equitable climate action, where we're very focused on making sure that this transition to all electric is all inclusive. And it's very important, as you mentioned, to have affordable products across every price point and segment. And this partnership allows us to really work with the young and the youth, particularly in the K through 12 areas and HBCUs, to really drive education and drive awareness and support to communities that maybe traditionally have been left behind.
Talk to us a little bit about some of the challenges of reaching climate initiatives by certain targets. I mean, you still need fossil in order to mine materials for EVs. How does this all play out when you're talking about these green initiatives?
Yeah, so GM's made some very ambitious goals. We're really proud of our commitment around being carbon neutral in our products and operations by 2040. Our plan to eliminate tailpipe emissions from light-duty vehicles by 2035, and really working along that. We've made great progress towards those very ambitious goals. You mentioned the supply chain, and we have all of the materials for our batteries secured for our commitment for 2025 to have 1 million EV capacity here in North America as well as in China. So really working very closely with our supply chain on sustainable materials, and having that in place is really important.
Yeah, you mentioned that target of being carbon neutral by 2040. With every company, scope 1 and 2, which is your direct emissions, is always the easy part, right?
Mm-hmm.
Scope 3, which is your supply chain, a much bigger challenge. How closely are you working with those partners right now, and how big of a load is that when you consider the investment that's needed to help some of those partners come along for this? Right.
Yeah, so as you mentioned, scope 1 and 2 is the traditional work. For GM, that's less than 2% of our overall carbon footprint. About 84% of our carbon footprint is the customer usage of our vehicles. So that transition to an all-electric future in the portfolio is so important. The next chunk is the supply chain, and we're working really closely with our suppliers. In fact, last year, we issued what we call an ESG pledge with our suppliers, and that's around working with them to make their own commitments around carbon neutral goals, as well as them working on the human rights aspects and the sustainability of their supply chain. And we have great suppliers, we have great relationships, and that pledge is just moving that commitment even closer.
Yeah, on the supplier issue, the president obviously signed in the Inflation Reduction Act. A lot of car makers were vocally opposed to the requirements that are needed to get those EV tax credits in place, because a majority of it would have to be supplied from North America. When you look at what the supply chain looks like for GM, in your estimation, how long would it take for GM cars to be able to qualify for that?
Yeah, I mean, the Inflation Recovery Act has a lot of great points in it, and although it's going to be challenging to make it happen overnight, we're really excited with the support that it provides for our all-electric future. As far as the manufacturing here in the United States, I mean, GM's announced 4 battery cell manufacturing plants. In fact, our facility in Ohio has already started production. And so we're really excited to see the resiliency and the sustainability of really having that and making the country a leader and strong in it.
But as it stands now, the cars would not qualify because of where the parts are sourced from?
No, I mean, we're doing our manufacturing here in the U.S. as well. We've got a number of plants that have already converted, so we're well on our way to meeting those plans.
And what about on the demand side and getting consumers on board to adopt, for example, electric vehicles? I know that GM just announced a deal with Hertz to provide a Hertz with 175,000 EVs. There still needs to be, though, an infrastructure that's set up for charging electric vehicles. The price point needs to come down. Where's the industry on that?
Yeah, I mean, so again, from a General Motors perspective, you know, we're committed to have products across every price point and segment. We have today the very affordable Bolt EV and SUV that, you know, are under $30,000. We just introduced last week or revealed the Chevrolet Equinox, which again is a $30,000, you know, family-sized SUV in the largest segment of vehicles available. So that price point and affordability is extremely important. and really getting everybody access. We talk about infrastructure, and it's one of those you can't wait. You know, when the automobile first came on board, there wasn't a gas station on every corner. So although we can't make this transition alone, GM is really committed to provide, you know, support and be part of the solution for the infrastructure as well. We announced a commitment or a collaboration we have with Pilot and Flying J, which is installing DC fast chargers across the US and really showing that everyone can live in an EV world. And from an equitable standpoint, we're looking too to make sure that infrastructure access is just as important as EV access, and that communities really have that availability across the board.
Finally, on the demand part that Inez talked about, we have seen the demand go up because gas prices have been so high, and yet there's also some more recent data that's come out that, along with the pullback in prices, the interest has waned a bit. We're still at 5% EV adoption in the US. Can that momentum continue even with gas prices lower?
I think so. I mean, products are exciting, and when you see the new products that we're introducing, everything from the Equinox that I mentioned to the Cadillac Lyriq, the Silverado EV, they're amazing products. Once you drive an EV and feel that instant acceleration and the flexibility and convenience that it provides, it's really hard to go back.
Well, we'll be watching.
Right.
Kristen Seaman, Chief Sustainability Officer at GM. Good to have you in studio.
Thank you so much for having me.
Now time for our chart of the day, an evaluation indicator you should check on. This chart from realinvestmentadvice.com shows key levels on the Buffett indicator, named, of course, after the Oracle of Omaha. It shows the ratio of the U.S. stock market's total market cap to domestic GDP. The indicator currently sits at around 2.44 times market cap to GDP, thanks, of course, to the everything rally. Even despite the recent sell-off we have seen, this is still really high historically. To put it into perspective, when the dot-com bubble burst back in 2000, the indicator was at 2.11. I certainly don't want to get to that level.
And coming up, the debt debacle. The Biden administration and Republican opponents look set for a legal showdown over student loan forgiveness. But can anything happen before the midterms? The details next. Stay with us. As Congress fails to rein in big tech, U.S. states have taken the reins in crafting legislation to regulate social media platforms. However, with different states come different opinions, leaving a muddied picture for CEOs of social media companies. With more on this, let's bring in Yahoo Finance's Dan Howley. Dan, so how will this impact social media companies? How will this impact users that use these platforms?
Yeah, it really is, kind of a patchwork of laws that we're seeing, not just, the big ones that I'll get to in a second, but across the country. But those aforementioned big ones are the ones that we've seen in Texas, which the Fifth Circuit Court managed to reinstate. They basically, that law would allow users to sue social media companies if they ban them from their platforms for posting content that the social media companies find objectionable or that run afoul of their actual user agreements. So the companies basically have nothing they can do, nothing they can fall back on to stop users from posting things that perhaps spread misinformation or are just outright violent or things along those lines. And then we have another law in California that was recently signed that is designed to stop social media companies from selling the user information of children's user information, as well as geolocation data. So we're seeing these different laws come up. By the way, the Texas law, there's a similar law in Florida that was struck down by the 11th Circuit Court as being unconstitutional. So we're expecting all of this to kind of end up in the Supreme Court with that side of things. And experts that I spoke to really said that, we're seeing this kind of red state, blue state approach to regulating social media. On the red state side of things, it's, they're blocking conservative voices, although there's no real evidence that we've seen come about of that. On the blue state side of things, we're looking at these legislators saying, look, we have to stop these companies from collecting user data or abusing user data. Now, the California law sounds good in theory, but there are people that have come out and said, no, it's not, because it could end up outing individuals who want to remain anonymous on platforms. They said it could be a risk to LGBTQ plus users because it could force them to put their ages into these platforms to prove that they're not children, and then that information could then be used to identify them using other data that's collected through social media on the usual basis. So there are these kind of patchwork of laws, and for us, it becomes, what do we do? Right? We're using these services and, can I post what I want? Can I not post what I want? Is my information going to be collected here, but not there? And then for the companies, it just becomes this morass of, so many laws that are kind of counterintuitive to each other and fighting. And it makes the entire situation almost untenable for them. So that's why we've seen the likes of Mark Zuckerberg, former Twitter CEO Jack Dorsey, among others, come forward and say, Congress, do your job. Give us one law that we can all follow so we're not stuck using these different laws and trying to figure out what we can do on our own.
Yeah, I guess the alternative is more fragmentation, but the argument on the other side would be that there just hasn't been federal leadership, which is why states are stepping in.
Exactly.
Certainly, Dan, I know you're going to continue to follow. Thanks so much for that. Well, turning now from one legal struggle to another, the Biden administration and Republicans headed for a potential legal battle over the president's executive action to cancel up to $20,000 of student loan debt for millions of Americans. Let's bring in Yahoo Finance's Alexis Keenan, who's following this story for us. How are the battle lines being drawn right now?
So it's a little premature right now, and that's because nothing's happened yet, right? Those applications from the administration have not yet gone out so that student loan borrowers, debtors can actually apply. So that's what's in the legal world called standing. You have to actually have harm done to you in order to bring a suit that says you've been harmed. So we'll see what happens here. Now, there are different groups that are not happy with this action or purported action by the administration. One is Republican State's Attorney General. Another are some fiscally conservative advocacy groups, also some lawmakers, but they're not all on the GOP side. There's also Democrats who are skeptical of this move. You have Senator Nancy Pelosi saying that she's not sure if the Biden administration has the power to flat out cancel debt, that maybe he can postpone debtors' responsibility for paying, might be able to put some delays in place, but she's not sure if that more broad effort is okay under the law. So that's something, though, that has been broadly addressed this year, in fact, by the U.S. Supreme Court. We had a number of cases come down that looked at this type of executive action and really curbed how far an administration can go to unilaterally do these types of things without Congress saying that it's okay. So I've been talking with legal experts about, okay, who actually would have the power to bring these lawsuits if the applications do go out? Also, what arguments would they make? And also, could the suit or potential suits block the debt relief from being given? So there might be a very short window there if these potential legal challengers say that they want there to be a stay put in place while the courts figure it out. So one of the grounds could be, and these could be brought, they say, by banks, if banks are expected to assume some of this debt, also states and also individuals, right? Just the person who has student loan debt is carrying it and can't get it forgiven. You can see the inequity argument there. So one of the grounds that could be, they say, these legal experts, is that the administration has exceeded its authority, right? That we were talking about, Congress would have to actually authorize it. Another is that the national emergency on which it's based, which is COVID-19, is over. So that's in large debate right now, whether COVID-19 is still, in fact, a national emergency. Can you go back and retroactively take this action?
Replay Biden's soundbite.
Right. So, look, there are arguments that are going to come. The law that the Biden administration is using in order to make this action, it comes from a 2003 act called the HEROES Act. And what it was meant to do was give some student loan relief to the military families that were fighting two wars at that time, both in Afghanistan and Iraq. So this is definitely a move to go deeper into that law and use it to give this kind of relief. So we'll be watching. We will let you know if an action does come down.
A lot to watch. Thanks so much, Alexis Keenan. And coming up, the Midas touch. Gold springs back to life this morning amid concerns over Russian troop mobilization. But that strong dollar keeps a lid on the moves. Are ETFs the way to play the trade? That's next. In times of uncertainty, investors typically turn to gold, and there were certainly some flows to the precious metal this morning. This as the Fed looks to proceed with another 75 basis point hike and amid the ongoing war in Ukraine. So what's the best way to play it? Wallach Beth Capital's Director of ETF Trading Solutions, Mohit Bajaj, joins us now. And Mohit, the big question for gold is, why hasn't it performed better? Year to date, it is down almost 7%. You could argue that it's done much better than other assets. But really, why hasn't oil gone to the moon, let's say, for gold bugs?
I think what's happening this year is that historically gold has been an inflation hedge, or considered an inflation hedge. But with uncertainty with the central banks, inflation now, at 8.5% almost, right? We haven't seen this type of inflation since the 1970s. People are a little more hesitant in getting into gold. And two, it hasn't performed as well as it historically has, right? Just because we've seen this huge spike in inflation and concerns with interest rates, gold usually performs pretty statically when inflation doesn't move as much or interest rates are more flatlined. But what we've seen this huge spike now with rates and inflation at the same time, which we haven't seen in 40 years. Gold hasn't proven to be its historically inflation-proof product that people hoped it would be.
I mean, just the safe haven play that it traditionally has been. We've seen the move today on the back of what's been playing out in Russia, but as you said, it hasn't really tracked with how it's historically been traded. We'll get to how you can actually trade gold, but I wonder, when you talk about prices, how much of what we've seen so far has to do with what's been playing out in China and India?
It's become a huge part of it. So unfortunately, with China, they're still under COVID restriction. So what's happening now is that usually China is a big consumer of gold products. So is India. So when China's on lockdown, not many people are actually physically buying the product. What needs to happen essentially in those countries is that there needs to be more open marketness. People need to go out and start shopping. And that hasn't been happening. So that's been kind of creating an excess surplus in the marketplace, and why gold prices haven't been lifted since.
How much gold do you think that investors should have in their portfolio?
I'm a big proponent of always allocating across the board in all sorts of different asset classes. Anywhere from 5 to 10% should be no more than significant in one's portfolio. Obviously, you don't want to be overweighted in any asset class, right, or sector for that matter. But having anywhere from a 5 to 10% weighting in your portfolio, I think, would be more than sufficient.
So where are you seeing the inflows right now when you talk about ETF products that are market that allow investors to trade in gold?
Well, there's a couple of products that are out there that are all fine products. GLD is one of them. It was the first ETF in the marketplace to actually track gold. It's about 50 billion in assets. So if you want to get access to gold without having to physically buy the metal, you can just buy that ETF. BAR is another one that we've seen a lot of strong demand in. One of the reasons why it's become so popular is it's actually become a lower expense fee play. And from a price standpoint, it's only like $16 or $17. So for those who are novice investors and just want to kind of put their foot into the space, they can buy that without having to expel as much capital.
And would you recommend physical gold?
I think it's the problem with having physical gold is that if you want to sell it, it's going to be a little bit tougher, right? It's getting the liquidity, buying it, storing it, and even getting out of it is always problematic. That's why it's much easier to have the ETF, where you can basically get liquidity anytime you want to get out.
Okay, some good investing advice there. Mohit Bajaj, Wallach Beth Capital's Director of ETF Trading Solutions. Appreciate your time today. Well, time now for a quick detour. Our look at the hidden headlines you need to know. Interesting one today. The newest branch of the U.S. military releasing its very own, yes, sing-along space song. The U.S. Space Force's new tune is called Semper Supra. That's Latin for always above. And despite the lofty name, online reception has been below what the military branch may have expected. The U.S. Space Force is no stranger to online pushback, having earlier released a uniform design that attracted criticism for using camouflage in space. And as I had to go back and read this, because if you'll recall, when the Space Force was first created in 2019, There's a lot of pushback for Donald Trump. He said this is one of his proudest accomplishments. Then there was actually a Netflix series called Space Force. It kind of spawned it, right? So it seems kind of on brand if we're talking about a song. I don't know if that's what's going to get people excited about the Space Force.
Well, the song, I read a comment online that said that somebody should do a remix of the song with Star Wars and the lightsabers and the pew pew. It would be interesting.
We can't play the song because of rights issues, but you can go check that out online. Coming up on the other side, back on a screen near you, the Golden Globe will return to TV next year. So has NBC seen the reforms it was looking for? And did the boycott, remember the boycott? Did that really work? Ali Canal has the details after the break. Well, the Golden Globes are returning to television in 2023 after holding an untelevised event earlier this year because of diversity and ethics controversy. NBC announced it will broadcast the ceremony on cable and streaming under a one-year agreement. Yahoo Finance's Ali Canal is here with more. And Ali, you've sort of backtrack and think about where the controversy started, right? It was about diversity within the Hollywood press, but has that already been addressed, and is that why they're returning?
Yeah, and there was indication earlier this summer that NBC was interested in bringing back this award show, but there were concerns that they weren't going to be able to attract the studios and the A-list talent, because if you remember during that controversy, we had studios like Netflix, Amazon, Warner Brothers, along with big stars like Tom Cruise, Scarlett Johansson, boycott the Hollywood Foreign Press Association after that LA Times expose. And in that investigation, they found allegations of bullying, self-dealing. Out of the 87 members at the time, not one of them was Black. So because of that, there was this huge controversy, a really big uproar. Since then, the HFPA has done pretty sweeping reforms, some of those being a new board of directors, enacting a new chief diversity officer, more diversity and inclusion programs and trainings, and a new class of 21 members, of which 29% identify as Black. So for now, that seems to be enough enough for NBC, but again, they just signed that one-year contract. I think they're going to be really focused on ratings. Do people care anymore? Do they want to watch the Golden Globes? This year's show is actually going to be on a Tuesday, which is different from years past. Normally we see that on a Sunday or a Monday. Tuesday, January 10th. They're hoping for a big ratings boost, but they certainly want it to be more than the last live telecast. That hit a 13-year low, 6.9 million viewers. And if you compare that to the last pre-pandemic show of 18.3 million in 2020, that's a pretty steep fall from grace. So I just don't know. I feel like Hollywood's changed at this point. I don't know if people want to watch this show as much. I don't know if it makes that much more of an impact at the box office too, especially with streaming introduced. So I think there's going to be a lot of changes coming from this show moving forward.
Yeah, the ratings part is the one question I had. I mean, if you even look at the Oscars, I mean, they haven't really been able to pull the kind of ratings. Golden Globes has always been kind of like the one step away, right? So
yeah, and even Oscars steadily decreasing over the years.
Yeah,
there needs to be a shakeup. They need to reinvent the genre of the award show.
Probably speaks to that 1 year that they'll be testing the waters. All right, Ali Canal, thanks so much for that. Let's do a final check of the markets before we let you go. Of course, we are counting down to that big Fed decision in about 2 hours here, and we're seeing green across the board. The Dow is up 140 points roughly, the S&P 500 up 18, and the Nasdaq up 38 as well. And as we've been talking about throughout the show, a bit of a reversal when you think about the big declines that we've seen on the back of ratings of bond yields pushing higher in the lead up to this Fed meeting. Could we see a relief rally?
Oh, and we are seeing some modest gains right now, but all will be around 2:30 p.m. All eyes will be on Fed Chair Jerome Powell when he speaks.
Of course, we will have all of that live for you right here on Yahoo Finance, the decision, as well as that press conference. You'll certainly want to keep it right here. That does it for Inez and I in this hour.
Everyone, the Federal Reserve continues its fight against inflation this week, but could excessive Fed tightening tilt the U.S. economy into a recession in 2023? That's a risk that's on the mind of our first guest this morning. And for more on what to expect from the upcoming FOMC meeting, we welcome in Sean Snyder, the head of investment strategy over at Citi U.S. Wealth Management. Sean, great to have you here with us. First and foremost, from your perspective, 75 basis points, it seems baked in, cooked in at this point. But what about the next meetings thereafter? And what would the Fed really signal if they were to continue to be hawkish or aggressive with their policy then, and the reaction that the U.S. economy would have to incur?
Thank you for the invite. Good morning. Listen, I think the August inflation report served as a wake-up call to investors that core inflation is not going to come down rapidly. It's going to be sticky for a while. And I think that kind of reassured them that the Federal Reserve is indeed sincere and that they're going to have to go 75 basis points at this next meeting. But I think the bigger question for investors right now is, what is the terminal Fed funds rate? What is the rate at which they will go on pause? Right now the market seems to be centered on this idea that it's going to be 4%, 4.5%. But there's some that are saying maybe it has to go north of 4%, maybe it needs to be 5%, or at least higher than the inflation rate. So that could mean the Fed goes even further than currently priced in or expected. And I think that is what everyone's going to be looking for guidance for, on whether or not 4 to 4.5% terminal Fed funds rate is what the Fed would consider restrictive to the economy. Because then at that point, they can probably go on hold, go into this holding pattern, just wait and see how monetary policy affects the economy over the next 12 months.
Sean, I like the way you put it in your note. You said the Fed's dual mandates may become dueling mandates going into 2023. And at that point, how do they weight the two mandates, right? Which are full employment and price stability, if indeed we see a spike in unemployment, for example?
That's exactly right. So the Federal Reserve has two mandates. One is price stability. They want to keep inflation around 2%. And then the other one is maximum employment. And what maximum employment is traditionally thought to be is an unemployment rate of somewhere between 5 to 6%. Right now you have inflation, according to the metric that they like, PCE, deflator, well north of 6%, according to the CPI, north of 8%. And you have the unemployment rate at 3.7%. So the Federal Reserve can look at those two metrics and say, okay, price stability gets our sole attention right now. But if they do tilt the economy into recession, and I think that would be 2023 if it were to occur, I personally think the first half it would occur, but it could be the second half, then the unemployment rate will start to rise. And then it makes it a little bit more difficult for them. And then they have this dueling mandates, right, where they have to decide which one is their focus. I do think they are willing to accept some job loss. If you do have a recession, they tend to last about 11 months on average, and the unemployment rate tends to rise about 2%, which would put the unemployment rate at 5.7%. So sort of in the range of full employment, but I just think it's going to be a more difficult task to communicate their policy if we start to see consecutive monthly job losses, which tends to be synonymous with recession. I think that will put them in a more difficult place, and I think that will put them in perhaps a holding pattern.
Sean, if we're talking about mid next year for us entering into a real recession, that also means that we would be, 4 quarters removed from hitting a technical recession after, or at least based on the definition of 2 consecutive quarters of declining GDP that we've already seen here during 2022. What's the longer standing kind of implications of that that might be felt by the average household?
Well, I think there's a couple things to consider. I think one, the first half of 2022, we did see 2 negative GDP prints. I think they were sort of distorted by COVID still. You saw inventories, rise sharply across retailers. They no longer need to order those inventories. They have too much inventory. And I think that has kind of resulted in this drawdown in GDP in the first half. But I think that's sort of distorted. Consumer spending still held up okay. But I do think if you look at leading economic indicators, they are not yet suggesting that we are in a recession, but they are suggesting that we may be headed towards one in 2023. And I think if the Fed continues to tighten aggressively, then I think that is the most likely scenario. We put the odds at maybe something close to 70%. But again, it's up to them. It is sort of, in their ballpark of whether they want to do this or not. I think the most likely scenario or implication for households is twofold. One, I do think inflation would come down. And if you look at the misery index of the United States, which measures the unemployment rate and the inflation rate combined, you see really, really weak consumer sentiment. And the reason is inflation is felt by many, while unemployment is most acutely felt by those unemployed. So I think in some regards, most consumers might actually think a recession's sort of okay if inflation's coming down and they're staying employed. For those that unfortunately face unemployment, obviously that's going to make things even more difficult if they're facing high inflation and also losing their job. So there will be, I think, some difficult times ahead for people if that tends to be the case that we see. And I think Europe's also facing a difficult situation. But at the end of the day, the Federal Reserve feels this is something they really need to do and that we can't live with persistent inflation. So I think that is a very tough task for them, but I think they are, up to the task, and hopefully we can still achieve that soft landing. And there are some signs we might be able to do it. Economic activity does look like it's picking up in the third quarter this year, so that's positive. Mm-hmm. There are some signs that inflation is coming down and may start to decline materially over the next 9 months. So fingers crossed, maybe they can pull it off, but it's looking tough.
Fingers crossed. Sean Snyder, thank you. Citi U.S. Wealth Management, Head of Investment Strategy. Appreciate it. For more on all of this, let's welcome in Vanguard Senior International Economist Andrew Patterson to talk about some of the backdrop that we are looking at for all of this action. So Andrew, as we look ahead to the Fed tomorrow, I'm curious, everybody talks about the press conference and the language and trying to read ahead to what the terminal rate might be. What are you going to be listening for specifically from the Fed chair?
So really tomorrow, seems like 75 basis points is pretty baked in. There's some discussion around 100, but if they do go 100 tomorrow, as a result of an inflation surprise or a higher CPI print, what do they have left to do if there's another one, right? They've acknowledged for a while that this is going to be a bumpy ride as they continue to bring inflation down. But tomorrow we'd expect them to really emphasize, not necessarily the terminal rate. They're not going to give you much clarity around that. They may hint at it, but really how long they're going to keep rates at that terminal rate. So how long they're going to keep rates high, because terminal doesn't mean you have to start cutting. It just means you've stopped raising rates. So maybe putting some emphasis around that could be a signal to the market that, just how much emphasis they're putting on combating inflation and how long they're willing to stay at those higher rate levels.
Okay, and so you mentioned that at this altitude, we'll still be incurring some of a bumpy ride, or should be expecting that. But should we also be expecting a soft landing at the end of that bumpy ride?
So again, trying to predict that, we tend to think about it in terms of scenarios. We were thinking that the probability of the soft landing scenario was increasing a bit. So call it around 20-ish% from around 15 earlier in the summer. That may have changed a bit with the inflation print, but again, that was just one CPI report, and one report does not make a trend. So much like the Fed emphasizes, we do want to remain data dependent on that. Right now, a soft landing is not our base case scenario. We would define that as being able to avoid a recession. We do believe that sometime in 2023, there's likely to be a recession, one called by the NBER at least. for at least a period of time. In terms of magnitude, though, we don't think we're thinking about anything like 2009 or 2020. Likely at this point, again, based on the data, likely to be somewhat more mild in nature.
Andrew, we talked to a guest earlier who said the terminal rate could be more like 5% instead of the, say, 4% that the market might be pricing in. Does that sound reasonable to you? And I mean, does 5% still comport with the scenario that you're just painting where we would not see a major pullback in the economy?
So as of right now, we're not ready to move to a 5% terminal. We'd have it a little bit between 4 and 5, probably closer to 4.5. Again, remaining data dependent there. Certainly, if it started to look as if the Fed were going to have to go to 5% and stay there for some time, the probability of a soft landing diminishes, and the probability of a recession increases along with the likely depth of that recession.
Well, the recent IPOs aren't doing too well as equity markets languish. More and more businesses are shelving their plans to go public, especially in the tech sector. A stark contrast, of course, from the IPO frenzy during the pandemic that launched companies like Roblox and SentinelOne to public markets, but maybe not surprising given the weak exit values of recent listings. Joining us to discuss the state of the IPO market is EquityZen senior research analyst Brianne Lynch. Brianne, it's good to see you. What EquityZen does, by the way, for folks who are not familiar, is let people get in on pre-IPO companies, sort of allowing broader access than is typically permitted there. And Brianne, I'm curious, first of all, what kind of interest you're seeing in those companies, the pre-IPO companies? Because if you know maybe your exit, your cash out is going to be pushed out a little bit, is that also affecting private funding? Oh, Brianne, we can't hear you.
Sorry about that.
There she is.
Absolutely. Great to be here. And what you mentioned is exactly the trend that we're seeing in the private markets now, because these companies aren't going public in the near future, given the volatility, given what's going on in the market. There's two factors at play. One is that shareholders and early employees are looking for liquidity and coming to a platform like ours to receive that type of liquidity. And then on the flip side, investors who are interested in these companies and realize that the public exit's not going to happen soon are tapping the private markets to invest and are actually able to invest at some attractive discounts and valuations, given what we've seen in the public markets now translate into the private markets.
This also becomes a retention issue for some of the talent too, especially in a labor market where for some of these tech companies and private companies, it's extremely tight and making sure that you're maintaining kind of the talent cohort that you've been able to take on and build up the goods or the services that you're bringing to market. For some of those early employees, it's really equity in the companies that they're also pitched on too. And so for equity as a retention mechanism, how have you also monitored the shakeup there and how this might even kind of change the pathway towards a public offering that a company may even see in the future?
Absolutely. So at Equities End, we've worked with over 400 late stage private companies on liquidity programs, and we are having more conversations than ever before with these companies who are realizing exactly to your point, okay, if we're not going to have a formal exit, we need to do something for these employees who may have options who are expiring or may have other life needs that require liquidity. And as you'd also mentioned, it's definitely a retention piece. When employees are able to get liquidity, they're able to see the real value of that sweat equity that they've put into these businesses. So it's something that companies are thinking about, they're planning around, and have much more appetite to do than in the past, understanding that the public markets are probably not a place that they'll be in the next 6 to 12 months.
So I want to pick up on that. So you think that this sort of freeze, I mean, it's not an actual freeze, but it's almost a freeze. You think that that's going to go on for the next 6 to 12 months?
Yeah, I would say, where we are in the IPO market now and seeing the results that companies that did IPO in 2021 saw, those companies are down on median 65% versus the Nasdaq down 27%. If I'm a private company looking at that and looking at the broader market landscape of high inflation, rising rates, geopolitical risks, there's not a lot of appetite to go public unless I absolutely have to, or I feel confident enough in my financials and in my brand that I think that I'm a must-have company that public market investors will invest in.
Is the SPAC as a means to going public? Do you believe that to still be a viable option for some companies, or have we seen this washout really shake the tenor of that mechanism of entering into the public markets?
I'm interested to see. Obviously, we saw a big SPAC frenzy a few years ago, and now some of those SPACs are having trouble finding companies that are attractive targets, and they're having to return capital to their investors. Saw 2 stories of that earlier today. So I don't think SPACs are going to go away, but I think that the easy money or, quicker path line to IPO that SPACs allowed isn't as attractive in today's market.
We are seeing crypto continuing its decline today, with Bitcoin falling more than actually 0.3% right now. It is holding right at that $19,000 handle. European-based digital asset manager CoinShares is launching an algorithmic trading platform designed for long-term crypto holders. That platform, known as HAL, allows traders to tap into a wide range of active trading strategies to ultimately get better returns. For more on the crypto market, we welcome in CoinShares CEO Jean-Marie Monetti, as well as Yahoo Finance's David Hollerith. It's good to have you on today. Let's start by talking about what exactly HAL is. How does that work?
Well, thank you for having me. And first of all, HAL is a wing. HAL is a wing to HAL 9000, the heuristically programmed algorithmic computer in Space Odyssey from Stanley Kubrick. But it's also a wing to Hal Finney, which is kind of one of the first type of cypherpunk, and more importantly, the first one to receive a Bitcoin from Satoshi. So it is really something which is there to help people simplify the journey in crypto. I would say direct access to the crypto market has been done very well by companies like Binance or FTX, and it's now time to sprinkle a little bit of an overlay on top of that to help people navigate this complicated market, as you mentioned, a little bit better and help them generate better risk-adjusted returns. So it's above anything about risk management.
Jean-Marie, turning to the markets real quick, most analysts I speak with say that crypto right now, for most of the year too, is mainly a macro asset. It's trading that way, especially with this Fed decision upcoming. And I was sort of curious, how would a trading platform like this be used to sort of deal with that, or how does it relate to the current market dynamic?
So it's a very fair point you're making, because right now, when we look at crypto and the crypto environment, first of all, it's a 24/7 market. It's always trading in the wrong direction when you're sleeping or when you're not available. So having a little bit of help from an algorithm like Trading is a fantastic solution for to help you on a daily basis. Now, if you think about crypto being trading as a macro asset, I think crypto right now is trading as a risk-on asset. But more importantly, crypto is waiting for a sign, and the sign crypto is waiting for is, the U.S. net liquidity index starting to increase again. And people get very confused all the time about this liquidity index or net liquidity index when we speak about, about it in general, because people track the Fed balance sheet and track the Fed rate as a proxy for that. But people forget to look into the Treasury general account and the overnight reverse purchase agreement, which can countermeasure effectively the QT at the same time. So really, what we're looking for is the start of a decoupling in crypto, and the kind of precursor to this decoupling, in my mind and in our research, CoinShare mind, is really when this US net liquidity index is going to start to grow again. So you can plug that very easily on any software, financial software. And because these markets are very complicated. Sorry, go ahead. Sorry.
My fault. The epic decoupling is a big crypto moment to watch. I was sort of curious, until we get to that point, how is CoinShare sort of positioning itself as a business? It's obviously not your first crypto cycle.
No, so CoinShare has been around for, as CoinShare as a brand 2016, but realistically in crypto since 2013. So our kind of we have learned to evolve and to survive in this kind of environment, which are called crypto winter, which are never really, good exercise from a market situation, but which are fantastic exercise from a built situation. And that's why we couldn't find a better time than now to launch something like Trading, because it is in this kind of bear market situation that you are building the bedrock of the future success. And we're doing the same thing with asset management product. We kind of keep innovating, keep bringing to market new things, which are going to be there and stabilize before the market starts to take a new dynamic. So it is time for building, it is time for innovation, and Trading is this illustration you're looking for.
Jean-Marie, it's been interesting to see how crypto has been so closely correlated with some of these risk assets in the equity space. And you mentioned you've seen these downturns before. How do you think what you're seeing right now plays out? How does that compare to the past declines that we've seen?
It's a very good question, because it's a very different time, effectively. If you go back to 2017 or 2018 more precisely, my head of trading and myself, look at our book, and the book was very simple. You move back to 2021, 2022, and you end up with like much more complex book, because the whole crypto ecosystem has been asking for institutional to come to crypto. Institutional adoption has been on all the lips, and it has happened to some degree in the US. And with that come complexity, come sophistication, come risk interoperability and composability. So all these kind of issues, which are typical Wall Street issues, are now permeating into crypto, making this crypto downturn much more complicated, much more vicious to some degree, because the risk management is very, very different and needs a lot of focus. And then you need to not forget that back in 2018, there was nothing like DeFi. Everything was very simple. Everything was a couple of very much smaller centralized exchange. And now we get massive centralized exchange and a very kind of important DeFi activity. So everything is very different this time, and make it, as usual, a bit more complicated to navigate for the user, which is not, 24/7 embedded, living and breathing crypto as we are.
Yeah, those challenges are a lot more layered, as you said, as we've seen in the past. Jean-Marie Mognetti, CoinShares CEO, it's good to talk to you today, and our thanks to David Hollerith as well. Mario, good to talk to you. I think a lot of people are wondering, we had the rail strike resolved last week. The next focus here is what's happening with the ports. Workers there have been working without a contract since July. What's the latest?
Well, the good news, Akiko, is that the workers continue to work day in, day out. So the cargo is moving. In addition to that, I think it's fair to say that the supply chain now is moderating. So we're having some semblance of normalization. So I think it's all good news for the West Coast, particularly the Port of Long Beach and Los Angeles. The backup of vessels is very much diminished, about 10 compared to 109 earlier this year in January. So I think it's all good news with regard to the supply chain.
You have said publicly that this is not going to be a repeat of 2014. You're not going to have a prolonged strike per se, a stoppage in work. When you think back to what happened with the rail strike last week, it was the White House that ultimately stepped in to try and resolve this. That's where we stand right now. Is that your expectation with these negotiations too? And what conversations are going on with the White House?
Well, at least at this point, I'm optimistic that the negotiations between the two parties, IOW and the PMA, are moving forward. So I'm optimistic they'll find resolution. The rail strike was a little bit different. I mean, you're talking about a 3-year impasse, so to speak, of discussions, negotiations. In that situation, the White House did step in. But in this case, I'm still optimistic that we're going to have a reasonable resolution here within a reasonable period of time. So
a reasonable resolution mean no stoppage?
Absolutely no stoppage, no slowage. So again, the cargo is moving day in, day out. High productivity for us at the Port of Long Beach for the first 8 months. We're up 4.6% than our record year of 2021.
Meantime, we have seen reports of importers who are maybe optimistic, but sort of looking at contingency plans, potentially moving some of the cargo away from the West Coast ports more over to the East Coast. Are you seeing that in Long Beach?
There is a percentile of that, absolutely. But again, once the labor negotiations come to resolution, some of that business is going to come back. So I'm not too worried about that in terms of the midterm or even long term. The San Pedro Bay complex will continue to be a competitive, strategic, significant gateway for this nation.
You've obviously got a good pulse on the demand picture with all the freight coming in through your ports at a time when there's concern about easing demand, but also companies, retailers having to deal with inventory that's building up. What are you seeing, and what does that tell you about where things are headed going into the holiday season?
Well, number one, what we're seeing now in terms of the consumer demand dissipating is what many of us predicted back in the spring. So you're starting to see that. The capacity issues, at least in the St. Peter Bay complex, are much diminished. We still have capacity issues at the warehouses because of the advancing of the inventory. So I'm very optimistic that in the holiday Christmas season, I don't think consumers have anything to worry about in terms of the shelves being well stocked and all goods being available for the season.
When you talk about capacity issues, I mean, what specifically are you seeing there, and to what extent has the situation improved?
Well, what we did see earlier was the shippers, or the BCOs, beneficial cargo owners, were advancing so much inventory for fear of not having a repetition of what occurred in 2020. And so much so that it created capacity issues at the warehouses and the distribution centers. I think that's diminished. You've seen Target, Walmart, and others announce a depletion of their inventory, sales. So I think that's being addressed, and I think we're in a much better position in the supply chain in Southern California than we were earlier. But the good news is that for the nation's supply chain, I think, again, you're seeing moderation and some semblance of normalization again.
Certainly good news after what you've seen over the last few years. Getting back to the negotiations here, though, one of the key sticking points has been this concern about automation. Obviously, with workers, wages a big question mark, benefits as well. But the automation part has been a bit of a sticking point, largely because when you think about where things are headed, there's concern about the security of the jobs. Where does that discussion stand right now?
Well, I'm not privy to the discussions. I'm not in the room discussing those issues. What I will say overall, keep in mind that for us, productivity is very important. I think on that metric, we're doing very well. 4% of the terminals throughout the world are automated or semi-automated. I'm not going to deny that's a subject of discussion in terms of the supply chain and the global terminals. But again, this is an issue that for us at the Port of Long Beach, we want to make sure that we keep the sense of productivity, which is so important. So in conclusion, I'm more interested in cargo velocity in terms of how we move the container, as opposed to what we've been discussing the last couple of years of cargo volatility.
What can be improved on that front when you talk about the velocity?
24/7. I'm not going to step back from the vision that I believe that the good news, we have already 3 terminals in St. Peter Bay Complex that have a hoot shift that is 3 a.m. to 8 a.m. So gate expansion of operations is occurring. So I think, again, that's the good news. So I think for us, we need to kind of elevate the gate hours, the operation hours, whether it's truck, gate, or railroad activity. And I'm optimistic in the future, we're making strides in that direction.
Finally, you mentioned that consumers don't necessarily have to be worried about store shelves being stocked come holiday season. The big concern is really how much consumers are willing to shell out at a time when inflation is still maybe not at the 40-year record, but still at very elevated levels. Big picture, based on what you've seen and what you've observed, how significant is the slowdown?
Well, I think the slowdown in terms of consumer demand is not a significant one. Again, we're comparing year to year to record demand given what we experienced from 2020 going forward because of e-commerce, online buying. So I think it's, the good news is, energy prices have diminished, so to speak. There is a concern about the inflationary rate. I will then trust the Federal Reserve that has a plan of action to address that. So I think, again, the good news for us is productivity continues. The demand is there, but again, we're comparing year to year. So I think going into 2023, we'll see what the Fed Reserve does and what that impact and results of that action next week, and we'll go from there.
Yeah, tough to compare against the kind of records that you saw over the last few years.
Absolutely, record year. And for this, like I said, for the first 8 months of Port of Long Beach, we're 4.7% above last year. So we may have another record year.
Okay, Mario, it's good to have you in the city here.
Well,
Mario
thank you,
Cordero, Executive Director of the Port of Long Beach, joining us. Well, the UN's New York Climate Week is officially underway, with business leaders, government officials, and activists all meeting to discuss progress towards a net zero world. Last year, world leaders agreed to set more ambitious climate goals at the COP26 summit. They were given a September deadline to submit new plans, but only 11 of the 196 countries have done that. So it was a very different macroeconomic environment, changing expectations. Joining us to weigh in is the Center for Strategic and International Studies Energy Security and Climate Change Program Fellow, Morgan Higman. Morgan, to say that things have really shifted would probably be an understatement, especially given what has transpired since Russia invaded Ukraine. Certainly countries in Europe now looking at energy security and saying, well, maybe we need to potentially push off some of these really ambitious goals towards clean energy. How do you think that all plays out this week?
Thank you for having me. I think it's absolutely true that we live in a different world than we did in November of 2021. Russia's invasion of Ukraine, of course, is at the top of that, but inflation spiraling kind of all around the world. We're seeing energy, food, and supply chain sort of concerns. All of these are creating challenges for those important climate commitments that have been made. And I would say that we've seen a variety of responses. Some have really doubled down on renewable energy and energy efficiency as a way to address these energy crises we're seeing. Others are, of course, falling back on fossil fuel resources. And some, frankly, I think are kind of attributing some of these energy costs to energy transition and climate commitments that they've made maybe not rightfully. We've also seen that these geopolitical tensions have sort of undermine some of the bilateral agreements that came out of COP26, perhaps most importantly, that between US and China. At the same time, climate impacts are becoming increasingly evident all over the world. Nonetheless, I think it's important to note that we have seen some measurable progress. In particular, the International Energy Agency published some figures highlighting sort of continued growth of renewables globally, and the doubling of electric vehicles around the world. So we're seeing some progress still. I think that Climate Week will, of course, highlight some of the challenges and opportunities, and then COP27 in November will do the same.
You've got the president coming into New York tomorrow to address the UN General Assembly. Obviously, this isn't just about climate, other geopolitical issues too, but he comes in with a big package to say, look, we were able to meet some of these goals through the Inflation Reduction Act. How do you think that divide between what the U.S. has pushed for and Europe is growing when you consider Europe is really the one that is experiencing the brunt of the energy crisis?
Europe is the one experiencing the brunt, but I think the good thing about this meeting is that it highlights opportunities for some of these global powerhouses to come together. They represent a great deal of potential for investment and innovation. And one of the things that is really coming out of this crisis is the need for diverse renewables, diverse supply chains, and energy resources that can be sort of connected and shared globally. That will require new infrastructure investments and a lot of private sector investment in these resources. And legislation like the Inflation Reduction Act will support that. But some of these meetings will provide opportunities for major leaders to come together around some of these goals. And we need that. That said, Climate Week is important, but it's probably not going to be the place where we can map the road to net zero, right? These conversations are going to continue for a long time.
Yeah, it is an ongoing conversation. As we said, this isn't just a week where global leaders are gathering. A lot of business leaders also coming into town at a time when there's growing skepticism from the investment perspective on ESG investing. And part of that is about whether, in fact, that the standards are right, whether there should be universal standards. How do you think that affects the messaging from these companies? Number one, as you said, they're being hit by inflation. Shareholders are saying, look, maybe this isn't the time to double down on clean energy. At the same time, there's an investment community that's saying everything that was pushed for in ESG hasn't necessarily materialized.
Absolutely. And I think there's a great deal of tension between the need for sort of ambitious and accelerated solutions and also the need for credibility and transparency. And we'll see that play out in a number of different ways, I think. new technologies will provide some opportunities to decarbonize sectors that haven't seen a lot of progress. In particular, we can think about transportation and heavy industry. And we've also seen some renewed commitments to reforestation and sustainable investments that are more environmentally focused, that might have broader appeal for some of those who have skepticism about these emerging technologies.
Well, we will be watching for any headlines that come out this week. Morgan, it's good to have you on today. Center for Strategic and International Studies, Energy Security and Climate Change Program Fellow Morgan Hickman.
New data shows construction of new homes rose more than 12% in August, this after a steep decline in July. This comes on the heels of a report that builder sentiment is down for the 9th straight month. Jay McCandless with us from Wedbush Securities, Senior Vice President, Equity Research. Good to see you, sir. So we talk about that number up 12%. On the other hand, building permits are down 10. It's a little bit confusing. Is there some reason for optimism in there?
Yeah, thank you for having me. I think part of the issue with starts being a little delayed is supply chain, both in terms of developing the land to get it ready to put the home on, and then actually getting the home constructed itself. As the parts and pieces become available, the builders are going ahead and starting. I think the slower permit growth is a function of what you talked about with higher mortgage rates. Maybe builders being a little more cautious until we figure out where mortgage rates are going to settle out. I also think that the builders already had a lot of homes that were underway, and again, now that they're starting to get the parts to get them built and get them constructed, they may be slowing down a little bit of the forward production until they can catch up in the field.
Jay, speaking of those higher mortgage rates, what do you think demand destruction potentially looks like, and how long do you see this challenging landscape here for housing lasting?
I wish I knew when the mortgage rates were going to stop going up. It's been a pretty challenging environment, certainly the highest rates we've seen in years. What we did see in August, when rates stabilized or late July and early August, rates stabilized for about 6 weeks. That started to help bring some buyers back in. Who knows where mortgage rates are going to go this time around, but if we could find a level and stay there, even if it is a higher level, that helps people figure out what their monthly payment is going to be, and conversely helps the builders, I think, generate more web traffic and foot traffic to start people on that home buying journey.
And Jay, I want to ask about the neutral rating on Toll Brothers and the $50 12-month target that you have for them. Talk about some of the issues that are at play and what you think might potentially turn it around.
We're cautious on, we like Toll Brothers, the company, but we're cautious on the stock right now, just because that higher end consumer, which Toll, that's their focus, are luxury and higher end consumers. that consumer seemed to have pulled back more in terms of confidence and willingness to buy a home than what we saw from some of the entry-level builders in the June and July earnings season. So, until we see that higher end customer maybe a little more willing to step out and get a home, which, we've seen it from some of the other builders too, but that's, I think when ahead of the June earnings cycle, the expectation, at least on my part, was that we were going to see maybe the entry level consumer pull back a little bit, but that move up and luxury consumer would be able to ride out this change in rates. And it's actually been the opposite. That entry level needs-based buyer who is growing their family, needs more space. That buyer, if they can find a payment that works for them and a home that works for them, they are going ahead and making the move. Whereas that higher end consumer is being a little more hesitant right now. So that's the reason behind the neutral rating for Toll at this point.
Most of the big home builders are down in the neighborhood of 30% on the year. Contrast that with what you see in KB Homes and why they outperform.
So KB does about 55 to 60% of their quarterly volume in entry level. Their entry level, though, is more of a call it a tweener, not really a spec smaller home. It's a home that a person can customize. We like their model. We like the fact that they focus on that 55 to 60% entry level because, again, that's where the demand seems to be. Going into the print, we are ahead on earnings. But we do think that orders may be a little bit softer this time because as opposed to some of what we call the speculative home builders, which are homes that are started without a sales contract, people who it may take 6 to 9 months with their KB home to receive it, they may be a little more hesitant to buy right now. Whereas with the three other names that we like, Meritage, Century, and Horton, they do have homes that are available for purchase within 60 days or less. And the buyers seem to like that right now because they can go ahead and lock in the rate on their mortgage, have an idea of what their monthly payment is going to look like. And I think that may give those three names a bit of an advantage right now versus KB. But again, we do like the entry level exposure. And as that buyer who may have a little more money saved up or maybe a little higher income demographic, once that buyer starts to return to the market, we think KB is going to benefit from that.
Well, Jay, it certainly is a very tough environment, a deteriorating environment for the housing sector right now. What do you think the impact will be on this space? Do you think we could potentially see consolidation as a result?
I haven't really seen consolidation in a couple of years. And I think given the opportunities that some of the builders have in the single family for rent space, it wouldn't surprise me if we see some of the production that was going to go to for sale move to for rent. Can't rule out consolidation, but there are so many investors and dollars being earmarked and targeted to go into that rental market. I think there's plenty of construction to be had out there. It may just not be exactly what the builders had anticipated coming into this year. And I think also you look at the competition to for sale housing. Multifamily rents are still moving up 15% a month. Single family rents are moving up 15 to 20% a month. So we think the overall shelter demand is still very high. It's just some of the builders may need to reset pricing and or help out on the rate side to get people into those homes. But when we look at the demand and the demographics with the millennials being such a larger population that's fully in household formation mode right now, and you compare that to 2009 when we had too much inventory and not enough buyers with the Gen X generation, I think from a demand and a shelter demand standpoint, we're set up much better this time around than we were during the GFC.
Mm-hmm.
And Jay, you mentioned multifamily projects. That was actually one of the bright spots in the home builder data, and that's, of course, being driven by some of this strong demand for rental properties. Are there certain companies that are in a better position to capitalize on this than others?
Yeah, the two that we covered that play in the multifamily market or build in the multifamily market are D.R. Horton, D.R. Horton, Toll Brothers, and Lennar. All three of them build multifamily projects to one extent or another. D.R. Horton has also started their own single-family for rent division where they're building whole communities, leasing them up, and then selling them into investment funds. And most of my other builders that I cover have started to move into the single family for rent space, either through joint ventures or doing some sales directly to investors. So yeah, multifamily and single family for rent. Again, those are other revenue opportunities for the builders, but to multifamily specifically, especially with some of the really strong rent growth we've seen in that market, Toll, Horton, and Lennar are going to be our most immediate beneficiaries.
Seems to be where the trends are headed. Jay McCandless, appreciate you being here. Thank you.
Early reaction from Amazon's first Thursday night football trickling out here. The company's head of sports calling the premiere a, quote, resounding success. In an internal email, he wrote that the company saw more Prime signups during that 3-hour window than ever before, including Prime Day, Cyber Monday, and Black Friday. Joining us now is Tom Forte. He's a senior research analyst with D.A. Davidson. Tom, it's great to see you. You obviously cover Amazon stock. It looks like it was a huge win for the company, the most Prime subscriber memberships in a 3-hour window. So very, very important to point out that tidbit of information. But what's your assessment just of what we're hearing from their head of sports?
Sure. So basically, the way that I've been thinking about Thursday Night Football and Lord of the Rings, the two multi-billion-dollar Prime Video bets, is how about the subscribers who are not interested in Thursday Night Football? So if you look at the ratings for Thursday Night Football last year, let's say that 15 million people watched Amazon Thursday Night Football. On a base of 200 million Prime Video members, that's 7.5% penetration. That means 92.5% of Amazon Prime viewers didn't watch Thursday Night Football. Well, in the 92.5%, how are they going to feel about paying $20 more a year for Prime for something they're not interested in? So I think that's kind of the challenge for Amazon when you think about Thursday Night Football and spending $1 billion a year for the rights to broadcast it.
How much do you, it's bizarre that we have not, Tom, heard a total rating or how many millions of people did watch the game. Amazon has more data than anybody on the planet, presumably could have had it that night. What do you make of that? Is there a number that could disappoint the street?
It's an excellent question, and you're talking to someone who's followed Amazon, essentially since the beginning when they were only an online bookstore. And I'm used to Amazon being vague with data. So a lot of times, for example, they'll say that they have, more than 200 million Prime members who watch video, or more than 1 million Amazon Web Services customers, things of that nature. So unfortunately, it's not unusual for Amazon not to give specific data, in this case, audience size for Thursday Night Football. So I go back to the information from Deadline on last year's ratings, which I think indicated it was in the neighborhood of, call it 15 million. And I think that's a good guidepost for how Amazon may have performed.
So Tom, I want to ask you about what you called Amazon's sphere of influence. How does sports and streaming then play into that?
So really the question is, how does Prime Video play for Amazon? And I think the most optimistic or bullish you can get on Prime Video is to think about Amazon's advertising efforts. So while we talked about how they're sometimes not very clear with providing data, they started breaking out how much revenue they're generating from advertising. So to the extent that they're broadcasting Thursday Night Football and showing a lot of ads against that popular content, I think that is actually a very good thing for Amazon. And the relative profitability of their advertising sales, it may not be as good as cloud computing, but it's definitely better than their retail sales. So I think the question will be, how much incremental advertising revenue can they generate from Thursday Night Football? And the good news is it should be high margin revenue, like other advertising revenue Amazon's generating.
Give it a year or two before they throw a barcode right up on your screen and you're shopping at halftime. Maybe not even that long. But Apple's the other player in this game, expected to get the Sunday NFL ticket package. How significant of the story is Apple's entry into sports streaming?
So for Apple, they're primarily going to make money selling you the hardware. So I think a great opportunity for Apple is to mirror what the cable companies did, which is charge you a monthly bill that includes hardware, software, and services. So I think that's going to enable Apple to charge $2,000 for an iPhone instead of $1,000. And the example I like to give is, how many consumers know how much their Samsung set-top box costs? And the answer is probably none. So to the extent that Apple can convert it to a monthly bill, let's call it $100 a month, or maybe $200 a month for all the Apple hardware, software, and services you'd ever want, I think that's what's going to enable Apple to make money, though I still think it'd be hard for them to make money on a Sunday NFL ticket because it's such an expensive piece of content.
Yeah, around $2 billion a year. That's really tough. Yeah.
It's very expensive. And Tom, talking about what all these tech giants are doing to stay competitive, they're not just focusing on their content, on the streaming plays here. There's also other, obviously, very important parts of the business. When it comes to Amazon, it's interesting in terms of the M&A strategy that we have seen under new CEO Andy Jassy. Most recently, one of their recent acquisitions was them buying iRobot. Now, there was news today that the FTC is requesting for additional information on this deal. What do you think the likelihood is of this deal getting approved? And then more broadly speaking, just Amazon's M&A strategy under Jassy?
So I think that there's a high likelihood the deal gets approved. The reason I think the deal gets approved is because I don't think Amazon entering, robot vacuums essentially is going to create a non-competitive environment for everyone else. And I do think that if you look at this One Medical, even MGM, Amazon seems to be expressing a lot of confidence it can do M&A deals $10 billion and less. And then how do I compare and contrast M&A under Andy versus M&A under Jeff? The big challenge for Andy is that it takes about $3.9 billion for 100 basis points of revenue growth for Amazon. It's just a much bigger company than when Jeff ran it. So Andy needs to do more M&A. I love the One Medical deal. It's $1 trillion total addressable market being healthcare. That could be a needle mover. And I think that's why you're seeing Amazon engage in more M&A than it did when Jeff Bezos ran the company.
And Tom, you also talk about some of the risks that perhaps aren't getting talked about as much when it comes to Amazon. What are you highlighting?
So again, I've been highlighting this risk because a lot of industry executives in the video industry felt like there was zero risk to Amazon, meaning that consumers so loved their Prime that if they were disappointed by Lord of the Rings or they didn't want to pay the $20 for the NFL, they would never turn off their Prime membership. I do think that that's a risk for Amazon. I do think that charging more money for the service could turn off consumers, especially the small minority who don't like Tolkien or don't like the NFL. But I do think there's a risk there.
Indeed. Well, great getting your insights, Tom Forte. Thank you for joining us this afternoon. Have a good one.
In this episode of Influencers, venture capitalist and domain money CEO, Adam Dell.
You can invest today in the banking system of tomorrow. And that's a very exciting investment opportunity for retail investors. If you are solving a fundamental problem with a technology solution that appeals to the end customer, that's a pretty good formula. I've been very fortunate to have a front row seat to one of the great entrepreneurial success stories in our country's history, and couldn't be more proud of my brother and what he's done.
Hello, everyone, and welcome to Influencers. I'm Andy Serwer, and welcome to our guest, Adam Dell, venture capitalist and the founder and CEO of a new trading platform, Domain Money. Adam, great to see you.
Good to see you, Andy. Thanks for having me.
I want to ask you all about Domain Money, but first of all, I've got to ask you about the crazy markets this year, both in crypto and in equities. What the heck is going on?
Well, market volatility is one of the things that is inherent in our market, right? Whenever you have such a large inflow of capital into a discrete number of assets, you're going to have significant swings. As Warren Buffett likes to say, the market is a voting machine in the short term and a weighing machine in the long term. And as I look at the long-term trends of some of the free cash flow sources that are being spit out of some of the larger tech names, I'm quite bullish on their prospects going forward. And as it relates to cryptocurrencies, where we're focused, I look at the fundamental underlying components of blockchain technologies and their contribution to our financial markets, less from a speculative standpoint and more from a core market function, a core financial function. If you look at, for example, Visa. Visa moved about $10 trillion worth of transaction volume around the planet last year. Last year, Ethereum alone moved 11 trillion. And so that just gives you a sense of the scale of the impact of these technologies and what impact they will have on our broader economy. I'll give you another example. Money markets. A few years ago, the number of dollars involved in DeFi money market protocols was less than 1 billion. That's a 2018 stat. This year, it's over 200 billion. And so the growth of the financial utility of these underlying technologies is undeniable. And as they become more widely adopted in commercial use cases, again, unrelated to speculation, I think you're going to see a significant growth in real revenue and real cash flow coming out of these technologies.
Yeah, I hear you, and I want to ask you more about those technologies, but just sort of again back to the macro environment, because say, first of all, with the tech stocks, they've just been such winners in so many ways in our economy, but the driver here right now is higher interest rates. Does that concern you?
Well, I mean, interest rates have been so low for so long that there's a whole generation of investors out there and market analysts who believe that this is the norm. And obviously, on a historical basis, interest rates don't stay this low. And so I think, given the true cost of capital and the fiscal responsibility that is incumbent upon responsible central banks to employ, interest rates inevitably need to go up over the long term.
And with regard to cryptocurrencies, blockchain aside, people are talking about Bitcoin, and they've sort of positioned it, Bitcoin and Ethereum, other cryptocurrencies, as either a hedge or not correlated to equities. But right now, it looks like those currencies are correlated to equities. What's your take on that?
Yeah, I think that is a reflection of the maturity that the crypto markets are going through. These assets are now more broadly held across a larger institutional base. They're now held across a larger retail base. And so downward pressure in the macro market invariably will impact crypto as well.
All right, let's switch over to Domain Money. Your new company, is it pretty new? And what is it? How old is it?
So we launched today.
Oh, that's new.
January 25th. So we have thousands of customers on the platform today. It is a robust, sophisticated investment solution for both stocks and crypto. We provide a number of differentiated features that we think distinguish us in the market. Chief among them is our signal product, which goes really deep down the data rabbit hole around the underlying fundamentals associated with these crypto assets. I'll give you a few examples. We analyze the Twitter fire hose as well as other social channels, and we provide a proprietary social sentiment score where we basically provide positive, neutral, negative ratings on the social sentiment of underlying assets. Another thing we do is we track the flow of funds on exchanges, so tracking the on-chain and off-chain activity of underlying crypto assets, which is indicative of sentiment and price volatility. A third thing we do is we track project health. We look at the overall quality of the management team, the number of GitHub submissions, and we present all of these insights to retail investors in a very consumable and easy to understand way. So those are some of the things that we are doing at Domain that are unique.
What about the timing of this all, Adam? I mean, with the Fed, probably raising rates a number of times this year, we were in this incredible bull market, particularly during COVID, where there was all those stimulus checks coming into people's pockets, and then they were going out to broker dealers and spending it. Are you heading into sort of a wind coming in your face?
Yeah, well, I mean, short-term market swings are not really the thing that we pay a lot of attention to. We spend much more of our focus on the long-term trajectory of these assets. And as I mentioned, there are some incredibly powerful forces that are driving real cash flow out of a number of the investment projects, the investment classes that we're looking at, particularly as it relates to DeFi protocols. And so we're very encouraged by the underlying trends that we see. A lot of people look at the price of Bitcoin or the price of any given crypto asset over the last couple of weeks and say, gee, this doesn't look really good. I look at something very different, which is that, a couple of years ago, there was virtually no transaction volume moving around the world to empower NFT transactions. Last year, it was 23 billion, okay? A few years ago, less than $1 billion in DeFi volume. Last year, 200 billion. 11 trillion in transaction volume on Ethereum. These are profound trends that are not going away just because of the short-term volatility in the financial markets.
And speaking of those profound trends, Adam, and you mentioned you worked at Goldman, you mentioned Visa. What is your take on these legacy institutions? Are they going to get consumed by these trends? Or are they going to co-opt them? Everyone always talk, oh, Visa and MasterCard are dead because of electronic payments. Of course, they benefited like crazy. But now there are questions about those companies, for instance.
Yeah. Well, we've been honored that we were selected by MasterCard to be part of their Smart Path program. What I've seen from the Visa and the MasterCards of the world is that they've really wrapped their tentacles around anything and everything related to blockchain technologies, because they, like many smart investors, see the opportunity set and what it can mean for improving the efficiency of our banking plumbing. The bigger story, though, is what these technologies will do to allow consumers to both borrow and lend on their assets. That game is going to change profoundly because of blockchains, and represents for consumers a real opportunity to make real yield on their assets or borrow at a much more market-driven rate rather than one available from their credit card or from their personal loan provider.
Wait, explain to us how that would work, Adam.
Well, if you look on a number of the DeFi marketplaces where you can borrow and lend, you see rates that are much lower than what you would get from a credit card or from a personal loan provider out there in the market.
But aren't those companies just trying to garner market share? Isn't that a money-losing proposition? Or is the margin on crypto so much lower so that it is still profitable?
Well, it's a true marketplace where rates are a function of what someone's willing to pay, rather than, a fair bit of regulatory constraints and controls that prevent true market rates from being accessible to anyone. The average consumer can't access a money market in the same way that an institutional investor can. And crypto represents an opportunity for those markets to be opened up to anyone.
That was the metaphor I was looking for. That's great. Okay. And speaking of regulation, though, you provided me with a nice segue. The Biden administration is reportedly preparing, I should say, an executive order for release coming up soon that will outline a comprehensive government strategy on crypto. Is it a good idea for the White House to get directly involved here?
Well, we welcome and invite regulation into this industry because it's an important step in its maturity. I point people to the fact that China's efforts to try to clamp down on this activity had virtually no impact on the overall value of the market or trading activity, for that matter. And it just shows you that information wants to be free and markets want to be free. And so I think it's incumbent upon the United States as a leader in financial systems and in financial markets to think through the policy decisions around what is a stable digital currency, how do we bring this nascent market into mainstream financial functions, while at the same time protecting investors from the things that are scary and may not be as above board about this industry. And obviously, in any new industry, those players emerge. Andy, you and I remember the early .com period where there were hundreds of companies, many going public without a clear business model or any line of sight to positive cash flow. And yet, despite all of that noise, an enormously valuable set of companies emerged that redefined the very fabric of our economy. And the same dynamic will exist with blockchains and crypto. We're in the middle of a Cambrian explosion of diverse projects and initiatives that are being tackled by engineers using these technologies, and some subset of those will become the very building blocks of the next generation of our banking system.
Would regulation impact domain money?
We've worked hard to ensure that we are following the letter of the law as it relates to regulation, because we want to represent this industry as it matures, rather than being part of the fringes of the Wild West of the industry.
Right. My understanding, Adam, is that you said, quote, the notion that individuals are rational actors is a false one. They are emotional animals and they make financial decisions based on emotion. So is that true? Okay, good. Glad we got that right. Do trading platforms like yours, though, then have an obligation to protect users from themselves?
Well, I believe it's our obligation to inform the consumer and provide them with as much information as we can to educate them about making rational investment choices. We really stress on our platform education, transparency, and time-tested investment strategies. So we talk a lot about dollar cost averaging. We talk a lot about portfolio theory. We talk a lot about market fundamentals. What is the market size of this technology? What is the product market fit? What is the management team? What is the business model? And what is the viability of that business model over time? Rather than things that are meme and momentum driven. And so while I can't protect individuals from making bad decisions, I can help inform them. And so our goal is to achieve that for investors.
I want to ask you about wealth inequality and financial services, because of course the wealthiest Americans still own the vast majority of equities. And it's probably true about crypto, although I'm not really informed. I'm just guessing. Maybe you know the answer to that as well. How do we address that? Is that anything that concerns you, Adam?
Well, the most interesting opportunity for blockchain technologies is opening up of markets to a broader set of our members of society that don't have fair access to a financial relationship that allows them to live their lives. Borrowing money, earning interest on deposits, those core components of our financial system are available to people who have bank accounts, who have credit scores. And blockchains operate differently. They don't require there to be trust between the two parties to a transaction. And so they, as I mentioned earlier, represent an opportunity to open up those markets to a broader segment of our society and to make available to individuals who have fewer dollars a fairer interest rate, a real yield on their savings, which they might not otherwise have access to. I mean, if you're a merchant in Taiwan and you have savings, how do you get yield on those savings? If you're a doctor in Nebraska and you have savings in your bank account, they're paying you 0.06%. That's not a market rate in terms of interest on your money. And blockchains represent an opportunity to open those up to fair market rates and real market rates for each one of those individuals.
Does that mean bad things for the legacy banks?
I believe that the legacy banks are smart enough to acquire and partner and evolve their business models over time to embrace the changing nature of how financial entities make money. If you look at banking over the last 10, 15 years, it's very clear what's happened with the introduction of Dodd-Frank and other regulation. Interest rate competition has been introduced into the market. And so the revenue that banks have made from interest has basically been cut in half. In response, what they've done is they've basically doubled their fees. And so they nickel and dime the consumer on these little things that nobody pays attention to, but add up over time. Eventually, that game is going to run out and true market rates. What can you borrow for at what rate? What can you earn on your deposits at what rate? Those will be made available to consumers without the required on-ramp associated with establishing a bank account.
Right.
You will be able to access those rates through DeFi protocols powered by blockchain technology.
All right, as we wrap things up here, I got to ask you some personal questions. And of course, that means I got to ask you about Michael, your older brother, Michael Dell, CEO of Dell. What was it like growing up with Michael? And what about it do you think contributed to the success of both of you guys, your household?
Well, my mom used to like to say that she had 3 boys and she left out food for 2. Michael was always a young man in a hurry. He was always tinkering with something, doing something, working on something, and he was pretty good at figuring things out. And so, I've been very fortunate to have a front row seat to one of the great entrepreneurial success stories in our country's history, and couldn't be, more proud of my brother and what he's done.
Right. Okay. And so, are you still working with him? I mean, you're in touch with him. You guys talk. What's your relationship like today?
We talk a lot, and I just saw him, and he's doing well and working hard and enjoying his role as the CEO of Dell.
Yeah, and it's just watching that kind of come and not go, but it sort of had these different chapters, I guess is how you characterize it, right?
Yep.
All right, and so you've now founded a bunch of successful companies yourself, Adam, and you've sold some to different entities. What have you learned, and what are some mistakes you've made? What are some things you've learned along the way?
Yeah. Well, one is that if you are solving a fundamental problem with a technology solution that appeals to the end customer, that's a pretty good formula. And so I've tried to focus on finding market problems and solving them with technology. The second, and this won't be any deep insight, but it's all about the team and the quality of the people around the table trying to solve the problem you're trying to solve. And so I really focus on that. I'm very proud of the team we've put together at Domain Money. About 25 of my former colleagues from Goldman Sachs chose to join me in this new adventure. And in addition to those folks, we've hired Brad Olson, who is the head of content for Seeking Alpha, the head of trade ops from Cantor Fitzgerald. We hired a COO who ran the crypto business for SoFi. We've established a really solid team that is very focused on our mission, which is to build our customers' wealth.
You have a metaverse part of it, or no?
Well, we will bring additional assets onto the platform over time. I think you'll see us getting into the NFT space sooner rather than later. And so customers can look forward to that in the coming months.
All right, let me know when you get the metaverse thing down.
Okay, I'll let you know.
Headset and go into Domain Money. Final question, Adam. How do you see using your influence on this world?
Well, I don't know how much influence I have other than I like building things. I like catalyzing teams around specific objectives and goals and trying to motivate and set direction there. It is very fun for me to build things. I genuinely enjoy it. I get a real rush out of creating something and then having people use it. And so I'm very focused on making sure that we deliver the best investment platform experience in the market. I remember when Goldman was working on the Apple Card, and there was chatter among the industry and even within the halls of Goldman Sachs, what does the world need another credit card for? And if you've ever used the Apple Card, it's really a delightful, unique experience. And I think the same opportunity exists in investment platforms where there are real improvements that can be made in the customer experience, the customer support, the education process, the journey that we take customers down as we help them try to make better investment decisions. And so I'm very focused on that as well as the rest of the team.
Adam Dell, VC and founder and CEO of Domain Money. Thanks so much for your time.
Andy, thanks for having me.
You've been watching Influencers. I'm Andy Serwer. We'll see you next time.
A housing market slowdown. It's coming up next. Welcome back to Yahoo Finance Live, everyone. We've struck the top of the 10 a.m. hour. I'm Brad Smith with Julie Hyman. Brian Sazia is on assignment, and we're going to take a quick look here at the markets as we are about 32 minutes into trading right now. The Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite, all on this Fed day, are higher by about 0.6% for the Dow and the S&P 500, 0.4% for the Nasdaq Composite. We've also got some breaking news on the housing front. For that, I'll toss things on over to Julie.
Yeah, existing home sales here is falling for the 7th straight month. This is the August figure. However, they're not down as much as estimated, down by 0.4%. The annualized pace now 4.8 million. It's still the weakest since May of 2020, but it's not as bad as the 4.7 million that had been anticipated. Of course, we all know what's going on with the housing prices. What is going on with the housing market? What's putting pressure there? It's that we are seeing an increase in mortgage rates which hit above 6% for the first time in more than a decade. That is definitely affecting affordability and affecting the ability of people to buy homes right now. So again, we saw a decline of 0.4% month over month in existing home sales. By the way, that figure is 17.4%, a dip of 17.4% if you look at the year over year figure. So all of this interesting as we look at the housing market and how it feeds into the broader economy. Let's talk about that now. Joining us to discuss is First American's Deputy Chief Economist, Odetta Kushi. Good to see you, Odetta, as we look at these numbers. Interesting that we didn't see more of a drop, but just sort of high level, how would you describe the state of the housing market right now?
Well, it's great to be here. So there's a demand and a supply side to this story. Clearly on the demand side, buyers have pulled back from the market as affordability has quickly deteriorated and mortgage rates have hit above 6%. On the supply side, you can't buy what's not for sale, and sellers are sitting tight right now because they're locked into these historically low mortgage rates and they don't have a financial incentive to move. And so we're finding that sellers aren't selling, buyers have pulled back, and that's resulting in housing market that's cooling quite a bit.
And on the other side here, I mean, I guess holistically, I should say, you've got home buyers or prospective home buyers who are still looking for where they could find inventory, where they can find a home that they can compete with on an offer. And if they're not able to do so, that they're staying in the rental space. Redfin actually had just reported asking rents climbing 11% in August. And even though that is the smallest gain in a year, it still does go to show that you've got some prospective home buyers that are still impacting the rental market and the renters out there that are still having to take on the burden of some of the higher prices.
Right. So renters have a tough decision. If they're interested in buying, affordability is down. And to your point, inventory, particularly at that starter home price range, is still incredibly limited. We're still facing historically low levels of inventory in a housing market that's underbuilt. And so they're facing higher rents and higher home prices, reduced affordability as well. So they're certainly in a tough spot. We are seeing rent growth start to decelerate. Similarly, house price growth is decelerating as well. So that's some welcome news for those potential home buyers.
You know, like so many other things that we saw during the pandemic, Odetta, it feels like that this is a rebalancing to a more quote unquote normal level, perhaps. But I don't know what normal looks like anymore. How long do you think this process is going to last? And to you, what does a normal, what does a normal median home price look like? What does a normal existing home sales pace look like?
It's a great question. So, double-digit annual house price growth is not sustainable. So the market of the last 2 years is the exception, not the rule. It was an incredibly hot seller's market. You could argue we're still in a seller's market across many top markets across the country, certainly not as competitive as it was early in the year or last year, but still very much in a seller's market. I think you'll start to see house price deceleration to more reasonable pace. Historically, it's been about 4 to 5%. Mortgage rates are actually, believe it or not, right in line with historical average, if not a little bit below. So the housing market just needs to adjust to this not so new normal of higher mortgage rates, slightly slower sales pace, and more moderate house price growth.
And so for the prices that even new homeowners are looking at or trying to get into right now, I guess I think, and I'm kind of thinking on my own personal level here a little bit, but, you know, even for those of us who are just looking to get into their first home, you know, this could have a much larger implication on households' ability to build equity and build wealth over time too, even if they are priced out of the housing or buying opportunity right now. Do you have a sense of what that implication could look like more long term?
So there's still this fundamental demand for home buying in the United States. There's this massive generation of millennials that continues to age into their prime home buying years, and they are buying later in life compared to their generational predecessors. So it's really a question of when, not if. These home buyers are currently, or potential home buyers are sitting on the sidelines right now, waiting for the market to adjust, waiting for prices to rebalance to a point where their monthly payment is affordable. And when that time comes, they'll jump back into the market. So maybe delayed wealth building, but certainly not foregone.
All right.
Odetta, good to see you. Thanks so much. Odetta Koshy, First American's Deputy Chief Economist.
Thank you.
All right, let's talk more about what's happening in the markets right now. Yahoo Finance's Inez Frey's over at the Wi-Fi Interactive watching the action today. What's going on?
Yeah, Julie, and stocks are drifting higher. Of course, we do expect to see more fireworks today at 2:30 after Jerome Powell speaks, and also sometimes the day after Fed Day is where you see a lot of fireworks. But right now we're looking at the Dow that's up about 0.5%. You've got the Nasdaq Composite that's higher, and the S&P 500 of about 0.6%. You've got the Treasury yields which have paused the recent rally, so this is helping equities. So you're looking at the 10-year Treasury at 3.53, down about 4 basis points. Also, the U.S. dollar index is at multi-decade highs, so this is putting a cap on how high equities are going. Because remember, we have seen recently that correlation where when the dollar goes higher, you're seeing equities go lower. But today, a little bit of a different picture because you're looking at industrials, which are higher, and that's because of defense stocks. Those are higher. I'll get to that in just a second. But look at that. Industrials is the leader right now, followed by real estate, consumer staples. You've got energy that's in the green as well. The energy had seen bigger gains earlier this morning, paring back some of those gains. Getting to where we're at with defense stocks, this has to do with the headline about Russia escalating the war in Ukraine. So we are watching defense stocks going higher, and I'm just going to pull up the chart here so you can see some of these gains. Lockheed Martin up more than 2%. You've got Northrop Grumman up also 3%, and also as well as General Dynamics, Raytheon. You get the idea. I'm going to pull up, though, a year-to-date chart because you can see some of the year-to-date gains for these stocks, guys.
Yahoo Finance's own Inez Ferre, a ton to continue to track on the defensive space as well here. Appreciate the breakdown this morning. Guys, coming up, we're going to speak with one analyst that says the Fed has to respond to the upside surprise in inflation. That's coming up next.
Let's get down to business now. A look at the stories in business and beyond you need to know about today. Cable company Charter has been ordered to pay $1.15 billion to the family of a murder victim who was stabbed to death by a cable technician. Now, that technician reportedly made a routine house call to the victim, then returned to the house the next day, dressed in uniform, driving the company van to steal credit cards. The victim was stabbed after she caught that technician. The victim's family says Charter tried to use forged documents to force the claim into private arbitration rather than court, and also alleged they were negligent in checking the technician's background. In a statement to Reuters, Charter maintains it was not liable for the incident since the employee was off duty when he murdered the victim. Employees at a Philadelphia Home Depot are taking the first official steps to unionization. This after a National Labor Relations Board filing on Monday that included 274 employees in merchandising, operations, and other roles. Previously, a Home Depot location in San Diego saw 60 employees unionized, but that was back in 2019. The most recent action in Philadelphia comes as a wave of unionization grows across the U.S., hitting large corporations like Starbucks, Chipotle, Apple, and others. And Italy is taking Eataly on an expanded world tour. The Italian food-focused grocery retailer and importer is selling a controlling stake to Invest Industrial. That's a European private equity firm known for helping businesses expand overseas. It also has stakes in things like Ducati. The deal increases Eataly's capital to about $198 million and will see Invest Industrial take a 52% stake in Eataly. The grocery chain currently has locations in the U.S., UAE, Japan, and Brazil, as well as Italy itself. Brad?
Consumer take, they have great prosciutto there, Julie. Well, we're continuing to watch markets ahead of the Fed, with markets holding on to some gains here this morning for the U.S. major averages. The U.S. Fed isn't the only central bank on our radar, with most around the world actually raising rates. Sweden's Riksbank, most recently hiking its own rates to keep up with the ECB. All of this as the U.S. dollar remains strong. For a global view, let's bring in Krishna Guha, who is the Evercore ISI Vice Chairman, Head of Global Policy and Central Bank Strategy. Thanks so much for joining us here this morning. First, going into this meeting, your expectations, and will the U.S. Federal Reserve and the FOMC committee, will they be kind of in lockstep, do you believe, in terms of their aggressive nature, perhaps, with the rest of the world?
So it's great to be with you. Thank you for the invitation. Look, all the major central banks in the world, outside China and Japan, where there's some special considerations, all the others are jacking up rates aggressively. Fundamentally because everyone is grappling with some version of a serious inflation problem. And the detail of that differs from one country to the next. So does the tactics and strategy that the central bank is using. But the trend to rates are moving quickly higher and then prospectively staying there for longer, that is certainly a global trend. And we fully expect the Fed's going to be taking its further step in that journey today.
And so how many steps is it going to take, I guess, Krishna, in the case of the Federal Reserve? The debate now seems to have moved from what are they doing at this meeting with the broad expectation at 75 to where will they end? What will the terminal rate be? Because we've really seen expectations move up.
Yeah, that's exactly right. So what I've said is that the Fed absolutely has to respond to the latest inflation news, which is really bad. Along with evidence that there is more momentum, more resiliency, particularly in the labor market to some degree, in spending as well, than might have been anticipated by this stage. So the Fed has to do more on rates, but I think it does get to choose how it does more. And I certainly think and have argued strongly that hiking by 100 basis points rather than 75 at this meeting is probably not the best solution here. What we expect them to do is indeed to signal that the path of rates from here is going to go higher and stay there for longer. So, that interest rate dot plot that they publish 4 times a year, we get another one of those today. I think that will show rates going to 4 and change the end of this year and point to rates, knocking on 4.5% next year. I think the message will also be that rate cuts are a long, long way out. No rate cuts next year, only moderate rate cuts in 24 and 25. Why? Because they expect inflation to be coming down, but will be coming down only gradually over those years ahead.
Given that you track the global picture here too, I mean, this comes up at least, every day, I should say, within this conversation too, is not just what's in the Fed's control, but also what's out of the Fed's control. And what's out of the Fed's control is things like energy prices, is things like the supply chain, and that supply chain being a global supply chain, even though there are efforts right now to bring more of that domestically here in the U.S., in the near term, that's still going to be a very global part of the equation that the Fed does not have control over. Is there any signs that is improving from your perspective?
So first of all, you're exactly right to say that this is a particularly difficult situation for the Fed, as for most of the other central banks, because a lot of the shocks that are hitting the economy are on the supply side rather than the demand side first. And secondly, that a lot of those supply shocks are global in nature. They relate to the pandemic, or they relate to Russian war in Ukraine, or other factors. And so they aren't the sort of things central banks are used to dealing with, or particularly good at forecasting. So that certainly makes it an additionally difficult time. Now, the right approach for the Fed to take in this environment is to say, on the one hand, look, we don't control where the gasoline price will be next week, next month. If Vladimir Putin decides as part of his energy war, he's going to, for instance, cut Russian oil production to try to generate an oil price spike. There's not a lot the Fed can do about that directly, and it's a massive but, on a 2 to 3 year type horizon and beyond, the Fed owns inflation in the US, period. And the Fed has the instruments, has the capacity, needs only the will to actually use those instruments in order to return inflation to an acceptable trajectory on a 2 to 3 year horizon. So that's the balance here to strike. They don't control inflation on a month-by-month basis. They do control inflation on a 2-3+ year horizon. That's the message that we will, I think, want to need to hear from.
It's interesting that you talk about that 2 to 3 year time horizon, because Elon Musk, of all people, was tweeting about the Fed the other day and talked about the problem with the Fed is its latency, is the fact that it takes its policies quite a long time to take effect and start to have more of an effect on inflation. And there have been folks who have argued for that reason, the Fed should wait. The Fed shouldn't be as aggressive because some of these issues will sort of take care of themselves without the Fed's help. How do you view that argument?
So I'd say a couple things. First of all, I think the Fed has no choice but to err in the direction of doing a bit too much, because the cost of allowing a high and variable inflation to become embedded in the US economy is greater significantly than the cost of causing a recession or trying to cause a recession. But if you had to pick, you would pick a recession over a return to the 1970s. But, and it's a very important but, second point, is that I think they still do have a responsibility to choose a strategy that gives them the maximum possible chance of restoring price stability without causing a recession that might not have been necessary. And I do worry that if they carry on moving in these big 75 basis point type increments, they risk outrunning the time lags with which their policy choices affect the economy. They risk outrunning, therefore, their ability to learn from the data, and the risk that they do make a policy mistake that causes a recession rises substantially from here if they can't find a way of getting off the hamster wheel of 75 basis point increases.
Some of the most bullish banks on Wall Street, they've shifted their tenor from it being a Fed pivot to it being, they could pull off a soft landing. Do you believe that there is credibility to the likelihood of a high probability likelihood of a soft landing, or should we be expecting something different?
So first of all, I think it's important to distinguish between is a soft landing possible and separately is a soft landing probable. So there are some very eminent economists who I respect greatly who would argue that at this point a soft landing is close to impossible. I don't agree. I think there's a lot that's unique about this pandemic business cycle. There are many factors that have driven prices higher. Some of them do represent classic imbalance of demand and supply. Others look like they are indeed one-time factors that will dissipate, fade away of their own accord on some horizon. So I think it is possible that we will be able to restore, price stability, restore an inflation rate closer to 2%, without necessarily having to have a full-blown recession. Second question is, how probable is that? And I think the probability moves up and down as we get new information coming in. I've sort of felt most of the year that probability is moving between 60-40 one way and 40-60 the other. I will say right now I'm feeling a bit less optimistic on the prospects of soft landing rather than more. That's really because this latest inflation data puts a bit of a gun to the Fed's head. It suggests there's some, indeed, greater likelihood that we just can't fix this without a recession. But over and above that, it increases the risk that the Fed ends up oversteering and causing a recession that might or might not have been inevitable. So that landing zone, if you like, for that soft landing, it's looking quite narrow right now.
Yes, ever narrower it feels like. Krishna, thank you so much. Krishna Guha, great to get your perspective as always. Evercore ISI Vice Chairman and Head of Global Policy and Central Bank Strategy there. Well, we're going to take a quick break. When we come back, 7 bank CEOs are facing questions from the House of Representatives on the state of the economy and impact of inflation. We'll have the latest from that hearing next. Jamie Dimon, Jane Fraser, and other bank CEOs currently on Capitol Hill for their annual grilling by lawmakers. It's funny that's happening the same day as FOMC Day. On deck for today, discussions on the economy, consumer protection, fossil fuels, firearms, and more. Yahoo Finance's Alexandra Semenova is watching closely. I don't think it usually happens on the same day.
Yeah, I mean, today's hearing certainly fell into the shadow a bit with all eyes on the Fed, but this is still a big event with the leaders of some of the biggest banks in the U.S. set to be grilled by by congressional leaders. Now, typically the purpose of these testimonies is to discuss topics like consumer protection, compliance, racial inequality, and those things will certainly be addressed. But given the macroeconomic backdrop, it is inevitable that we'll be getting a lot of remarks on the economy.
To Yahoo Finance Live this Wednesday, September 21st, we have breaking news. We are moments away from the Fed's decision on interest rates. Wall Street widely expecting a 75 basis point hike. Taking a look at how the market is trading ahead of that announcement from the Fed. We have all three of the major averages holding on to gains. The Dow up just short of 200 points. Taking a look at the S&P, bouncing off the lowest level that it hit in just about 2 months, although still trading below that critical 3,900 level. Taking a look at the Nasdaq, also moving to the upside here, up just about 0.7%. Again, a lot of the action that investors are closely watching going on in the bond market. You can see the 10-year yield stabilizing a bit here, but the big story was a 2-year yield topping 4% for the first time since 2007. Taking a look at the U.S. dollar, heading for another record here, so keeping the gains here in equities in check. Real quick, the sector action today, Rochelle, all 11 of the S&P sectors moving to the upside. We're seeing consumer staples leading the way on the heels of the earnings results that we got from General Mills ahead of the bell.
So we're certainly seeing some enthusiasm ahead of this announcement, and we know that the Fed has said, look, we're going to do whatever we have to do while keeping an eye on the data when going forward with our decision. They've really seemed comfortable with equity markets falling and having the U.S. unemployment rate ticking up if it means that they can really get inflation under control. They've been sticking to their guns. We saw that Fed Chair Powell remained hawkish earlier, saying that we need to act now forthrightly, strongly, as we have been doing. And obviously that was before they went into their quiet period ahead of the decision. But he said, don't get used to those jumbo rate hikes, but we're still expecting one today.
Yeah, indeed. It will be curious to see how long they intend to stay high. The Fed decision is out. Yahoo Finance's Jen Schomburger has the details for us. Jen, are you ready for us? Or are we not quite there, guys? All right, not quite there. Let's
75
continue.
basis point rate hike. The Federal Reserve raising its benchmark interest rate by 0.75 percentage point to a new range of 3 to 3.25%. Fed officials see raising the Fed funds rate higher and holding it there longer. Looking ahead, by the end of this year, they see the Fed funds rate ending the year at 4.4%, and they see the Fed funds rate ending next year at 4.6%. That's higher than what projections were in June, when the Fed funds rate was projected to end this year around 3.4%. And next year by 3.8%. It's not until 2024 that Fed officials see rates starting to come back down. At that point, though, 3.9%. So that would actually be higher than previously forecast back in June. Now, why is this the case? Well, Fed officials see inflation remaining high this year. They actually raised their forecast for inflation to 5.4% overall, a faster clip than previously forecast. Excluding volatile food and energy, they see 4.5% on inflation this year. They still see core inflation remaining at 3.1% next year, not coming back down to that 2% range until 2024. Some heightened inflation here. Now, as far as the unemployment rate is concerned, they see the unemployment rate at 3.8% this year. That's up from previously forecast, rising again to 4.4% next year. The Fed did upgrade its economic assessment of the economy, saying in the statement that indicators of spending and production point to modest growth. That is an upgrade from having softened back the previous meeting. Now, the Fed, though, did downgrade its outlook for the economy. It only sees GDP at 0.2% growth this year before rebounding back to 1.7% next year. Guys?
All right, thank you. Our Jen Schomburger there, giving you that breaking news there. The Fed, they're raising interest rates there by 75 basis points. Well, for more on the Fed's decision, let's bring in Principal Global Investors Chief Global Strategist Seema Shah and Wells Fargo economist Michael Puglisi. Thank you both for joining us. So first, I want to get your reaction, Seema. 75 basis points, largely what the street was expecting. But what are you keeping an eye on? What are you hoping to hear from Fed Chair Powell later on?
Thanks. Well, I think we need to hear, what is his tone? Right? Is he going to continue to be hawkish? Does he mention anything about trying to force the unemployment rate higher in order to reduce inflation pressures? The dot plot and the summary of economic projections has given us a good hint at the kind of state of Fed hawkishness. It seems actually to be beyond even what the market was anticipating. But I think we're just looking to see further color, see how they are considering the labor market, and just a hint of how much further they really need to go and how long they need to hold rates for.
And Michael, your reaction now to the 75 and, of course, the 4.6 Fed funds rate by the end of next year.
Yeah, I mean, it comes across to me as hawkish. So I think even more than the 4.6 at the end of next year is the 4.4 for this year. I mean, that implies a pretty substantial amount of tightening through the end of this year, probably, something along the lines of another 75 in November and maybe 50 to end the year. So when you think about how we began this year, right, the Fed was still buying bonds at the beginning of this year. We're now talking about a 4.5% Fed funds rate at the end of this year, and then sustaining that all the way through next year and well above neutral through 2024. So, I think it's very hawkish. It's even more hawkish than the market was priced for, and it had moved quite a lot in recent weeks. So I think it just goes to show that Chair Powell and the Fed is putting its weight behind this inflation fight.
And that's a big reason why we're seeing all three of the major averages now in negative territory. The Dow off 142 points. Mike, just in terms of the strength of the economy right now, is the economy going to be able to absorb this aggressive of a Fed?
I think it could absorb it in the near term, but we put a recession in our forecast all the way back in June. And so we've been looking for a 2023 recession starting, spring, summer of next year for a few months now. And I think the case for that is really only strengthened. I mean, there's some near-term momentum here as gas prices have come down and consumers have continued to lean on their pretty healthy balance sheets to sustain consumption. But the question for us really is, how long will that last? I mean, month in, month out, as the weeks turn to months, turn to quarters here, in the face of this much tighter monetary policy, in the face of the fading fiscal policy stimulus that we got last year, earlier this year, will we still be in such a robust economic environment 12 months from now? I think the answer is no, and I think you're starting to see that reflected more and more in the Fed's own economic projections.
And Seema, what's your take on whether or not we'll hit a recession and whether it will be perhaps this year versus next year?
So I don't think it's going to be this year because, as we've just heard, consumers have been generally quite resilient. And of course, the labor market especially is extremely tight. It's very unlikely to see a recession when the labor market is as robust as it is now. But I do think that what the Fed is essentially trying to do is almost engineer a recession. It's almost the only way that they would be able to push down inflation. When we think about recession, yes, they keep going until they have raised the unemployment rate sufficiently. And unfortunately, that implies that a recession is almost inevitable, I think, next year.
Okay, Michael. So is there any concern that there was just too much, too fast at this point by the Fed, not letting the medicine take hold?
Yeah, I think there's concern there. I mean, monetary policy, somewhat famously acts with long and variable lags. But I think the way the Fed thinks about it is, inflation is still so high at this point. If inflation was 3% or 3.5%, I think they might be willing to look at it a little more symmetrically and say, well, that's only a point and a half above our 2% inflation target. Let's digest this pace of tightening. But when you're running at, an 8% year over year and 6 or 7% on a 3-month annualized rate through core inflation, and when it's been this high for going on a year now, I think the Fed looks at this as no longer a symmetric situation. And so you certainly run the risk of going too far too fast, but I don't think the Fed is there yet, and neither do we. I think there still needs to be more policy tightening to get this inflation in check from what is well above the 2% inflation target where we are right now.
Seema, just your reaction on what we're seeing play out in the bond market right now. We have the 2-year rate here surging to 4.11. Obviously, the 2-year most closely tied to Fed policy, what we could potentially see play out here in the economy over the coming months. Just what's your assessment of the strong move up that we have seen in yields, especially at the shorter end of the curve?
Right. Well, I think it has to be expected that this kind of move would happen when you see the Fed as aggressively hawkish as they're conveying in today's decision. From here, we think that there could even be further movement up on the 2-year if inflation continues to be extremely stubborn. But on the 10-year point, we think that it can stay relatively elevated, kind of where it is today. But then as you get closer to that economic weakness really starting to come through, and recession comes into view as well, at that point, you could see some downward pressure on 10 years. But at this stage, there's very, very little to push it down as long as the Fed is hiking and the economy stays robust for the time being.
And Michael, speaking of robust, as we look at the sector action, it's really only consumer staples now in the green after this announcement of the 75 basis point hike. How important is the consumer going to be in terms of what happens going forward, especially when you look at things like earnings?
Oh, I mean, it's tremendously important. You know, consumption is 2/3 to 70% of the U.S. economy, and so that remains the big engine here. As you've seen other parts of the economy, be it residential investment, or obviously there are a lot of problems abroad when it comes to global growth, and consumption has been really remarkable when you think about all the challenges we've had this year, starting with the Omicron COVID wave back at the beginning of this year, over the winter, through of course the commodity price shock that we got, and just the inflationary pressures more broadly, and the many hurdles that consumers have had to jump. We've still seen decent real personal consumption growth. But of course, that has been sort of on the back of this very strong labor market. Month in, month out, we've been adding hundreds of thousands of new jobs a month. I think the question really going forward is, as those tailwinds start to fade, as you're not seeing job growth like that, if unemployment rises next year like we expect, and like it sounds like the Fed expects, is it really realistic to expect consumption growth to remain very robust? I'm a little bit skeptical.
And Seema, what do you want to hear from the Fed chair today? And specifically, how do you think he'll address the pain ahead for the labor market, to Michael's point?
Well, look, I think we have to think about this. For the Fed, this is going to be a very, very difficult time. And certainly for the U.S. economy, it's going to be extremely challenging. But they need to hike rates very aggressively now in order to ward off an even worse scenario later on. So in a way, I think what we're hoping to hear from Powell is almost him invoking his inner Volcker. And talk about the inflation fight, something that it is pernicious. It has to be done, that they need to achieve this price stability. And I think by doing that, unfortunately, along the way, that does mean that the unemployment rate is going to rise. And they have to acknowledge that there will be pain, but it's something that they have to go through in order to hit that price stability target, which is of the utmost importance.
All right, Seema Shah, we will check in with you in a little bit, so if you could hang with us here. Michael Puglisi, thanks so much for joining us here this afternoon. Well, again, let's take a look at the rates here in terms of treasuries, because we're seeing some movement in the yields. The 10-year yield spiking to the highest level that we have seen in just about 11 years. The 2-year yield now at just around 4.11. Again, the highest that we have seen since at least 2007. We want to bring in Ellen Gask. She's PGIM's fixed income lead economist. Ellen, it's great to see you. In terms of your reaction, what we just heard from the Fed, what we just got from Jay Powell, a 75 basis point hike, is that enough?
Well, the 75 basis point hike today was expected. I think, though, their projections, it looks like they pulled forward their expected rate hikes a bit from what we and the markets were expecting. They've got basically another 100 up to 4.5% by the end of this year, a little higher than we had expected, and critically signaling that they expect the funds rate will stay high, maybe even move a bit higher next year as well. So persistently tight policy here through the next year and a half. So it was a little more aggressive, I think, than expected. The unemployment rate a little bit higher projected from the Fed than I had anticipated. So they are signaling they are serious about this. Critically, though, if you look next year with a 4.6% Fed funds rate they're projecting, they're also expecting inflation will moderate. The PCE deflator, their preferred measure, down to 2.6%. That means next year, their funds rate will be outpacing inflation finally. They will be sufficiently restrictive.
And a lot of people wondering what this means in terms of GDP projections that are out now. What's your take on what we can expect then, given some of the pressures that the Fed both can and cannot control?
Yeah, so it was expected that they would bring down the GDP forecast for this year down close to zero, which they did. By the way they measure it, they look at fourth quarter to fourth quarter growth rates. Last year's fourth quarter was extremely strong. Since then, the economy's been a bit treading water, as we know. So if you compare fourth quarter of this year to last year, it's going to look about flat. But underneath that, underlying that, I think the household sector in aggregate is still in really good shape. We know that their balance sheets in aggregate are good. And corporates, critically, businesses, profits have been more resilient, margins more resilient than expected. Companies have been willing to continue to spend, hiring, investing in equipment and software, much needed investment in the supply side of the economy that's going to ultimately be part of the solution to these high inflation pressures. So overall, there's a chance here still for a soft landing, but the Fed is moving so rapidly against rapidly changing domestic and global conditions. Admittedly, the risks of recession are elevated at this point, and given the aggressive pace of the Fed and other central banks, recession risks are now higher. The soft landing, that's a very fine needle that has to be thread here.
What does the Fed need to accomplish that?
Well, I think we need to see some rollover in these inflation pressures, a natural rollover that I think we've been seeing nascent signs of, but inflation has been more persistent than expected. We had an inventory cycle now finished playing out. That put pressure on production and demand while companies were restocking shelves alongside households and businesses reopening and the COVID boost from them. But that's now played out. The fiscal stimulus has played out. The drag from its end has also now played out. So I think the very volatile fiscal policy should dissipate, and that would go a long way, I think, also to put us on an even keel here. But again, the global backdrop is one of elevated risks. Global energy prices right now, they're cooperating with demand destruction from China, from Europe. The softening of energy prices, oil prices is really helping U.S. consumers, but that is at risk here this winter going forward. So it's going to be challenging. It's not impossible for a soft landing, but certainly challenging.
And I guess what I was getting at, Ellen, is beyond their control. Let's say an end to the hostilities in Ukraine, the COVID China lockdowns. Is there something that could change this equation dramatically for the Fed?
Yeah, so I keep looking towards what's going to happen to companies and they're willing to invest. To me, that's the long run solution here that would boost growth and dampen inflation pressures. If the Fed hits the brakes so hard here that companies start to pull back and pull back quickly, hiring not just slows but really dries up, the labor market is decimated. That means that the supply side of the economy it is really going to freeze up. And that's something that's been so different in this cycle. The challenges on the supply front. The Fed trying to dampen demand conditions has to be careful that it doesn't inadvertently too much dampen the supply side. The housing market is a key example where the froth is coming out of it. We've seen existing home sales decline now 7 months in a row. Demand is slowing, but it's been a tight market for over 10 years now, very challenged in terms of supply. And Fed tightening could inadvertently slow down much needed additional new housing to feed into the millennial Gen Z demand. Similarly in the labor market, a softening would help wage pressures soften a bit here, but a strong labor market helps pull people off the sidelines. Much needed additional labor as boomers are hitting peak retirement years. So the trick here is to not tighten so much that it discourages much needed additional labor supply. Infrastructure in terms of the production and distribution of goods. We've seen that be still challenged. Mm-hmm. There's a lot of investment that needs to take place in this new environment. And again, the Fed's got to be careful here. If the Fed does achieve the soft landing, it's that supply side that I look to. It's companies willing to invest on an ongoing basis that holds open the possibility for a longer expansion than most are anticipating now.
Well, and we'll hear from Fed Chair Jay Powell in just about 13 minutes from now. He has been optimistic that the Fed will be able to get inflation under control. From your view, when do you expect to see a significant, meaningful decline in inflation?
Well, what I'm looking for primarily is how broad-based the inflation pressures are. And we did for 1 month see the breadth decline. And that to me was a hopeful sign, but that went out the window with last month's print. So I'm looking for continued high inflation in rents, homeowners equivalent rent. That's something that's baked in the cake that will stay elevated for a while. But offsetting that, I want to see softness in goods prices. The seeds have been sown for that. Shelves have been restocked. The Fed has tightened a lot. It's hard for consumers to run up a credit card and not pay a higher interest rate. The seeds have been sown for a softening in those goods prices. That's what I'd be expecting to see going forward. It may take into next year, which is what the Fed is signaling they expect. So that keeps the Fed in hiking mode from here.
A long hike ahead. Ellen, appreciate you. Stick around for us if you would. Andrew Levin now with us, former Federal Reserve Board Special Advisor and Dartmouth College economics professor. Good to see you, sir. What surprised you, and specifically what surprised the markets, a dramatic turn upon the news?
Well, I think as some others have said, really this more or less moved rate hikes that the markets were thinking were going to happen next winter or spring now looks like might happen in the next few months. But the markets as of yesterday were already expecting the Fed funds rate to reach around 4.5%, plus or minus a quarter. So I don't actually think that part changed. What I'll tell you, I'm surprised by is the Federal Reserve has been repeatedly making the same mistake now for a year and a half, which is at every point in time to assume that inflation's about to start heading downward. And of course, it's possible that that's a really benign outcome. But I think, for example, their projection for the core inflation rate, excluding food and energy, is that that's going to head downward from here over the next few months just to the end of the year, and then really head down much further next year, so that they're already within striking distance of the 2% inflation target within the next year or so. That's a very benign view. And the risk scenario, which I think is very material, is that core inflation still heads upward further in the next few months. Housing rental costs are going up. Wage compensation, especially in healthcare, is going up. The service sector is really booming. The slowdown that people talked about is mostly in some of the goods sectors, and the supply chains are really relevant for goods. So if the Fed is surprised yet again, and core inflation is actually continuing to head upward instead of down, we're not done. The Fed's going to have to do further rate hikes next year.
Well, Andrew, just looking out to the November meeting, if you take a look at the dot plot right now showing 10-9 majority in favor of hiking above 4.25% this year, making it seem like 75 basis point hike in November is on the table. It sounds like you think that that makes sense then.
I think that the Federal Reserve's responsibility is risk management. Now, economists generally think that what really matters for the economy is the interest rate relative to the level of inflation. So that means if inflation's running at 4.5%, 5%, and workers and their families and small companies are expecting inflation to continue at 5%, then even a 3% or a 4% interest rate is not actually that tight. And this is, again, the mistake the Federal Reserve's been making for the past year, and it looks like they may be making again. I think there's a real risk here that the economy will stagnate for sure, almost certainly, over the next year or two. A combination of high inflation and these global developments, high energy prices and so forth. But we should not be thinking that monetary policy is very tight yet. It isn't. And probably, in my view, there's a very significant chance that it'll need to be tightened very substantially beyond what the Fed has unveiled today. Market participants should be prepared for that possibility. The Fed still has quite a ways to go.
And we did hear earlier from Cleveland Fed President Mester this month cautioning over declaring victory over the inflation beast too soon. Or he also downplayed, though, suggestions that the Fed would cut interest rates in early 2023. Is there a disconnect between what the markets are hoping will happen and what the Fed is actually trying to tell people is actually happening?
Well, to be honest with you, I think what I hope will happen at the press conference today is for Chair Powell to explain more clearly what the Fed's strategy is. It's not enough for President Nestor, she's great, but for one bank president to stand up and talk in a speech, the Fed itself needs to have a clear strategy and contingency plans, and they should do it right away. If inflation comes down the way they're hoping in these projections today, then maybe they can be close to declaring victory, sometime next year. If inflation stays high at 5% plus, they're going to need to do more, and he needs to prepare the markets and the public, for that possibility as well as the benign possibility.
And Andrew, as we put a bow on this thing, you've spoken several times about the repeated mistake from the Fed. So what will make you feel better? What would you like to hear from the Fed chair today that might give you a little comfort?
Okay, people keep talking about the Volcker spirit. Okay, the Fed in the Volcker era raised the federal funds rate up in the teens. Okay, imagine a short-term interest rate in the teens. Up, I think the maximum was at 20%. And the unemployment rate had to rise to 10 percentage points to bring inflation down. The Fed's projections today, the unemployment rate goes up just by a little teeny bit, still below 4.5% at the peak. That's very, very mild. I think what Chair Powell needs to prepare the public and the markets and elected officials for is that a lot more tightening may be needed, and that in order that's critical to bring inflation back to the target over the next several years. That their work is nowhere close to being finished.
So then if inflation does remain stubbornly high despite this 75 basis point hike, how much wiggle room does the Fed actually have from this point on?
They have none. They need a plan. They need contingency plans. They need to explain how much further will they go if inflation stays at 5% plus. The projections they released today is a baseline. Okay, that's what they think may be the most likely. We're going to debate about it. Okay, but it's a very benign outcome where inflation already starts heading down very quickly and gets close to their target within the next year or so. And I think they need to address the material risk that inflation stays stubbornly high, which is the service sector is critical to consumers. It's critical to the economy as a whole. And the service sector is where the labor market's very strong right now. And where nominal wage growth is very, very rapid. And so the Fed's going to have to move far enough so that the service sector actually starts to slow down.
Certainly a space we'll be keeping an eye on. A big thank you there. Andrew Levin, former Federal Reserve Board Special Advisor and Dartmouth College Economics Professor. Thank you for joining us this afternoon. All right, well, let's bring back Seema Shah and Ellen Gasky as we await Fed Chair Jerome Powell's remarks. Obviously, a lot hanging on the words that we're going to hear. So, Seema, first starting with you, though. As we try and digest, we see the markets really trying to digest this 75 basis point hike, but waiting to hear from Fed Chair Powell. Do we get a sense of where the markets might go from here in terms of how they're taking on this new rate hike?
So I think, I think the first thing is that the market is, I think it's finally settling in, that the Fed really has a challenge in front of them, and they are absolutely dead set on making sure that inflation is stamped out. I'm not sure, though, that actually the dot plot goes far enough. I think the Fed has made a very good attempt at getting ahead of the market for the first time actually since the inflation problem started. But if core inflation doesn't fade like they are expecting, then we could be looking at even further hikes beyond what the Fed is talking about here. I think also listening to Powell, how does he talk about labor market? At the moment, as we just heard from Andrew, their forecast for unemployment rate is actually still quite modest. So how does he talk about this? And is he conveying the fact that, look, there will be economic pain, but it is something that they need to go through in order to clamp down on inflation?
Ellen, what is your assessment of the labor market? Because as Seema was just saying, Powell has said previously that the strong labor market is going to be able to withstand the rapid monetary tightening that we have seen. Do you still think that that is the case?
Yes, so I think in their projections, the amount by which they raised their projected unemployment rate That was a little bit more than what I was expecting. And I see that as a step towards preparing everyone, signaling to everyone that they are willing to do what it takes, lifting that unemployment rate a bit above where they think the long run neutral rate is. That's already a sign to markets. Don't be thinking that we're going to go soft on this. The labor market remains really tight, yet somewhere companies have been finding hundreds of thousands of workers each month to continue hiring. Again, the soft landing would be that scenario softens. I'm expecting at this point in the cycle that companies are pivoting and taking a better look, a sharper look at the mix of all their inputs, labor, equipment, other capital. Last year, it was just a hiring spree to open doors during the pandemic reopening phase. Companies had to hire, had to pay up just to get somebody behind the counter in order to reopen for business. But that mentality, I think, has sharply shifted. And companies now, while the level of job openings remains really elevated, you're not seeing wages accelerate further from here. I think companies are getting a lot more choosy about the skills, the exact match to job openings. Some of those job openings may be a bit stale as well. So I think we've likely already seen a bit of softening. But of course, if the Fed really overdoes it here, you could see a sharp retrenchment of businesses. Then that unemployment rate would go even higher than what the Fed is projecting.
Seema, we are awaiting Jerome Powell and may have to cut you off if his speech begins, but it sounds as though you don't buy the Fed projections of unemployment going to 4.4. You think well north. We've heard projections north of 7. Where do you think it needs to get to drive down inflation? Let's just say to 4%.
So 4.4% is the average of where it was in previous cycles. So actually, that isn't a significant rise. That would be considered as a healthy economy. Actually, I think pushing it up to about the 5% level, the kind of levels that Lawrence Summers has been talking about for time and time again, those are the kind of levels that actually you do start to see an economic weakness coming through, and then core inflation going down in the way that they are expecting. So if they really believe that inflation is going to go down, then they need to be a little bit more honest about what's going to happen to the unemployment rate.
Which is what in your estimation?
So I think to about the 5% level, if not higher. And I think at that point, that's when you start to create the labor market slack, which is sufficient to dull inflation.
All right, well, perfect timing there. We have Jay Powell's press conference getting underway now in D.C. Let's listen in.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level. Inflation remains well above our 2% longer-run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the consumer price index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer-run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Hi, Chair Powell. Thank you for taking our questions. Gina Smilik from the New York Times. I wonder if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
So I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done. So the way we're thinking about this is the overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular to achieve a period of growth below trend and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
Steve.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was?
Is there a point in time you can see pausing? Is it linear that you keep raising rates, or is there? Oh, I'm sorry. I should know better than to not talk with my microphone.
I should know better than to answer your second question.
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what has happened to the economy and give time to catch up in the real economy, the rate increase time to catch up in the real economy? Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold. As I mentioned, what we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now, those will evolve over time, and I think we'll just have to see how that goes. There is a possibility, certainly, that we would go to a certain level that we're confident in and stay there for a time. But we're not at that level. Clearly, today we've just moved, I think, probably into the very lowest level of what might be restrictive. And certainly, in my view and in the view of the committee, there's a ways to go.
Hey, Rachel. Hi, Chair Powell. Rachel Siegel from The Washington Post. Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
Right. So you're right. In the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect, because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. As I've said, there's no basis for complacency there. But to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say, how much these factors will turn out to really matter in this sequence of events, it remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, or rather increase in unemployment, and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be. That's going to depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether, also do we get more labor supply, which would help as well. In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
Just to follow up on one small thing, are vacancies still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding where the labor market is.
Nick. Nick Timmeros of the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know. You look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes. We also, I would think, and you see this this is something we talked about today in the meeting and talk about in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
Howard.
Hi, Howard Schneider with Reuters. Thanks for the opportunity. I just want to be clear on the steps. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
So we make one decision per meeting, and the meeting decision we made today was to raise the federal funds rate by 75. You're right that the median for the year end suggests another 125 basis points in rate increases. But there's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So, we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that, we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly. And that's what we're thinking about.
So just as a follow-up to that, I'm wondering about the sort of risk management considerations here. Given there's some discussion now of overdoing it, what's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is inflation our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Let's go to Colby.
Thank
you. Colby Smith with the Financial Times. Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024? And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I mean, I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Okay, just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so we, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you have to, you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. That's how we think about it.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now, and not something I expect to be considering in the near term. It's just it's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I think a number of things might affect that decision, but the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Neil.
Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination with your fellow central bankers? And is there much risk of overdoing it on a global level?
So we actually, my colleagues and I, a number of my FOMC colleagues and I, just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives, in our case, the dual mandate, maximum employment and price stability. But we regularly discuss what we're seeing in terms of our own economy and international spillovers. And it's a very ongoing, constant kind of a process. So we are very aware of what's going on in other economies around the world and what that means for us and vice versa. The forecast that we put together, that our staff puts together and that we put together on our own, always try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember, there were coordinated cuts and raises and things like that at various times, but really we're in very different situations. But I will tell you that our contact is more or less ongoing. And it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies that are important to the United States are doing.
Craig.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future. And indeed, Treasury rates moved up. So we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient? And does it mean that we might need a possibly higher terminal rate?
You're right, of course. The labor market in particular has been very strong, but there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity and of all different kinds, and housing price increases moving down. So we're having an effect on interest sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening, but you're right. And we've said this. This is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash, so there's good reason to think that this will continue to be a reasonably strong economy. Now, the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that, and that's a good thing because that means the economy will be more resistant to a significant downturn. But of course, we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus. And you see that, I think, in the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Mike, thank you.
Thank you, Mr. Chairman. In a world of euphemisms that we live in here with below-trend growth and a modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions for the American people. Do the odds now favor, given where you are and where you're going with interest rates, favor a recession? 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then given that the data you look at is backward-looking and the lags in your policy are forward-looking and you don't know what they are, how will you know, or will you know, if you've gone too far?
So I don't know what the odds are. I think that there's a very high likelihood that we'll have a period of what I've mentioned is below trend growth, by which I mean much lower growth, and we're seeing that now. So the median forecast, I think, this year for among my colleagues and me was 0.2% growth. So that's very slow growth, and then below trend next year. I think the median was 1.2, also well below. So that's a slower. That's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well. We're never going to say that there are too many people working, but the real point is this: inflation. What we hear from people when we meet with them is that they really are suffering from inflation, And if we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
Well, how will you know, or will you know, if you've gone too far?
It's hard to hypothetically deal with that question. I mean, our really tight focus now continues to be ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
Chris Rugaber.
Thanks. Chris Rugaber, Associated Press. I wanted to follow up with what you just mentioned about the labor market. You've said several times that to have the labor market we want, we need price stability. And you've suggested maybe there isn't a trade-off in the long run. But in the short run, there is a lot of concern, as people have been expressing here, about higher unemployment as a result of these rate hikes, or as a result of the rate hikes. So can you explain, though, what about high inflation now threatens the job market? I mean, you seem to suggest that inflation, high inflation will eventually lead to a weaker job market. So can you spell that out a little more for the general public and how that would work?
So for starters, people are seeing their wage increases, their wage increases eaten up by inflation. So if your family is one where you spend most of your paycheck, every paycheck cycle, on gas, food, transportation, clothing, basics of life, and prices go up the way they've been going up, you're in trouble right away. You don't have a cushion. And this is very painful for people at the lower end of the income and wealth spectrum. So that's what we're hearing from people is, it very much that inflation is really hurting. So how do we get rid of inflation? And as I mentioned, it would be nice if there were, a way to just wish it away, but there isn't. We have to get supply and demand back into alignment. And the way we do that is by slowing the economy. Hopefully we do that by slowing the economy, and we see some softening in labor market conditions, and we see a big contribution from supply side improvements and things like that, but none of that is guaranteed. In any case, our job is to deliver price stability, and I think you can think of price stability as an asset that just delivers large benefits to society over a long period of time. We really saw that for a long time. The United States had 2% inflation, didn't move around much, and that was enormously beneficial to the public that we serve. And we have to get back to that and keep it for another long period of time. To pull back from the task of doing that is you're just postponing. The record shows that if you postpone that, the delay is only likely to lead to more pain. So I think we're moving to do what we need to do and do our jobs, and that's what you see us doing.
Thank you for taking the question, Mr. Chairman. Edward Lawrence for Fox Business. So you had said that Americans and businesses need to feel some economic pain as we go forward. How long from here should Americans be prepared for that economic pain?
How long? I mean, it really depends on how long it takes for wages and more than that, prices to come down, for inflation to come down. And what you see in our projections today is that inflation moves down significantly over the course of next year, and then more the next year after that. And I think once you're on that path, that's a good thing, and things will start to feel better to people. They'll feel lower inflation. They'll feel that the economy's improving, and also if our projections are close to right, you will see that that the costs in unemployment they're meaningful, and they're certainly very meaningful to the people who lose their jobs, and we talk about that in our meetings quite a lot. But at the same time, we'd be setting the economy up for another long period. This era has been noted for very long expansions. We've had 3 of the 4 longest in measured history since we got inflation under control, and that's not an accident. So when inflation is low and stable, you can have these 9, 10, 11, 10-year anyway, expansions, and you can see what we saw in 2018, 19, and 20, which was very low unemployment, the biggest wage gains going to people at the low end of the spectrum, the smallest racial gaps that we've seen since we started keeping track of that. So we want to get back to that, but to get there, we're going to have to get supply and demand back in alignment, and that's going to take tight monetary policy for a period of time.
As a follow-up, what is that economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. Higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability and then having to come back and do it, down the road again, and doing it at a time when actually now people have really come to expect, high inflation. If the concept of high inflation becomes entrenched in people's economic thinking about their decisions, then sort of getting back to price stability, the cost of getting back to price stability just rises, and so we want to avoid that. We want to act aggressively now, and get this job done and keep at it until it's done.
Nicole from CNN. Thank you, Chairman Powell. Nicole Goodkind, CNN Business. Existing home sales have fallen for 7 months straight. Mortgage rates are at their highest level since 2008. Yet mortgage demand increased this week, and housing prices are still elevated. Now, at the end of your June press conference, you mentioned plans to reset the housing market. I was wondering if you could elaborate on what you mean when you say reset, and what you think it will take to actually get there.
So when I say reset, I'm not looking at a particular specific, set of data or anything. What I'm really saying is that we've had a time of a red hot housing market all over the country, where, famously houses were selling to the first buyer at 10% above the ask before even seeing the house, that kind of thing. So there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. And that's a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place. There are also longer run issues though with the housing market, as you know, it's difficult to find lots now close enough to cities and things like that. So builders are having a hard time getting zoning and lots and workers and materials and things like that. But from a sort of business cycle standpoint, this difficult correction should put the housing market back into better balance.
Shelter made up such a large part of this hot CPI report that we saw. Do you think that there is a lag and that we will see that come down in the coming months, or do you think that there's still this imbalance that needs to be addressed?
I think that shelter inflation is going to remain high for some time. We're looking for it to come down, but it's not exactly clear when that will happen. So it may take some time. So I think hope for the best, plan for the worst. So I think on shelter inflation, you've just got to assume that it's going to remain pretty high for a while.
Okay, we'll go to Jean for the last question.
Hi, Jean Young with Market News. You've talked about the need to get real rates into positive territory, and you said earlier that policy is just moving into that territory now. So I'm curious, how restrictive is rates at 4.6% expected? Is that expected to be next year? How restrictive?
So I think if you look, when we get to, let's assume we do get to that level, which I think is likely, what you're going to do is you're going to adjust that for some forward-looking measure of inflation, and that could be, you pick your measure. It could be, there are all kinds of different things you can pick, and you get. But what you'll get is a positive number in all cases. You will get forward inflation expectations in the short term, I think, that are going to be assuming that we're doing our jobs appropriately, that will be significant. So you'll have a positive federal funds rate at that point, which could be 1% or so. But I mean, I don't know exactly what it would be, but it would be significantly positive when we get to that level. And let me say, we've written down what we think is a plausible path for the federal funds rate. The path that we actually execute will be enough. It will be enough to restore price stability. So this is something that, as you can see, they've moved up, and we're going to continue to watch incoming data and the evolving outlook and ask ourselves whether our policy is in the right place as we go. Thank you very much.
That was Fed Chair Jay Powell wrapping up his news conference after the Fed raised rates by 75 basis points as Wall Street had expected. Now, it was a roller coaster ride when you take a look at the market's reaction. Stocks erasing some of those gains on the initial announcement. As you can see, we are a bit mixed right now. Dow back in negative territory, off just around 92 points. S&P trading to the downside. Nasdaq, though, holding on to gains. And Dave, just a couple of big takeaways. I think one, the fact that Jay Powell once again reiterating the fact that the Fed is going to do whatever it takes to get inflation under control. He was asked a couple of times about the jobs market, his assessment of the labor market right now. He said a couple of times that it continues to be out of balance. So far, we're only seeing modest evidence of labor market cooling. So I think the big question is, how big of a pullback do we have to see in the labor market? And then he once again reiterated the fact that it isn't a painless way. There is not a painless way to get inflation behind us. So lots of questions just in terms of how big of a slowdown. He didn't necessarily go as far as saying we need to see a recession, although it seemed like the data points might be leading us there.
Yeah, as to a recession, he did not, I mean, in terms of the soft landing, he was very non-committal.
Yes.
And in fact said, we don't even know how severe a recession we might have. To your point about the pain, everyone kept trying to press him to get to that pain. The estimate is 1.2 million jobs will be lost, according to the estimate that is 4.4 unemployment by next year, but that seems way low. It may be double that to get the inflation back to where he'd like it. Price stability, the word of the day. I think 12, 13, 14 times the phrase of the day. For me, I'm always watching housing and comments on real estate, which he had several, more than we've seen in all of the 5 hikes this year. He talked about it a lot, said we weakened significantly, suggesting that is the one area that they have succeeded the most. And that's what we've been seeing in all the housing data lately. There's been a lot of questions about when, Shauna and Rochelle, they would start to sell off, roll off mortgage-backed securities off of the balance sheet. We keep wondering because the impact that will have on housing is severe. He said, no, we're not thinking about it, and we're not even close. And then lastly, on housing, that prices rose way too fast, that we need a correction to get back to the right place. And then lastly said, shelter inflation will remain high for some time. Of course, the stickiest part of that right now is rent. So a real focus on housing today by the Fed Chair, Rochelle.
And we did hear a lot of questions, a lot of people pressing him on when we can expect some sort of normalcy, when we can expect that pivot to happen. But he came right out of the gate saying, look, we're going to do what we have to do until the job is done. And they did mention, obviously, some of the reporters, this lag between what we get with inflation data versus what we see in the real economy, and whether or not there's a risk of going too far. But we did see that the Fed is still willing to be aggressive to get inflation down, even if that does potentially boost recession risks, rather than having inflation linger for longer and then having to sort of backtrack. And we know some analysts have already criticized the Fed for being too late out of the gate when inflation first started to tick up, and it looks like they're not willing to make that same mistake again, Sean.
Yeah, certainly. It was interesting just when he was asked about the variable lags on inflation. He did say that there is a possibility we will pause, but not at this level, really just to wait and really evaluate the effect that the rate hikes have already had or are having right now on the economy. All right, let's talk a little bit more about this. We have Commonwealth Financial Network's Chief Investment Officer, Brad McMillan, joining us. And Brad, let's first start off with the reaction that we're seeing in the stock market, because we've been fluctuating between gains and losses here for the past hour or so. Dow, Nasdaq, and S&P all moving to the upside. What's your takeaway from what we just heard from Fed Chair Jay Powell and what we're seeing play out in the markets?
Well, I think the initial reaction, Shauna, is fear. Oh my God, they really went to 75 basis points. And then when you look at this written statement, you have a statement that says, yes, we're going to keep going. But then, of course, it bounced back. Well, hey, that's good. We're going to get inflation under control. But then Powell comes out and actually says the economy is out of balance. And a big part of what he's talking about is giving examples of those out of balance numbers. And that's why we have inflation. And we're going to keep going until we get into balance. And I think the markets are saying, okay, we do need to get back into balance. And we've got somebody up there that can be trusted to do that. So I think that's why we're edging back into the green because, yeah, we know where we're going and we know we're going to get there.
And Brad, your reaction to the Fed chair saying a soft landing will be very challenging, even saying we're not sure even how severe a potential recession might be. Is that the language you expected from Powell?
I expected Powell to go out there and say, we are going to get inflation under control. And I don't think he wants to say, yes, we're going to have a recession because A, that's not certain. B, that would be a terrible soundbite. But when you look at the projected growth for the rest of the year at 0.2%, that's as close as you can get to saying we're going to have a recession without actually saying we're going to have a recession. And then when you look at the next year's expected growth, we're not going to bounce back quickly. So they're building in a lot of uncertainty. They don't want to say it, and I don't blame them for saying it, but they've been very clear. This is about inflation. This is not about employment. This is not about growth. This is about getting inflation under control, and we're going to do what it takes.
And you talked about that initial panic. We did see the VIX pop above 30 as soon as that announcement was made, but obviously has tempered down since then. But when asked about this incentive about front loading, though, about core PCE inflation readings, he said they're not where we expected or wanted them to be on a 3, 6, and 12-month basis. What do you think this means then going forward? What are the expectations? And do you think the markets are really ready to price in the reality of what the Fed is trying to convey?
Well, on the first one, I think Powell gave us a hint to his thinking. He's not just looking at one data point, nor should he be. He's looking at the 3, 6, and 12-month trend. He wants to see them rolling down. And I think that's exactly right. And his point is we're not there yet, so we're not even going to think about slowing down or even stopping, much less, until we get to that point. So we have an idea of what that metric is. So when you look at that, I think the market is expecting, and in fact, this is what the dot plot is saying, we're probably going to be done maybe towards the beginning or middle of next year. I think Powell is saying that, yeah, that's our best guess, but the risk is to the downside. It might go on longer.
Brad, do you think we've hit peak hawkishness here from the Fed?
I would have said so, Shauna, before the press conference. But when you look at the way he's talking about it, I mean, he continues to channel Volcker, basically. And he keeps saying what the data tells us is what we're going to do. I think right now he believes this is peak hawkishness, but he's very explicitly left the door open to keep going. So I think probably yes, but the chances of a no are a lot bigger than I would have said 20 minutes ago.
Yeah, clearly willing to take some pain, as he has said, reiterated over and over again, 4.4% unemployment. The estimate next year, are you buying that? How much worse might it have to get inflation, to get price stability for Powell?
Well, there's two things going on here. First of all, yeah, we need to loosen the unemployment. We need to raise the unemployment rate. But that doesn't necessarily mean job destruction. That can mean more jobs being created. That can mean the labor force shrinking. And to some extent, that doesn't matter. It's a distinction without a difference. But we can see that happen just by seeing job growth slow substantially. We typically see jobs growing even during a recession, but the labor force grows more. So it could be bad, but it's not necessarily as bad as those numbers would seem to suggest. And I think ideally, given the strength of the economy and the job market, that's probably where it's going to come from. Not mass job losses, but simply slower growth.
And staying on this trajectory, Powell said that no one knows whether this process will lead to a recession, or if so, how significant the recession would be, and said that's going to depend on how quickly wage and price inflation pressures come down. When you look at things like wages, do we get any indication that they're moving in the direction that the Fed wants right now?
We've seen real wage growth in particular go negative, and that's obviously mostly due to inflation. But we're not seeing too much in the way of the mitigation of wages. And more to the point, when you combine wage growth with job growth, when you look at the total growth in purchasing power, we're not seeing any mitigation at all. But that's where I say if we start to do see wage growth pull back, and with that we also see a drop in job growth, that can be more of an impact for the economy as a whole. But no, we're not there yet. And frankly, if that hasn't even peaked yet, we've still got a ways to go.
And so do we, Brad. So we hope you stick around for us just a bit. We'll come back to you. We're going to get over to Jared Blickery now with a look at how the markets ingested all this noise. But first, Jared, let me get your just broad takeaway. What surprised you from the tone or specific phraseology from the Fed chair today?
I'm going to put it from Jay Powell's perspective. I think he's happy with this press conference, namely because we didn't see a big move up or down in stocks. Now, had a big down move occurred, arguably that would have been in his favor, because there have been some statements since the last meeting, since Jackson Hole, saying that the Fed does not want to see the stock market rally on these events. And there's a good reason for that. So let me just get to some of the stock movement here. We can see it as a mixed board. Let me just put the S&P 500 up, and let's go to a 2-day view. Actually, this is going to be 1 day. And you can see usually on a net basis, we are not by the unchanged line at this point in the day. We're usually substantially up or down. Now, the last meeting in late July, we were substantially up, and we later learned that Powell was not happy with that arrangement because he was trying to convey the notion that he is hawkish as possible, that he's going to do everything, and the Fed is going to do everything they can to get inflation under control. And stocks being up kind of speaks against that. Here's the sector action. We see staples, tech, industrials. Those are in the green. All of them outperforming the S&P 500. Communication services, materials, that could be a dollar play. We can get to that in a second. Financials, those are the biggest losers, but nothing off by more than about 0.5%. And I just want to show you the stock movement in the S&P 500 on a longer term basis. That's the dollar. Let me get to the S&P 500. Here is today's price action. Now, this exceeds the price action of the prior 2 days, which is to say we went down, we went up, and we're back in the middle. And so everything is copacetic from the Fed's point of view, still fighting that inflation. We saw the VIX spike up to over 30. That was the highest amount in about 2 months, 6 weeks, something like that. And also taking a look at the bond market. Now, this is usually where the fireworks are. We see the 5-year T-note yield. It did spike to a new high. It is down 4 basis points right now. The 10-year T-note yield also made a new multi-year high, I think the highest since 2007, don't quote me, but ending down on the day. And the 13-week T-bill yield, now this is a key one too. This has been racing higher. This more accurately tracks, it's on the short end of the curve, what the Fed is doing with its benchmark interest rate, which is an overnight rate. This did not make a new high. So really this is a press conference and I think an FOMC statement that went as expected. Now here's the US dollar index. I don't know if we have time for this, but all right, let's get to this because I want to show you what the US dollar has been doing. Now it has been racing higher. That is what we know. And it has provided some of the global risk markets with a lot of consternation. So this is my dollar heat map. Everything on here is with respect to the US dollar. Now in the upper left, let's not forget what happened yesterday before we all woke up, or some of us woke up, is the Swedish Central Bank. They went up 100 basis points. The Fed only went 75 today. Interestingly, on a net basis, the US dollar is still stronger versus the Swedish kroner, and that is a central bank that raised more than we did. It just shows you that a lot of these other central banks around the world maybe have to catch up to what we're doing right now, but it does suggest that the US is in a better position because we have tackled this on a front-loaded basis, seen more of that action up front. Now, the U.S. dollar, the surging U.S. dollar, does present some consternation, as I've been talking about, not only for international, multinational corporations and their earnings, but also commodities. That could be good for consumers, weighing on commodities. Also, crypto prices. One of the things I haven't checked here yet today, and I think I'll close with this, kind of fitting that we're going to close my FOMC comments with a check on Bitcoin right here, because Bitcoin was leading the way up at the last press conference. You can see it's still up about 1.8% versus 24 hours ago, but this is a fairly muted reaction. So Bitcoin being the arbiter of was this a successful press conference from the perspective of Jay Powell, I'm going to say yes, guys. Bitcoin is saying yes.
Is the arbiter.
Okay,
yes.
Bitcoin, there we go. We're going to get that as your final word there, Jared Blicker. Thanks so much for breaking that down for us. We want to bring back in Brad McMillan of Commonwealth Financial. Brad, let's just start with what Jared was talking about with the strong U.S. dollar. Now, while Powell was speaking, we did see the dollar spike higher here, still holding on to gains today. But the strong U.S. dollar, just what is your assessment for how big of a challenge this poses to U.S. equities in the second half of the year and then looking ahead to 2023?
Yeah, I think when you look at this, I mean, the fact of the matter is the reason the dollar is stronger compared to international currencies is simply we've done more to get inflation under control. It's not showing up yet, but from a policy perspective, we're on top of things. I think that was an absolutely correct statement. So while at the same time, we're getting a challenge from the U.S. dollar, for example, sales abroad in foreign currencies are going to scale back into the U.S. at a reduced value. Nonetheless, we also get some advantages on input costs, especially for raw materials. And because we are managing inflation better, I think net, it's going to be pretty much neutral. And most of the arguments you get that it's going to be a headwind are based on those earnings effects. But I think they're going to be offset by some of the other positives that we're seeing.
And as you address this sort of simultaneous global tightening that you're seeing with other central bankers, are there any sort of outliers that you think could put additional pressure on the U.S. economy more so than they already are?
I think the big worry out there is energy prices. I mean, what we've seen in the improvement in the headline inflation index was largely due to energy and gas prices. But then today, we didn't quite make it to 100 days in a row where we saw declining gas prices. They actually ticked up a bit. And the question is, how much of that energy, the oil price decline, is due to the release from the Strategic Petroleum Reserve? So right now, I think energy is probably the biggest threat to the progress we've made on inflation and the biggest upside risk. I think for housing, which is the other probably the biggest risk, is we're probably looking at that for another 6 to 12 months. But even there, we can see the data starting to roll over. So I think energy is the big thing I'm watching at the moment.
Yeah, Strategic Petroleum Reserve now at levels not seen since 1984. We don't hear a lot about that. Andrew Levin earlier told us he believes inflation will still continue to climb in the months ahead. And even Powell himself admitted that shelter inflation will remain high for, quote, some time. And it was really sticky in that last print. When do you think inflation will begin to subside?
I would say probably around the first quarter of next year. When you look at shelter, that was the real surprise in the last inflation report. And the reason I say that is because everything else came out pretty much as expected, but shelter came in twice what it was. And when you look at the relationship of shelter inflation to housing prices, there's typically about a 15-month lag. So shelter is going to continue to be a major part and a major pressure on inflation, certainly through the rest of this year and probably through the first quarter of next year. The question is going to be, do we get enough of a pullback in everything else? And I think we're certainly going to mitigate inflation. Goods inflation in particular has started to come back as the supply chain has healed. But we're probably going to see increasing, but more slowly increasing inflation, at least through the end of the year.
We do thank you for joining us this afternoon with your insights. Commonwealth Financial Network CIO Brad McMillan, thank you so much. All right, well, Yahoo Finance's Jen Schonberger is at the press conference. So, Jen, first give us your highlights here.
Hey, good afternoon. Yeah, that press conference just wrapped with Fed Chair Jay Powell, the chairman holding the line on inflation, doubling down on his message made at Jackson Hole back in August that the Fed will do whatever it takes until they're confident inflation is under control, even if that means withstanding a bit of pain. Take a listen.
If we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing.
Chair Powell saying that the Fed has just gotten to a restrictive policy stance and that they need to get to a meaningful level and hold rates there until inflation comes down. Of course, the Fed raised its benchmark interest rate by 75 basis points today to a new range of 3 to 3.25. He says they will need to maintain this restrictive policy stance, and it would be a mistake to prematurely loosen policy. They see rates ending the year at 4.5 4.4% this year, and next year ending at 4.6%. So still more quote unquote pain to come. Powell mentioned that he thinks a soft landing, basically a scenario where the Fed raises rates without causing a recession, remains, quote, very challenging. He says it will be appropriate at some point to begin slowing down those rate hikes, but they will make those decisions meeting by meeting. Chair Powell again striking a very tough stance on inflation. Back to you guys.
Jen Schomburger, terrific job today. Really appreciate that. No ambiguity, no wiggle room there for Jerome Powell, Chana. And you brought up this earlier. He's very clear, data dependent. They'll take it one meeting at a time. But it sure sounds like, and I'm curious if Andrew Levin's happy with what he heard from Powell, a 75-point hike might be coming again at the next meeting, our fourth straight.
Yeah, it does certainly sound like that is still on the table here. And it echoes what we've heard from our guests since we got the decision, the fact that we are so far from getting inflation under control, that we need a more aggressive Fed, because clearly when you take a look at the job market today, what we're seeing play out in the economy, yes, housing is starting to weaken, but we heard from Powell himself that we need to see a larger correction here just in order to get housing to the levels that we need to see to slow the economy and then, of course, bring inflation under control. So I think a more aggressive Fed in the coming months is something that the market is now anticipating. I don't think they were necessarily expecting that going into the decision today, and that's why we saw the reaction that we did in the market shortly after that decision was announced, and we did get those projections. Now we have been going kind of searching for direction the past hour or so, with now all three of the major averages in the red as we head into the final 30 minutes of trading. But Rochelle, Wall Street now, I guess, really just trying to figure out, when we take a look at how aggressive the Fed is and the hawkish stance that Powell had reiterated time and time again during the press conference, just what exactly that means here in the coming months and exactly how painful that's going to be for the economy.
And we did hear Powell say, look, there could be between 100 and 125 basis points more to go before the end of the year, and that the FOMC is split on that. So I do think that's interesting. Obviously, being asked about front loading, they seem to obviously be rather front loading than doing too little too late. And the Fed is sticking to their guns. They were consistent throughout, saying, look, inflation, if it doesn't come down, everything else is coming secondary. They're not really looking at the equity markets. They're still focusing on unemployment and that 2% target. So we just have to keep our fingers crossed, but I don't think equity markets are going to be too happy with that for a while.
Nope. When you look at those numbers at the bottom of your screen, they continue to go down, continue to decline. It looks like deeper into the red. And just one more thing on the housing, because he did say that was the one obvious example that they are having success. But again, we talk a lot about negative data coming in on housing across the country, but we're still talking about price increases cooling. We're not talking about price drops, net price drops. They're still above where they were a year ago. We're a long way in terms of housing from what Jerome Powell wants to see. And that's without even talking about rent. That is very sticky and doesn't appear to be improving because supply is not improving fast enough. Plenty more to come here on Yahoo Finance Live after the break. Much more on Jerome Powell and what he had to say, and also with mortgage rates above 6%. We'll tell you how today's Fed decision could impact home buyers in the months ahead. Also, President Biden blasting Russia at the UN General Assembly as Vladimir Putin declares a partial military mobilization in Russia's war against Ukraine and hinting at nuclear. And CEOs of the nation's largest banks in the hot seat as they testify before Congress. We'll tell you what they said. Don't go away.
there was a big imbalance between supply and demand. Housing prices were going up at an unsustainably fast level. So the deceleration in housing prices that we're seeing should help bring sort of prices more closely in line with rents and other housing market fundamentals. And, you know, that's a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place.
Fed Chair Jerome Powell, a renewed emphasis on housing and the real estate environment today at the Fed meeting after raising rates for 75 basis points. Also saying that there was weakened significantly is how he described housing in this environment, the one area they're seeing evidence of success beyond all else. Let's talk about that with Danielle Hill, Realtor.com chief economist, in terms of where we're headed. Danielle, your reaction to that statement from Powell about a correction, are you seeing compelling evidence that we are in correction territory? Is that still down the road?
We've certainly seen sales activity pull back significantly. Today's numbers on existing home sales were down almost 20% compared to a year ago. That's the second month in a row where the declines have been about that large. We know that the housing market was overheated at this time last year in response to very close to record low rates. We are seeing now that buyers are responding as rates climb to new records. Home sales are pulling back and we're seeing fewer transactions in the market.
Danielle, when you take a look at the potential correction here, I guess how much worse do you see it potentially getting here for housing in the next couple of months?
You know, I think that remains to be seen. A lot depends on what happens to mortgage rates. We know that housing is a very interest rate sensitive sector. You know, the difference between 5% where we were, you know, just 6 weeks ago and over 6% now is a pretty big payment shock. And if you look at where we are now compared to where we were 1 year ago, you know, monthly mortgage payments are up 66% between the combo of higher mortgage rates and higher home prices. So that's a lot for households that are shopping to absorb. I think as long as we see mortgage rates remain elevated, it's going to be hard to see sales activity pick up in a big and meaningful way.
So then, Danielle, for buyers, sellers, and renters who are seeing this announcement, knowing that rates are going to continue to climb and that the Fed isn't going to be slowing down anytime soon, what are the big takeaways for them?
Yeah, I think given the higher rate environment, it's more important than ever to make sure that you're financially prepared. There's really kind of no escape from higher cost as someone looking for a place to live right now, whether you're planning to buy, whether you're planning to rent. You know, home prices continue to go up by double digit on the asking price side. Sales prices today actually slipped into single digit territory for the first time, but they're still, you know, up more than 7% compared to a year ago. So if the prices of homes to buy and to rent are getting more expensive, and then you factor in mortgage rates, that adds an extra layer of cost for home buyers. I think going in with a plan, setting your budget and sticking to it, it can be really tempting as prices go higher to just push that budget envelope a little bit. But I think sticking to your budget in this environment is very important for buyers. And on the plus side, in the housing market, as we see this pullback in buying activity, those who can continue to remain in the housing market are finding that sellers may be a little bit more open to negotiating because they're seeing fewer home buyers. The market in many areas is not quite as competitive as it was a year ago. We're seeing month-to-month price declines. They're still gaining on a year-over-year basis. But more importantly, we're seeing sellers in some cases reduce asking prices. So that is actually back to roughly 1 in 5 homes, whereas it was about half that at this time last year.
We're looking at another jumbo hike, possibly 75 points, at least 50 at the next meeting. And look, a Fed funds rate of 4.4 by the end of next year. Where do you think mortgage rates are headed? I'm hearing some feel we're headed to at least 7%.
You know, I think it's possible, but it's not a given at this point. You know, if you're tracking the rates, you know, long-term rates have actually come down a little bit after the Fed's announcement today. We'll see if they stay in that territory. But you know, there's usually some variability in the spread between short-term rates and mortgage rates. There's a little bit more consistency between 10-year Treasury rates and mortgage rates. And you know, as 10-year Treasury rates come down, that gives mortgage rates some breathing room. We are not necessarily going to see another 75 basis point surge in mortgage rates. But I do think as long as inflation remains rampant, as long as we don't know exactly what the endpoint will be for those short-term rates, that continues to put upward pressure on mortgage rates.
Danielle, how long do you see this challenging environment that we're currently in right now? How long do you see this lasting?
I think it really depends on inflation. So that's the key thing. We need to see inflation get back to under control, back, moving steadily toward the Fed's 2% target. We haven't seen that in the annual data yet. There's, some bright spots in the month-over-month data on overall inflation. That was largely driven by energy prices. We're really going to need to see across the board in those core inflation indicators, price growth decelerate significantly before we can say, we're close to the end on this tightening cycle, and we can start to think about what it might look like if rates were to trend lower.
And Danielle, how much of the pressure that's already on the housing market is being compounded when you look at things like home builder confidence, when you look at, what people are willing to spend, and even if they have the labor to really complete some of these homes?
Yeah, I think that's the most challenging thing right now, is that the housing market remains in a long-term shortage situation. We haven't built enough homes over the last decade to keep up with the number of households that have formed. So whether you're looking at rental vacancy rates or homeowner vacancy rates, we see that housing is in relatively short supply in the big picture macro sense. But if you look at the market of homes for sale, we're seeing improvement. There are 25% more homes for sale right now compared to this time last year. So we are seeing an improvement, a little bit of a better balance between supply and demand in the transaction side. But those vacancy rates remain close to record lows. So there's still plenty of opportunity for builders to build more, but they're facing headwinds when it comes to housing demand because of these higher costs, because of the higher cost of financing, because of higher mortgage rates. It is going to be difficult for them to navigate this market going forward. There's plenty of long-term demand, but in the short run, we're seeing demand pull back because of the higher costs.
Real estate geeks like ourselves were on pins and needles waiting to hear mortgage-backed securities, and we heard that question, and the Fed chair said no. We're not even close to thinking about rolling those off the balance sheets. Apologies for this being so theoretical, but when that begins, when we begin to sell off our mortgage-backed securities, any sense of what that means for the housing sector?
And so as the Fed rolls off mortgage-backed securities, that should mean an increase in mortgage rates unless we see a big surge in other investors stepping in to make those mortgage-backed securities purchases. So my best guess is that that's going to be some upward pressure on mortgage rates, some additional upward pressure when we get to that point.
So let's put a bow on this thing with advice for the homeowner. If you're sitting here watching mortgage rates continue to go up and a slight cooling off to prices, what's your advice?
So mortgages are going up. If you're a homeowner and you want to stay in your home, you're looking at record high levels of equity thanks to those price increases that we've seen. Interestingly, even if we do see a correction or even a pullback in housing prices of 10 to 20%, that would still put most homeowners, or at least in aggregate, homeowners would still have a record high share of equity. So most homeowners are in a really good position. I think it's important for recent home buyers and those thinking about home buying to make sure they're going in on as strong a financial footing as possible so that they are making decisions that can be sustainable for themselves in the long run. Don't push your budget. Now is not the time to do that in the housing market.
All right, a big thank you there to Danielle Hale, Realtor.com chief economist. Have a great afternoon. All right, well, markets are selling off into the close. The Dow now at the lows of the session, off just over 400 points. Stay with us.
About 10 minutes ago until the closing bell, all three of the major averages taking another leg lower here. The Dow off just over 400 points. Jared Blickery is back with us. Jared, what's going on?
Everything down about 1.5%. That's what it looks like here. Let's take a look at the Nasdaq this time. These are the fireworks we saw after the announcement, and then we saw Chair Powell give a little ray of hope. But by the end of the presser, I think it became obvious that yes, he really means it when the FOMC says they're going to bring down inflation. But just want to point out too that these are some fairly depressed levels. Let me put on a 3-month chart. This is going to be the lowest close since it looks like July, so that's going to be a couple months ago. Nevertheless, let's take a look at some of the heat maps, and this is going to be our sector action for the day. Everything in the red right now. A couple green sectors before we took a look about 20 minutes ago. Not so right now. Some of those sectors that have those mega caps getting hit the most. Consumer discretionary, that's XLY, XLC. Those are the two worst. And let's take a look at the Nasdaq 100, where we can see some of that action concentrated in these mega caps. Tesla, Meta, Amazon, all down more than 2%. NVIDIA up 1%. Walmart also up on the Dow. I don't know if we can get excited about that, but some pretty broad-based losses here. Got to think that the Fed really means this, as they've been saying.
Certainly do. All right. Thanks, Jared. All right. Now it's time for Triple Play, the 3 stocks that we're watching in these final minutes of trading. We've got Boeing, Meta, and General Mills on deck. My pick is plane maker Boeing, the company announcing plans to lay off nearly 150 finance and IT jobs to simplify its corporate structure and focus on manufacturing and product development. The stock was in positive territory, but after that Fed announcement, also down there about 1.5%. Now, the company also grew its workforce, though, this year by about 10,000 employees and hired in its engineering and manufacturing departments to really keep up with demand. But it has been a busy week for Boeing as China's aviation regulator confirmed that it did hold a meeting with Boeing about bringing the 737 MAX back to China. Now, the meeting was to review improved aircraft training plans for the jet after those 2 fatal crashes that led to the grounding of the 737 MAX in China in 2019. Now, interestingly, Boeing also announcing today that it's teaming up with augmented reality developer Red 6 for advanced fighter pilot training. Now, this is part of Boeing's broader strategy for modernizing pilot training, as well as its next generation of aircraft, Shauna. Stock under pressure, though, and year to date down about almost 30% there.
Yeah, stock under pressure here along with the broader markets. It's interesting here just because we know China could be critical here for Boeing just regaining its footing here. Certainly will be a huge step forward as it does try to improve its balance sheet since it had been hit so hard by the grounding of the 737. Also the fact of COVID and how big of a hit that had on Boeing here over the last 2 years. In terms of the job cuts, Boeing did quickly point out that it was not related to the announcement earlier this year that it was moving its headquarters. So 150 job cuts, obviously something significant, but when you take a look at the size of Boeing, they still have a very large workforce. All right, my play today is Meta. The Wall Street Journal reporting that the company is aiming to reduce costs by at least 10% in the next few months. And much of that is expected to come from job cuts. Now, Meta has reportedly started reducing its headcount by reorganizing departments and giving employees time to seek other roles. Additional savings will come from slashing overhead and also consulting budgets. Shares jumped initially after the moved higher here during the press conference with Jay Powell, but ending the day, looks like it's going to end the day in the red with shares off just about 2%. Now, Dave, Meta clearly has been struggling since the start of the year, off just around 50% over the past year, off around 60%. They're transitioning their business, focusing on the future. The metaverse, investors aren't quite buying in. We'll see whether or not these cost cuts really move the stock here going forward.
Yeah, we got a pretty good glimpse at this back in June at the town hall, and Mark Zuckerberg said ominously, realistically, there are probably a bunch of people that shouldn't be here, obviously sending shivers throughout the whole crowd. But this is like a lot of stories that we snap, a lot of tech companies in the pandemic that ramped up hiring too high. Meta had 83.5 at the end of the second quarter. That was up 32% from a year earlier. So they hired too many during the pandemic. This is only natural. And let me give you one number. $71 billion. That's the amount of net worth that Mark Zuckerberg has lost this year.
Yeah.
This year. Somebody's got to go when that happens to the boss. My play is General Mills, GIS, a trending ticker on Yahoo Finance. Along with Cheerios, Betty Crocker, and Cinnamon Toast Crunch raising its full year forecast after beating quarterly profits today. General Mills sees costs rising as much as 15% for the fiscal year. Their CEO, Jeff Harmening, saying ahead of the earnings call, significant inflation and reduced consumer spending power has led to an increase in at-home eating and other value-seeking behaviors. Food prices, as you all know, rose 13.5% in August, the fastest rate in more than 40 years. And look at the stock popping on this news, up about 6%. They've had a strong year, up about 20% this year, almost 40% over the last 12 months. We've had a very heavy day. So, Rochelle, I have to ask you, your favorite General Mills cereal? I know the obvious answer is Cinnamon Toast Crunch. Hot take here, it's Cinnamon Chex.
I'm really boring. I like a plain cereal. Like I'm a cornflakes, Rice Krispies kind of girl. I like a plain cereal. I don't like cinnamon and peanut butter and extra things. Just keep it simple. A little bit of brown sugar and some agave.
Cheerios.
No, you're too healthy for us, Rochelle. I think mine might be Lucky Charms. That's General Mills, right?
It is.
Lucky Charms is a very, very good pick.
Those are solid.
They are really solid. All right, well, coming up, we're all getting hungry here as we're counting down to the closing bell on Wall Street. Again, all three of the major averages in the red. The Dow off 465 points. We'll be right back.
All right, we're minutes away from the closing bell. Let's bring in Yahoo Finance's Inez Frey to break down the roller coaster ride following Jerome Powell's remarks. Hi, Inez.
A roller coaster indeed, Dave. A lot of volatility that we saw in this last couple of hours of trading. And if we just take a look, we are seeing some accelerated losses as we go into the close. We're watching the Dow that's down 460 points, but keep in mind that the Dow was up as much as 260 points while Jerome Powell was speaking during the presser. The Nasdaq Composite down 1.5% and the S&P 500 down also 1.5%. We saw the 2-year and the 10-year Treasury yields invert even further, the 2-year initially jumping to 4.12 after that Fed rate hike came out at 2 p.m. Looking at the sector action, we are seeing, well, let's take a look. NASDAQ 100. Here, the mega caps, Amazon down more than 2%, Tesla also lower, Meta down as well. So you're seeing the mega caps that are really getting clobbered. If we take a look at the sector action, you can tell communications services, consumer discretionary, some of the stocks that I just mentioned, these are losing the most right now. Keep in mind that these markets had opened in the green earlier this morning. We had seen industrials in the green this morning. It's now down, XLI down 1.2%. You're also looking at all 11 sectors of the S&P 500 that are lower right now. And here's a closing bell for today, Wednesday, September 21st at the New York Stock Exchange.
And there you have it, your closing bell on this Fed day. Let's take a look at where the major indices ended. They did accelerate into the close. We see where the Dow settled off more than 500 points. That's past a 3-month low. The S&P 500 there losing about 1.7%. Tech-heavy Nasdaq losing about 1.8%. Both of those also nearing 3-month lows as well. Well, let's take a closer look at the broader markets and bring in our panel. We have Christian Hoffman, Thornburg Investment Management Portfolio Manager and Managing Director, and Eva Ados, ER Shares COO. So, Eva, I want to first start with you. This reaction that we saw, this real roller coaster in the afternoon, how do you think markets are digesting what they heard from Powell today?
We expected that reaction. We think the 75 basis points was a foregone conclusion, but we did expect Jay Powell to be as hawkish as he was. The last CPI report was not that good. And we do expect the markets to continue their roller coaster, as you very well described, that we're seeing today in the next couple of weeks until the next catalyst that we see in October. So I think the CPI report in October and the early November Fed meeting, that will be the next catalyst that has the potential to push the markets higher, as we might see the Fed easing up on the 75 basis points rate hikes.
So Christian, Dow closing off today 500, and 22 points. Further downside risk ahead?
The volatility will continue until morale improves. The reason that it's going to stay volatile for a long time is because the market is broadly hyper-focused on inflation, and so is the Federal Reserve, and rightly so. And it's a question over a prolonged time, and are we looking at inflation at 7% or 5% or 3%, and how long does that persist? And we're back to fundamentals here. We're back to valuations, and that impacts all valuations from bond markets to equity markets. And the market is hyper-focused on every single economic data point, trying to extrapolate that longer-term trend. And so the volatility is going to continue for here, absolutely.
Ava, was there anything in particular that surprised you that the Fed chair said today? And what's your reaction to him describing it as very challenging to accommodate, to pull off the soft landing?
To me, the biggest surprise was his point during the Q&A regarding housing, because housing, as we saw, the CPI for housing in the last report increased by 0.7%. However, we have seen over the last months headlines about new housing starts dropping, home prices falling. So it was inconsistent. And we do believe there is a big lag here between what the CPI suggests for housing and what's actually happening, because the CPI is only tracking owners' equivalent rent. And that does not take into consideration the actual prices of homes being bought and sold, but rather what a homeowner would rent his house for if he had to. And that includes also other costs such as maintenance and taxes. So it's not really a good indicator. And we think there is a lag, but Jay Powell made it clear that there might be a big lag between, and it might take a long time until we see housing prices come down.
Ava, just for clarity, are you saying there was something from Powell that was inconsistent when it comes to housing? And how far are we from the correction that he said the market does need?
He made it clear that it will take time to see housing prices drop. We did not think that it's going to take so long. So that was the biggest surprise to us. And we're again concerned the CPI, even in the next CPI reading, might not show the true reality for housing. So we're just want to make sure that people are very clear on what data they're looking for, because the CPI for housing does not always show the reality, and it lags.
So then, Christian, given that data and what we heard from Powell's comments today, how is that informing your investment strategy going forward?
Well, for one, I think it's an incredibly rich time to be investing in fixed income, especially as you contrast it to the opportunities last year where core rates were ostensibly zero and spreads weren't much higher than that. You know, at this point, we're finding opportunities where you can invest in 2-year AAA rated paper and get nearly 6%. You can buy high-quality performing bonds at 80 and 90 cents on the dollar, have a great convexity profile and long-term total return. So, like I said, it's going to continue to be choppy, but it's actually a very rich opportunity set for investing in fixed income at this point in time.
Well, Christian, what is your assessment just of the bond market right now, more broadly speaking, when you take a look at treasuries, right? The 2-year yield jumping to 4.12, hitting a high, the highest level we've seen since 2007. The 10-year yield also jumping to its highest level that we've seen in 11 years. That trend, you don't think that will stay intact?
Again, I don't think we've necessarily put in the tops in terms of rates. But if you're looking at positive real rates, that's actually quite attractive. And relative to your views, there's actually a number of ways you can express a high total return potential depending on your views of inflation and Fed policy. The Fed is in this weird place where they're playing this tug of war with the market, that the market is trying to front run the Fed, trying to see when they're gonna blink. And they absolutely will, but the Fed is trying to look as tough as possible. I wouldn't be surprised to see Chairman Powell come out in the next meeting, wearing a leather jacket and having a neck tattoo, because they are hyper-focused on trying not to flinch against the market. And, that tug of war is going to continue. You saw it in the press comments when the market bounced. People were looking for anything, any silver lining, and there was some slight hint that they might ease up, and that's when you saw the bounce and the reversal. That was wrong. That was the wrong take, and you saw that unwind through the day.
Brother, thank you for that image. I will not unsee that all day. Jerome Powell, neck tattoo and leather jacket. I'm just going to dream about that. But Ava, I do want to get your thoughts on the 2-year at 07 levels and Christian's strategy of fixed income in this environment.
We're not big in fixed income, and we would certainly not encourage people to go long bonds because of their exposure to interest rates. So as interest rates go up, bonds will come down. However, the short term is a good investment. So the 3-month, the 6-month, it's really tough now with anything when it comes to investments. So throughout the world, geographically, asset-wise, so throughout the world, there are very few markets now that will actually perform well. But one hidden gem is India, which of course is a market that is really hard to get in and out due to the regulations, but it's one of the few markets that's flat year to date, as they've benefited from the oil trade and their partnership with Russia, because they're buying the oil, refining and then reselling it to to Europe. And so that's one of the bright spots. And then we would encourage investors to stay conservative in the markets, equities, and then add to their positions as we approach late October and early November.
Ava Ados, Christian Hoffman, thanks so much for joining us. Always great to have you here at Yahoo Finance. All right, well, coming up next, President Biden calling out Vladimir Putin as the Russian leader escalates the war in Ukraine. We will tell you what the tensions mean for energy prices after the break.
The war in Ukraine resulting in the European energy crisis coming to a head. Germany nationalizing energy giant Uniper, while a UK bailout is expected to cut energy bills for businesses in half this winter. What is ahead, though? Tom Kloza is the Opus head of energy analysis. Good to see you, sir. Let's start with the words of Vladimir Putin, which have changed the energy situation around the globe. What's the biggest impact of the war in Ukraine moving forward on energy?
Well, I think the impact is clearly if he pulls some of the levers that it can pull to cut off the flow of hydrocarbons, either natural gas or crude oil or refined products to the West. I mean, he's obviously going to put his people through incredible pain, and that doesn't stop him. So, you know, we've seen natural gas prices drop tremendously in Europe, but they've dropped from $550 oil equivalents to about 300 to 350. So it's still very, very much a threat. If you wake up one morning and he's been ousted or whatever, say a little prayer of thanks, but also figure that oil prices and energy prices will drop. But in the meantime, I think the energy transition is going to be moving into another quarter that's going to herald really the next few years of pain.
And Tom, we know that we didn't quite make it to 100 days of gas prices going down, but in terms of the domino effects and from the energy crisis in Europe, what are the expectations for what we could see here in the US?
Well, I think the expectations are that we've survived a gasoline scare when we were 501.65 on June 14th. And every day of the summer, with the exception of today, we've seen prices come off a little bit. That probably ends, but I don't think the next big move is higher, or at least not in 2022. In 2023, we'll see what I call petronoia, the fear that there's not going to be enough petroleum molecules to go around, particularly in the gasoline season. It'll manifest itself. And then maybe we'll have another move. You know, for the next 4 months, gasoline has the moves like Al Gore as opposed to the moves like Jagger. But diesel and heating oil and jet fuel, those are the products to watch. We're seeing in Ohio today, for example, the price of diesel is up 20 cents or so a gallon on the loss of a refinery there. And that breaks a string of really, really smooth refining operations in 2022.
Tom, I like that analogy there with Al Gore
Yeah,
and Jagger.
Al Gore called. He can dance.
Yeah. So let's
nice.
talk about the supply picture, because we have two very different drivers here in terms of supply. On the one hand, we have Russia's war with Ukraine, obviously the energy crisis that's happening right now in Europe. On the other side of the equation, we have the global slowdown economically. I guess, how tight do you see supplies getting by the end of the year? And what does that picture look like looking ahead into next year?
If you could tell me what happens in China, I'd probably be able to answer that question very well. But China has really been a laggard, or it's been behaving as though it's in a terrible recession right now. If they start, with the appetite to take up all of the crude oil that's out there in the markets, I mean, crude oil markets can turn around very, very quickly. And I would say that, these episodes of $80, or even if we get into the 70s, they're going to give way to higher prices for crude in the next few years. I don't think that 2023, for example, is going to be much more expensive than what we saw in the summer of 2022. But I do believe that the bias is toward higher prices for energy as opposed to lower.
WTI crude settling at 83.36, down a bit, and Brent just above 90. The Strategic Petroleum Reserve, levels not seen since 1984. What do you make of the lack of urgency on the administration's behalf, and what are the implications there?
It's hard to tell, because in the oil and gas industry, it's incredibly Republican biased, and they're never going to give Joe Biden any credit for anything, even if it works for the moment. The problem is, if you put up a mission accomplished sign after 98 days of lower gas prices, you might have to take it down real quick. So I don't think that there's any imminent danger to replenish the reserve. I mean, in essence, we have reserves of light sweet oil in the shale, in the Permian, New Mexico, and North Dakota. But it's quite a political football. I think you'll see the White House take credit for the lower prices because of the SPR releases. And for the last few months, I think that's had an impact. We saw record high prices in every single hydrocarbon, with the exception of the two kind of benchmarks, Brent and WTI.
And Tom, I want to ask you, because you did focus on diesel, heating oil, and jet fuel as some spaces that you're watching. What do you think people are not paying attention to there, and what are your expectations?
I think what they're not paying attention to is the fact that we've already been in progress for an energy transition, particularly for diesel fuel and heating oil. Now, there's not a terrible amount of people that use heating oil to heat their homes in the winter, but we don't have much in storage anymore. I mean, we're way below 5-year storage levels in the US and in Europe and even in the Far East. So it wouldn't take much in terms of cold weather to really mount an assault on some super high prices for diesel, for jet fuel, since sometimes it gets used in some of the heating cuts in the wintertime. And diesel is the biggest worry, I think, going forward. It probably doesn't really rally until after the midterms, but we might see some ideas floated like, Jones Act waivers to send diesel fuel from the Gulf Coast to New York or the Northeast where it's desperately needed.
Tom Closa, always great to get your perspective here. Opus Global Head of Energy Analysis. Thanks for joining us. Well, coming up, a deeper dive into Walmart's holiday hiring announcement, what this could tell us about the state of the economy next. President Biden speaking at the UN General Assembly today, accusing Russia of violating the UN Charter.
The United Nations Security Council invaded its neighbor, attempted to erase a sovereign state from the map. Russia has shamelessly violated the core tenets of the United Nations Charter. Just today, President Putin has made overt nuclear threats against Europe and a reckless disregard for the responsibilities of the non-proliferation regime.
The speech coming hours after Russian President Vladimir Putin announced he is mobilizing hundreds of thousands of additional troops for his invasion of Ukraine. Yahoo Finance's Rick Newman joins us now with more. And Rick, clearly no end in sight for the conflict between Russia and Ukraine, and if anything, obviously escalating here, likely in the short term.
Right, and this mobilization of what could be another 300,000 or so Russian troops over the next several months might give Vladimir Putin, the Russian leader, a little bit of extra roadway to keep this war going, but it's also an acknowledgement that he's losing. Yeah. He laid this out in February as a special military operation for a reason. It was supposed to be a limited operation using the peacetime Russian military as it existed at the time. It was not supposed to involve calling back any civilians or causing any unrest in Russia among people who don't want to do this. And this is already turning out to be unpopular in Russia. We're seeing protests, very unusual. Somebody said there was like a 20-mile backup to go from Russia into Finland. People are fleeing to get out. You can't get on a flight out of Russia. And there are some reports that Russia has banned airline ticket sales to men between the ages of 20 and 65. So this is exactly the kind of negative reaction and perhaps even uprisings that Putin intended to avoid, but the war has just gone so badly for him that he really has no choice but to do this.
And Rick, you really did call it yesterday when Putin put off that address that we were expecting something big to be coming. So then beyond sort of condemning words, do we get any sort of sense from the international community about how they plan on reacting to this move?
Well, here's the dynamic. Putin clearly wants to divide Ukraine's allies, and that is part of what this war over energy in Europe is all about. It is to make European citizens extremely uncomfortable over the winter, as uncomfortable as possible, so that they increase political support to look, can we do something? Can we make some kind of deal in Ukraine so we can resume deliveries of Russian energy? There's no indication so far that Putin is able to split support for Ukraine among its allies. And I think one of the things President Biden and his team is probably doing at the UN behind the scenes, off stage, is mustering as much ongoing support for Ukraine as they can. And that is weapons deliveries, obviously, but economic aid is really important. I mean, the Ukraine economy is, has crashed. Food aid, humanitarian aid, everything it's going to take, and to line that up for months. I mean, this could still go on for months, even though it's going badly for Russia.
Yeah, it certainly can. Hopefully it doesn't. All right, Rick Newman, thanks so much for joining us.
All right, major bank CEOs testifying on Capitol Hill today. Yahoo Finance's Alexandra Semenova is here with the latest on what seemed to be a rather contentious day, as we usually expect with the bank CEOs on Capitol Hill.
Yeah, absolutely, Dave. Well, these testimonies got lost in the chaos of today's Fed decision and Putin's warning, of course, but there were some incredibly interesting exchanges between congressional leaders and these CEOs. The questioning was on a wide range of topics, including cybersecurity, racial inequities, particularly in their lending practices, overdraft fees, and many other items. And while these hearings hardly ever result in any kind of legislative action, it is incredibly consequential for these CEOs to be put on the spot and grilled by congressional members. Some of the takeaways were remarks from JP Morgan CEO Jamie Dimon. Again, he was talking about the Federal Reserve possibly still achieving a soft landing, but warning lawmakers that they should be prepared for the worst. Somewhat of a similar warning from Citibank's Jane Fraser. She said that we're going to be in for tough times ahead. And notable also was a very heated exchange between California Congressman Brad Sherman and Jamie Dimon. Sherman questioned Dimon and Fraser about whether they still have any stakes in Russian oil companies, to which they appeared to respond with some hesitation. And things didn't go well for Dimon when he tried to add on to the conversation. Let's take a listen.
Let me go on to Citigroup. Have you cut your ties with Lukoil and Vitol?
I just had one other thing. I don't think
not on my time. You can't.
No one is doing
reclaiming my time.
No
Mr.
one
Diamond
belongs to the gentleman from California.
You can do a press conference afterwards and comment as you like. Not on my time.
quite contentious there. There was also a lot of discussion on the geopolitical front. Jamie Dimon said that the biggest threat to U.S. financial stability are China and Ukraine, speaking in terms of the escalating economic consequences of the war in Ukraine, but also talking about the possibility of China taking military action against Taiwan. The bank execs were asked if they would pull investments in China if that happened, and they said that they would follow government guidelines on that. And also separately, there were discussions about competing with Chinese banks, and Jamie Dimon said that it's very important that America maintains financial supremacy. And again, these discussions are still underway. We have a second day of hearings tomorrow with a lot to be addressed.
Yeah, and it was an interesting dichotomy. It's more evidence that it used to be along party lines. Democrats would hammer away at the bank CEOs and Republicans were largely supportive. That was not the case today. We've seen that pivot, and in particular with ESG and things, ESG, excuse me, that narrative is definitely changing with the GOP. Alexandra Semenova, great stuff. I can't believe somebody talked to Jamie Dimon that way, but it is entertaining. Rochelle?
Well, yeah, it looks like he couldn't believe it either.
Yeah,
but JP Morgan CEO Jamie Dimon also giving a rather blunt opinion about cryptocurrencies in the hearing today. Take a listen.
You have to separate blockchain, which is real, DeFi, which is real, ledgers, tokens that do something and deliver information, money, ideas, simplify, smart contracts. That's one thing. I'm not a skeptic. Okay, I'm a major skeptic on crypto tokens, which you call currency, like Bitcoin. They are decentralized Ponzi schemes, and the notion that's good for anybody is unbelievable.
I mean, it's not really surprising. Back in 2017, he called crypto a fraud. But using this opportunity, though, I mean, obviously, when you're the head of a bank, you have your own sort of vested interest in your own views in crypto and tokens. But Shauna, what do you think?
Yeah, I mean, I don't think it comes as a big surprise. He's also called it worthless in the past. He's been very critical of cryptocurrency. He also pointed to the hacks and also the schemes, the fraud that has taken place in the crypto space. After the recent drop, the turmoil that we're seeing in the market, I think it will be a while before Jamie Dimon really changes his view on this space, Dave.
Well, I think really until, again, and I hate to feel like a broken record, Jamie is too on Bitcoin, but until it's tethered to something, until it has a practical use for someone like Jamie Dimon, I think he's going to continue to say things like that, and he's going to be proven right by the fluctuations that are anchored to, generally speaking, nothing, Rochelle. But I know you're going to defend it, right? You are going to defend it.
I mean, it's decentralized. That's kind of the point. It's meant to sort of circumvent these things. But, it's helping the unbanked. So we'll see. It's obviously still very, very volatile and not something to put all your money in all at once. Well, shifting gears now to Walmart, announcing today it plans to add 40,000 workers this holiday season. Now, that's far fewer than 150,000 that it announced last year. Well, joining us now is UBS Broadline and Food Retail Analyst Michael Lasser. So, Michael, what's your take on Walmart's hiring strategy at the moment?
My take on Walmart's hiring strategy is that they're being prudent for the holiday. There's a lot of uncertainty with the consumer. Also, keep in mind, a lot of the sales gains that have been driven throughout retail and Walmart have been due to inflation rather than transactions. So when you're seeing increases in the amount spent per transaction or amount spent per consumer, you don't need as much labor to process those transactions. Also, Walmart has been investing in more technology to increase the efficiency of its existing workers. So Walmart's being prudent with how it's going about it for the holiday season.
Michael, how do you think Walmart is set up really heading into the holiday season? You mentioned the fact, obviously, inflation, higher prices in terms of guidance. Their sales are expected to rise in the current quarter and the fourth quarter. A lot of that, though, tied to those higher prices. How do they stack up maybe against some of their other competitors out there?
I think Walmart's going to do very well during the holiday season. They've been seeing some consumers who typically don't shop at Walmart that come from more affluent households trade down because of all the well-documented macroeconomic pressures. And I think Walmart believes it has the right to win more wallet share with those consumers. It also has a lot of tools at its disposal to gain more wallet share, like Walmart Plus, can be aggressive on price. It's got a lot of inventory. And so I think Walmart is positioned to win over the holiday season.
And beyond that, the Fed chair today talked about it being very challenging to accomplish that soft landing. So if it is a recession, what are the implications for a retailer like Walmart?
The implication of a recession for a retailer like Walmart is that it's going to benefit. There's no better way for a consumer to stretch a dollar through lower prices than going to Walmart. And so the most likely case is that while a lot of retailers are feeling the pressure from that into 2023, Walmart's seeing a benefit from a more difficult economic environment. Also, in a more challenging overall retail landscape, it's likely that there's going to be more consolidation. The marginal retailers are going to have a difficult time surviving. That would leave more share for Walmart to gain. And in any of those scenarios, a tough environment is good for Walmart.
Michael, who might not survive?
Well, there's a lot of retailers that are experiencing challenges right now. We have a sell on Bed Bath & Beyond. Its sales have been declining at a 20% clip. And so Walmart's well positioned to gain share given the proximity of its stores to a retailer like Bed Bath & Beyond.
And I wanted to ask you, obviously inventory issues have been a problem for retailers, how you think Walmart is faring with that, and also this sort of foray into banking that Walmart is heading towards.
So we think Walmart is just with its foray into other categories like banking, healthcare, opening its e-commerce website to other merchants. It's looking to tap deeper into other profit pools and do more with its existing customer base. On its inventory position, it's been managing through this over the last couple of quarters. I think it's going to be aggressive with general merchandise, areas like consumer electronics, home furnishings, apparel during the holiday season, because it's seeing trade down from some more affluent consumers. Those consumers also have more money to spend. They're coming in, they're buying consumables like food and household products. And we think that they're going to offer aggressive deals to try and sell those consumers the general merchandise as well.
All right, a big thank you there to UBS Broadline and food retail analyst Michael Lasser. Thank you so much for joining us. All right, well, coming up, Salesforce's Dreamforce conference is back. Co-CEO Brett Taylor tells us why its latest platform announcement is such a game changer. Stay tuned. Welcome back. It's day 2 of Dreamforce 2022, the annual conference hosted by cloud company Salesforce. Yahoo Finance's editor-at-large, Brian Suzzi, sat down with Salesforce co-CEO Brett Taylor to break down the company's cloud business. And he first asked him about what this event means for the company. Take a listen.
Let me give a little context, especially for your viewers who are not familiar with this Dreamforce thing is. Salesforce is more than a company. We are in a community and an economy. IDC estimates that the Salesforce economy is going to be 9.3 million jobs, representing $1.6 trillion of economic impact by 2026. Those are big numbers. Well, this is the centerpiece of the Salesforce economy. So you have trailblazers, our administrators, our developers, all the partners like Snowflake and DocuSign that have built businesses on Salesforce, all here to do business with each other. And so, we talk a lot about the economy right now, and it's complex, a bigger question than for people like me. But right now, people are doing business, because despite all the complexity in the supply chain, foreign exchange, all the things that you talk about all the time on Yahoo Finance, digital is more relevant than it has ever been before. And Dreamforce is bigger than just Salesforce, right? All these people are connecting to find jobs, to talk about digital transformation. And what I'm hearing is despite all the complexity in the economy, digital is the centerpiece of people's strategy. And what I'm really grateful for is this ecosystem is here to do business, to create jobs. And it's really rewarding. And honestly, it's been a long 3 years. I'm really grateful we're back.
Did you want to hit me with a GDP forecast? No, just had to ask. I had to ask. But is it still, when you talk to customers, is it still a measured buying environment?
Well, here's what I'll say, is I think CFOs have a lot of power right now. People are focused not just on top line growth like they were through the past few years, but also bottom line growth. When you think about digital technology, it's about both, right? It's about automation. And in fact, our big announcement here at Dreamforce from a technology standpoint was a product called Salesforce Genie, which is all about data, intelligence, automation, and real time. And those are a lot of technology words, but what it means if you're a technologist, it means I can build amazing new customer experiences. If you're a CFO, it means I can drive automation and cost savings and efficiency. And I think technology has a promise to do both. And that's what I think everyone's here to figure out is how can we drive results now in a time when time matters, value matters, automation matters, and that's what's so exciting. It's obviously a more measured environment, but I think technology is the solution.
Do you think this measured environment loosens up at all next year?
As we've talked a lot about this, and I'm not an economist. I actually just interviewed Larry Summers on stage here moments ago.
He was right on the Fed. He was right on the Federal Reserve.
He's been right about a lot of things. What we're trying to do is not try to predict the future of the economy. We're trying to help our customers navigate it. So if you're a company and you're still navigating the complexities in the supply chain, if you're a multinational, you're trying to figure out what do we do with the strength of the dollar right now, where your Japan business is worth a third less than it was a year ago. These are things that most managers haven't experienced in their careers. What we're trying to do is say, here's a platform, here's a company that can focus on your success, on your innovation. Here's a company to help you develop trust with your customers, and we can help you be more resilient in the face of all this uncertainty. And I think that's why this sold out faster than any Dreamforce in our history. It's why 40,000 people are here and millions of people are watching online, because no matter how measured the environment is, people want to come together and find solutions. And I honestly feel a ton of optimism here at Dreamforce.
In your keynote, it said something that was pretty interesting. Besides, I was watching, I think, when Bunny Ears on the live stream, it was very fascinating.
I'm never going to live down the Bunny Ear.
No, you're not. You're probably viral. You're around the world now. But you said that you're seeing a better pace of organic innovation. What is driving that, in your view?
Well, first, I just want to give a shout out to all the Salesforce engineering team if you're watching right now. I am so grateful for all their work. Through a pandemic, working from their homes. We've just invested a lot in what we call our core CRM, sales, customer service, marketing, e-commerce, our core platform. And through all those foundational investments in technologies like Hyperforce, which enables our customers to go with data residency in places like Europe, where compliance has become more complex for companies to navigate than ever before. And through those investments, we're really starting to see the returns in momentum. And I mentioned this in the keynote, but when Mark and Parker 20 years ago were at the first Dreamforce, probably not quite as big as this one.
I was still trying to get through my last year of college.
Yeah, exactly. I think Parker had no gray hair at that point. There's 150 million PCs in the world. Fast forward today, there's 15 billion smartphones, more smartphones than people. 125 billion connected devices. And you need this pace of innovation for every one of our customers to keep pace with their customer expectations. And no matter what the roller coaster of the economy that you can talk to Larry Summers about later, that secular trend of digital is moving faster than ever before, and we need to enable our customers to succeed in that environment no matter how much they're focused on cost savings. And I'm really excited about the opportunity we have to do that.
Look, I know you're a busy guy, so we'll let you go. We'll end it on this. One of the biggest questions we get on Salesforce at Yahoo Finance is, when are they buying another company? You bought Slack, MuleSoft, Tableau, but I think you've made some very key points on the last earnings call that you are focused on an operating margin of what, 20.4%? You're not buying a company tomorrow, right? You seem very focused on driving better profits at this company.
Well, first, let me just say, I'm so proud of the success of our acquisitions. You talked to Stuart Butterfield earlier this week, a remarkable entrepreneur. Our acquisitions have helped shape who we are as a company today. So M&A was a part of our past. M&A will definitely be part of our future. But as you said, our focus right now is profitable growth. We know that as we scale, we guided to $31 billion in revenue, 20.4% in operating margins. We want to expand our operating margins, expand our cash flow over time through discipline, and understand that there's leverage in our business. And I don't think the two are at odds with one another, but we're very committed to profitable growth. We're really committed to bottom line performance as well. I'm also really proud of how important acquisitions have been to our company, and we want to do so in a shareholder-friendly way and a disciplined way. But just look around you. We would not be here if not for MuleSoft and Tableau and Slack, and it's a part of our identity now.
All right, that was Brian Sozzi with Salesforce co-CEO Brett Taylor with some lofty growth projections. All right, New York Attorney General Letitia James causing a political earthquake, filing a suit against former President Donald Trump, his three oldest children, and the Trump Organization, accusing them of more than 200 instances of fraud over 10 years. Let's hear what she had to say.
This conduct cannot be brushed aside and dismissed as some sort of good faith mistake. The statements of financial condition were greatly exaggerated, grossly inflated, objectively false, and therefore fraudulent and illegal. And as a result of that, we are seeking relief, and Mr. Trump, the Trump Organization, his family, they should all be held accountable.
The New York AG there, Alexis Keenan here with more. Alexis, we've almost become numb to legal peril from the former president, but this is a big deal.
It's a big deal, and at this stage, it's a civil complaint, but there are trappings and some criminal allegations that AG James have put into this complaint. Now, it's 200 and some pages. I haven't been through all of them yet, but I'll tell you what I know. So there are 7 counts in there, this mixed bag of criminal accusations and civil. It's a fraud and business misrepresentation case so far. What the AG alleges is that Donald Trump, along with his 3 children who work at the Trump Organization, also Alan Weisselberg, the CFO, who just pled guilty to some criminal fraud charges, and also Jeffrey McConney, who is the second in command to Weisselberg. They are all named, as are a litany of different Trump organizations. And the focus is on 11 years of what are called annual statements of financial conditions. That's what AG James was just talking about there. It's from 2011 until 2021, she says. They're misrepresentations, according to her, of Donald Trump's net worth. And why that's important, she says, is that those numbers were illegally inflated. She said to the tune of billions of dollars. And that the purpose, she said, was to induce banks to give favorable lending terms to Trump and the organization, and also to give favorable insurance, to get underwriters to give good terms on insurance for his properties, mostly by inflating real estate properties. That's how she claims that this scheme was cooked up. So I want to give you just one example that's in here, and there are many, but this is just one of her type of allegations. Now, if we look at Trump's home at the Trump Tower, AG James claims that in the year 2015, claiming that there was an overstatement of the square footage on that residence of 19,000 approximate square feet. She says that it was actually stated as that it was 30,000 square feet, but it was really just 11 square feet. And also the price per square foot, she says, was then also inflated 3 times higher than the highest sale that year. So that's the type of thing that she's talking about here. And it goes through instances like that, similar to that, across the Trump properties and across his golf courses. And so really globally here.
And Alexis, as you mentioned, this is a civil case, but what about the potential for criminal charges as well?
Yeah, so A.G. James did say that she was taking her allegations here and referring them over to the Southern District of New York, referring them to the Manhattan DA. So we can expect then that they are sharing information. She said that she would be cooperating with any request that they have and the evidence that she has dug up so far in her investigation. And also at a press conference, it was asked whether the IRS would also be learning about these claims. She said yes, that all of these agencies that would have interest in what she found would be apprised and would be able to access what she has turned up.
And a $250 million fine is what he's facing on the civil portion of this.
Right. Well, actually, A.G. James is asking for a lot here. She wants $250 million. She says that's the ill-begotten gains that these schemes have turned up. So, but that's not all. She also wants to dissolve the corporations that are run by Trump and his associates in the state of New York. Also wants to restructure them. Wants to bar the family members from serving as officers and directors of any New York entity that they have, and also wants to replace the company's trustees, and also wants a third-party monitor to go in place to oversee these companies.
Stay tuned. Alexis Keenan on that story for us. She will follow it. Thanks. Next, Taco Bell partnering with Beyond Meat to cook up a new dish for vegetarians and vegans. All the delicious details on the other side of the break.
Let's take a look at some of these after-hours movers here. Lennar and KB Home both out with earnings results. We know home builders took a hit here after what we heard from the Fed in terms of raising rates another 75 basis points. Lennar in the red, off just around 1% here after hours. Now, the company reporting mixed results on both the top and bottom line. EPS coming in better than expected, but revenue coming in a bit light. New orders off 12% from a year ago. Deliveries, though, up 13% for the most recent quarter. Now, the company's CEO saying that, quote, sales clearly impacted by rising rates and demand, though, does remain strong, saying that the company is navigating the rebalance here that we're seeing between price and interest rates. So Lennar closing the day off just around 1% over the past 3 months. Let's take a look at that chart. Up just around 15% year to date, though, a very different picture with shares off 34%. Now, KB Home also out with results here after the bell. The stock moving after hours off just around 1.5%. Now, it was sliding earlier. Deliveries disappointing on some supply chain issues within the company. The KB Home also saying that those supply chain issues will likely extend into the fourth quarter. Net orders there off 50% on a year-over-year basis. Now, KB Home off 2% today. Past 3 months, taking a look at that chart, up just around 9%, so not exactly the performance that we've seen from competitor Lennar. Year to date, though, very similar picture, off just about 37%. Rochelle?
All right, well, here's my stock to watch for tomorrow, and it's Costco. The retail giant reporting earnings after the close tomorrow, and all eyes will be on memberships and cost pressures in this inflationary environment. Now, there is speculation the company could raise prices of its annual membership fee. You remember that after Sam's Club made that same move last month. Costco expected to report earnings of $4.17 per share on revenue of $70.8 billion. Shares just slightly down about 1.33% today. All right, well, coming up, vegans rejoice. Taco Bell and Beyond Meat have cooked up a collaboration just for you. We have the details next.
Carnade means Spanish, meat in Spanish, but not at various Taco Bell locations in Ohio next month. That's where they'll roll out Beyond Meat carne asada. Sounds delicious. Ali Canal is here with the details. I'll get it right one of these days. You tried it though.
I did. I got a chance to try it yesterday. Now this is a test product. Like you mentioned, it's only going to be available at around 50 Taco Bell locations in Dayton, Ohio. Once that testing period is over, perhaps they'll roll it out to some other cities and states. There it is in all its glory. I gotta say, it really did taste like carne asada steak. Look at me. I mean, I also had a bad bellyache yesterday because I had a quesadilla, a burrito, all with this Beyond carne asada, but it was
so maybe in moderation.
Maybe in moderation, maybe not all at once. A warning to the viewers. But I will say that Taco Bell really wanted to get this right. This took a little under 2 years to develop. They told me they didn't want to be a sea of the same. There's plant-based chicken out there. There's plant-based beef, which, by the way, Taco Bell is also working on as a proprietary product. But there hasn't been anything, at least not in the QSR market, when we talk about plant-based steaks. This is a really important initiative for them. They said this is actually going to cost the same as traditional steak, so they're not doing any upcharge or any premium there because they want people to enjoy it and have that value. They're
That's
all
shocking.
about, yeah, they're all about creating value. But we've talked about the Mexican pizza. We talked about their craveable menu offerings, and that's really helped them with same-store sales beating expectations in the last quarter. So, you know, they just know what they're doing, I feel like, at Taco Bell.
I love that they're not raising the price, because usually when you have when they substitute for these Beyond Meats, it's always so much more expensive. Now, I've not had Taco Bell since college, but I love Beyond Meat. So this, if you're in terms of a crossover, I'm into this. I would definitely try this.
Yeah.
When is it coming to everybody else?
That's the thing. It's TBD on everybody else. This was a partnership that Yum struck with Beyond Meat in February 2021. We have seen Beyond Meat products at KFC locations, at Pizza Hut locations, but this is the first one for Taco Bell. So, you know, we'll see how it performs in the market. I have a feeling it's going to do really well. If you take a look at something like the Impossible Burger at Burger King, for example, that did so well, continues to do big numbers for the company. So I feel like this is something that people want. They want a plant-based option, a vegan option.
I hope you washed that all down with the Baja Blast at Taco Bell, because those are awesome.
Thank God I didn't, because like I said, the bellyache.
That, imagine what the Baja Blast would have done to you.
Big regrets, but also not entire regrets. So we'll see.
Good to see you. Thanks so much. That'll do it for us today on this extraordinary Fed Day. For Ali and Shauna and Rochelle, I'm Dave Briggs. We'll see you tomorrow, 3 o'clock Eastern Time.